Hello everyone, good evening to all. Welcome to CFR Marathon. Okay, 3.0. So I got a lot of messages from number of students. Okay, so we decided to do the marathon class for CFR. Okay, so almost more than 100 students we have. Okay, for CFR only regular classes. Fast track also I have some, I don't know the exact number. Fast track also a lot of students we have. Okay, even if you take the fast track or regular classes, still please go with this marathon classes. It's like a revision. Okay, I will cover a lot of topics. Okay, I am unable to all the questions, or I cannot teach all the questions or a number of questions also. It's not possible in this marathon, right? But I will teach a few important questions which will be helpful for examination. Okay now, and I will provide a marathon material also. We have a marathon material. Don't worry about it. I will upload in a Telegram channel. Okay, so before starting the video, please subscribe the channel. Okay now, I think I uploaded a last video almost 3 to 4 months ago. Okay, I'm busy in classes as well as my work. Okay, so that's why I'm unable to focus on YouTube also. Okay, clear? So come to examination pattern. Actually a lot of students are they feel difficult about this subject. Even a lot of students have taken classes. Before taking classes they said like this only: sir, CFR subject is difficult. Is 100 hours is sufficient or not? So I got a lot of questions from number of students like this. Now everyone got satisfied with the CFR. Yes, it's possible. Very simple subject with our classes. Okay, clear? just follow our classes. Okay, clear? So come to marathon anyway. So we have a total 8 questions in our question paper, right? Total 8 questions we have in our question paper. The first question is MCQs. 15 to the 30 marks, right? 15 to the 30 marks. It's very easy. Almost 10 MCQs we can easily attempt. Okay now, next question number 2, 3, 4, 5, 6, 7, 8. Okay, sir, actually I have not taken any classes. Okay, I'm preparing, I'm self preparing. Okay, still, okay, please go through this video. You will get a good marks from this marathon, no issue. Seriously sir, seriously, I'm giving my 100% for this marathon. Like first marathon what we have uploaded, we got a lot of response from it, right? So like that only I'm decided I want to give my 200% for this marathon class. Okay, 200%. Don't worry about it. Easily you can crack this subject. So our target is exemption, that's it. Sir, with the marathon exemption is possible means yes, provided you have to study previously. And practice is very important in this case. Practice is very important. And what are the topics we need to study? So we need smart work from right now. From now we need to do smart work, not a hard work. Don't do all the problems, all the topics. Don't do like that. Just to follow the procedure. Okay now, I will give some suggestions, please follow that. That's it. You will get a good mark from this. Are you ready? Clear? So come to question number 2 and 3. These completely Ind AS. So mostly Ind AS 115, 116 pakka. Important standards 115, 116 pakka questions. And 36, 38, 16. Okay, 23 also may ask. Okay now, so these are the very important standards. I will tell important standards later. Okay, so easily we can crack this. in our previous attempt also, every student can easily answer these questions. Whatever the questions we got from Ind AS, that's very easy questions. If you see the previous question paper, you can solve easily. Seriously. Okay. From our material only we got the questions, right? Next, come to question number 4. Actually, this I prepared this based on the last attempt paper, previous paper, right? So either question number 4 they may ask about the valuation of a shares or from 109. So last time we got 109 question. This time valuation of a shares question may ask. Okay. Last time 102 question is not there, right? So this time they may ask 102. Very important. And business question. Reconstruction question also they asked in previous attempt, business combination. So possible combination. Next, question number 5 and 6, combination of a business combination, CFS, consolidated financial statements. Question number 7, theory topics. They may ask a problematic also from theory, like EVA, economic value added statement. So like that they ask some few problematic questions also. We have seen in last attempt, right? And completely theory topics in last question, 8th question. Okay, now clear? Everyone, these are the 8 questions. Sir, now what I want to do? Simple, sir. What we need to do? Simple. Please, first of all, you must focus on Ind AS. That's the first point. Ind AS, you must study Ind AS. Okay, Ind AS you have to study 16, 36, 38, 115, 116, 102. Mostly these 6 standards, 108 anyone can answer easily, right? Correct or not? These standards are very, very important. A plus standards. These 3 are A plus plus standards. Okay, I am giving a grade. Next, come to everyone have very well in valuation of shares. I think so. Everyone is good at valuation of shares. And 109 pakka. Please do these two questions. These two topics compulsory. Next, come to what is that? Theory topics, mainly theory topics. Like definitely we will get questions from government accounting. Okay, so please go through that. We will get only theory questions. So from problematic we will get some like EVA, market value added, theory question also there, like value added statement. So that questions also they may ask. Theory questions. So go with the complete theory like sustainability, QBL, quadruple bottom line reporting, CSR. CSR have some limits, right? So from that limits also they may ask one question. We have everything in our, I will discuss in marathon, but whatever we need to study, I will give a marathon material also, don't worry about it. Okay, clear? Everyone clear about it? Okay. Next, if we complete these 3 topics, Ind AS and valuation of shares and theory topics, almost we will cover how many marks, sir? Each question carries how many marks here? 14 marks, right? 14 marks. So 28 marks we will cover here. Here also 14. Here also 28 marks. Almost 70 out of 70 marks we will cover with these topics. But if the extra question asking from business combination, for the to cover that also, don't take any chance. So we need to study that business combination also. We need to study business combination, that's it. If you don't have a lot of time, yes, obviously we don't have a lot of time. We need to prepare for 8 subjects. We need to give time to all the subjects. Correct or not? Yes, we need to give time to all the subjects. That's why. Okay, next, please keep my video in 1.5 speed or 1.75 speed. It will be clear, I think so. Okay, easily you can learn. Clear? So if we go through these topics, obviously we will attempt 100 marks, but the question paper will come for 128 marks. Correct or not? question paper is for 128 marks. We need to write only 100 marks. Okay, out of the 30 marks is MCQs. Okay, on an average, if you prepare these topics very well, okay now, so it will take not that much time also, sir. For Ind AS, the specific Ind AS I am saying, not all the Ind AS. At least out of 28 marks, we will get a minimum basic marks, sir. Basic marks. If you follow our material, that's more than enough. That's more than enough completely. Okay, but I'm damn sure about the regular as well as the fast track students. You need to do all the questions from our book. That's it. Definitely you will get a good marks. Okay, this is just for revision purpose only. Okay, I will not discuss all the questions and all. Just the concept only I will give. A very few questions, 1 or 2 questions I will discuss here. That's it. That is only possible in our marathon, right? We don't have a lot of time to discuss all the questions and all. Okay, just important questions. Very few questions I will discuss here. But I will give the complete concept knowledge. Okay, I will try my level best to give. As per the time, I will give a lot of content to you. Don't worry. Next, so this is the question paper and pattern. You need to write out of the 7 questions. You need to write only 5 questions. 5 14s are 70 marks plus 30 marks MCQs. Total 100 marks. That's it. This is the question paper. So out of the 7 questions, you can write any 5. No issue. If you go with Ind AS, if you are good in Ind AS, okay, go with that. If you're good in theory, go with that. Please don't ignore theory. Theory will be very helpful. Okay, now are you getting my point? Very, very helpful. Or I don't want theory, sir, means okay, then come to business combination and CFS. I have given a clear explanation about the business combination and CFS. How to consolidate. Suppose example, holding company is given, holding company financials and subsidiary company financials. How to consolidate both? I have given a clear explanation about these 2 topics. Okay, now please go if you all students who have purchased the classes, no issue. Okay, now so just I will give a conceptual knowledge in this marathon. Okay, based on the time requirement. But damn surely I will discuss all the Ind AS as well as the valuation of shares and business combination. Valuation of shares and 109 and theory topics and business combination to some extent. That's it. This is the portion I will cover in our marathon. That's it. Clear? Okay. Can I start? Okay, guys. Let us start. So first we are going to discuss what is the topic. Ind AS 16. So these are the important Ind AS for exam purpose. What is it? 16, 23, 36, 38, 102, 108, 115, 116. Okay. We will cover it conceptually. Don't worry about it. Okay. Almost we will get a basic marks I have written 25 marks. Okay. Here at least you will get a 16 marks. Business combination 20 marks. All theory 16 marks. MC questions. So overall total 100% we will, we need to write only 100 marks only, but the question paper given for 128 marks, right? So we will cover a lot of topics. Don't worry about it. So I will try to give my level best. Okay, I want to cover a lot of topics if time permits. Okay. So come to Ind AS 16 PPE. First of all, what do you mean by PPE? PPE are the tangible assets. Correct or not? Tangible assets which can be seen and touched. Okay, which are held for use in the production or supply of goods or services. That means, suppose example, plant and machinery. Okay, by using the plant and machinery, we can produce the goods. Correct or not? We can produce the goods. Yes or no, sir? Yes. And for rental purpose, we can give on rental basis. Suppose example, we have 2 buildings. One building used for business purpose, another building given for rental purpose or for administrative purpose. Suppose example, we are using a building for business purpose, administrative purpose. Okay, so and condition are expected to be used more than one accounting period. Obviously, such building must be used more than one accounting period. Then we can say it's a PPE. So what are the examples? Generally simply fixed assets, sir. Okay na, building, land and building, nothing but furniture. Okay na, equipment, plant and machinery, these all are comes under PP. Clear? Everyone clear about it? So it's a simple definition, no need to discuss a lot of things here. Next object is simply we have to know the accounting treatment, correct or not? So accounting treatment, just wait. Okay, to prescribe the accounting treatment for PPE, so that understandable to the users. Okay na? So we need to know the accounting treatment. This is the scope means applicability, non-applicability we are talking about. Okay, so this is not covered under Ind AS 16, non-applicability actually. These are not applicable. Okay, PPE class held for sale as per Ind AS 105. It is covered under Ind AS 105, not Ind AS 16. Biological assets related to agriculture activity covered in Ind AS 41. But other than bearer plant, MCQ purpose important. For bearer plant, Ind AS 16 will be applicable. Okay, bearer plant comes under biological assets only actually. But for particular bearer plants, Ind AS 16 only will be applicable. So, but for biological assets, so like living stock, livestock, cattle, so these all comes under biological assets. Bearer plant means what is the bearer plant? What is the bearer plant, sir? Simply we can suppose example, if you take an example, coconut tree. By using that coconuts we can sell to some other market, whatever maybe we can use. We can get a benefit from it, right? We have a long-term benefit there. So that is known as a bearer plant, simply bearer plant. Okay na? So mineral rights such as oil, natural gas is all not covered under Ind AS 16. That's it. Very simple. Yes. So scope we covered. Okay. Definition, objective. Next, recognition. Recognition simple, sir. Generally, asset should be recognized only when it follows the two conditions. It satisfies the two conditions. Simple. It is probable that future economic benefit associated to the item will flow to the entity. Associated with the item will flow to the entity. Nothing but suppose example, it should generate future economic benefit. Suppose example, I purchase one building for college purpose or institute purpose. Okay na, definitely it will generate a future economic benefit. Students will come. So for that purpose, I need to purchase the benches and board, laptops, AC, everything I need to purchase, right? So definitely I will get a future economic benefit from it, right? Correct or not? And cost should be measured reliably. So that such cost should be measured reliably. If two conditions satisfied, then you can recognize the PP in your books of accounts. That's it. Can you please repeat this? Very important. You can use it. You can write anywhere. Before starting the standard question, you can write this. So cost of a PP can be recognized only when two conditions are satisfied. It is probable that future economic benefit will be flowed to the entity and the cost should be measured reliably. That's it. Clear? So such recognition have, I think everyone knows about it. Initial recognition, subsequent recognition. Initially always recognize at a cost. How to calculate that? See here. Purchase price. So take purchase price minus trade discount or rebate, but not cash discount. Please don't take cash discount. Only trade discount or rebate you can reduce from the purchase price. Okay, such a trade discount, suppose example 5% trade discount, which means you need to apply this 5% on purchase price only. Okay, now next, non-refundable taxes. Is there any non-refundable taxes you must add it? Refundable taxes don't take. Refundable tax means even if you paid it will get refund. So don't take the refundable taxes. Only non-refundable taxes only you can add. Is there any cost directly attributable to the asset, to its location and condition, like employee cost, cost of preparing the site, freight and delivery cost, installation assembly cost, cost during the test run, professional fees. So these are all the direct cost to bring the asset to the present location and condition. Okay, now sometimes legal fees also we can take. Site preparation cost. So these are all the costs you need to capitalize. That means added to the value of asset. Correct? Capitalized means added to the value of asset. And one more point is estimated dismantling cost, which means, suppose example, if you purchase a building, okay, suppose example, the life of the building is 20 years. After the end of the 20 years, definitely you have to dismantle that building. For that dismantling, you need to incur some cost, right? But when you will incur that cost at the end of the 20 years. But previously this point is not there. Okay, recently this point have been added in the cost of asset. This cost also we need to add to the value of asset. Sir, how can we add this cost? We don't know exact dismantling cost, right? So that's why we need to estimate that. We will estimate that in after 20 years, you will bring that value to the present value and then add. Are you getting my point? Suppose the example, at the end of the 20 years, the value is 1 lakh. You need to bring this 1 lakh to present value. Nothing but for 20 years. Suppose the example, it is 25,000. Assume that. You need to add this 25,000 here. Estimated dismantling cost present value. You need to add present value. Are you getting my point? Okay, now. So total cost, you will get the total cost of the asset. Okay, we have one question also on that. Next, cost excludes. This is MCQ purpose important. Cost excludes administrative and general overheads, advertising and promotion cost of a new product, cost of relocating. Okay, initial operating losses and the operation at a low level. Incidental cost not directly related to installation. Okay. Next, inauguration cost. Please note down inauguration cost. Cost of opening a new facility. You can also call it as. Okay. So please don't add this cost. Please don't consider it as a cost. Please exclude. Exclude means don't minus, sir. Just ignore. Are you getting my point? Suppose the example. PPE cost 10 lakhs. Freight 1 lakh. Example. Dismantling cost present value 1 lakh. Administrative overheads 1 lakh. Okay. Relocating cost 1 lakh. Please find out the cost of asset. Everyone. 10 lakhs plus, yes, freight we should add. 11 lakhs plus 1 lakh. Dismantling cost also we need to add 1 lakh. So total 12 lakhs. Can we add this administrative cost? Ignore. Can we add relocating cost? Ignore. So total how much? 12 lakhs only. This is the meaning of excludes. Don't minus this 1 lakh. Assume, suppose example, if the question is saying that this administrative cost is included in freight or PPE, then you need to exclude, because administrative cost don't consider that. Don't consider that administrative cost, right? So at that point of time only you need to reduce. You need to subtract. Otherwise ignore. That's it. Cost excludes means administrative and general overheads, advertising and promotion cost of a new product. Next, cost of relocating, initial losses and assets at operating at low level, and incidental cost not directly related to installation. Inauguration cost, cost of opening a new facility, which means cost of opening a new facility. That means inauguration cost. Don't consider that cost. Initial operating losses also please don't consider. Okay, now. Next, subsequent recognition. We have two types of models actually. One is a cost model, second one is a revaluation model. One is a cost model, second one is a revaluation model. So, cost model means we should recognize the PPE at cost only. Out of that, we need to reduce the depreciation minus impairment loss. Then you will get a book value. Okay. So, can you please repeat cost minus obviously depreciation means what is the depreciation? Decrease in the value of asset. So we need to decrease from the cost of the asset. So minus depreciation. Then what is impairment loss? This will cover under Ind AS 36. Impairment loss. So we will cover elaborately there only. Impairment loss. Okay now. Clear? Impairment loss also. Impairment loss means reduction in the value of asset, obviously. This is also estimation. Then you will get a book value or carrying value. Yeah, this is cost model. Suppose example, subsequent means suppose example year and for next year. Okay, now not on the date of purchase I am talking about. That is initial recognition. This is subsequent recognition. Suppose example, you may follow revaluation model also. If you follow revaluation model, you need to revalue the asset value. Okay, that is means fair value on the date of revaluation you need to take. Don't take the cost. You need to take the fair value on the date of revaluation. From that you need to reduce the depreciation minus impairment loss. Then you will get a book value or carrying value. That's it. Clear? Initial recognition, cost. Subsequent recognition, we have two models. Cost model, revaluation model. Cost model means cost minus depreciation minus impairment loss. Revaluation model means fair value on the date of revaluation minus depreciation minus impairment loss. Then you will get a book value. So discuss revaluation concept. Yes. Come to revaluation concept, everyone. So examination point of view, very important. So the question may ask from this topic. Okay. So for the example, so I will discuss small example. Don't worry. So for the example, cost of a PPE. Example 10 lakhs. The cost of a PPE is 10 lakhs. Just wait. Okay. Cost of PPE. Example 10 lakhs. 10 lakhs. Assume that there is no depreciation. Okay. At the end of the year, the value gets revalued to revalued amount is 12 lakhs. Revalued amount is 12 lakhs. That means how much increased amount? Revalued amount how much here? 2 lakhs. This is the case 1. Case 2 is revalued amount is 7 lakhs. Okay, this is the case 1. Come to case 1. This is revaluation upwards. Because the value gets increased. This is revaluation downwards. Revaluation downwards, upwards, downwards. So come to upwards. Suppose example, when you purchase the PP, what is the entry? PPE account debit to cash or bank, 10 lakhs, correct? This is on the date of purchase, PPE to cash or bank. But subsequently revalued, you revalued the PPE. So the value will become, the value becomes 12 lakhs, which means 2 lakhs increased. So PPE account increased by obviously 2 lakhs only, sir. So 2, what is that? This is the point. The increased revaluation amount will be transferred to what is that, sir? Revaluation surplus account. That means OCI account. Other comprehensive income. Revaluation surplus will be transferred to OCI. Okay, so PPE to OCI account simply. Bracket lo revaluation surplus. What is the entry? PPE to revaluation surplus, which means if the revaluation upwards, what is the entry? PPE to revaluation surplus. That's it. Keep OCI in brackets or whatever may be your wish. Suppose example, if the revaluation downwards, on the date of purchase, same entry. PPE account debit to cash or bank 7 lakhs only. Sorry, 10 lakhs only. This is the second case. But on the date of revaluation, the value will get decreased by 3 lakhs. So 3 lakhs decrease means asset value will get decreased by 3 lakhs. So to PPE account 3 lakhs. Then what we need to debit? Don't take revaluation surplus here. We have to take P&L account. P&L account should be debited because it's a loss. Correct or not? So P&L account debit to PPE 3 lakhs. That's it. This is revaluation downwards. If the revaluation upwards, PPE to revaluation surplus or OCI. Okay. If the revaluation downwards, P&L to PPE 3 lakhs. That's it. Clear? So now come to second point. Case 1, second point. Initially the value is 10 lakhs and then upwards to 12 lakhs and again downwards to, suppose example, 9 lakhs. This is the case second point in case 1. Initially upwards, then what is the entry there? PPE to revaluation surplus, nothing but under revaluation surplus, what is the surplus amount here? 2 lakhs. 2 lakhs is the already credit balance, right? That's the benefit actually. Asset value increase means benefit. So 2 lakhs we have a revaluation surplus balance, right? So revaluation surplus account balance is 2 lakhs. So in second year, next year, the value gets decreased from 12 lakhs to 9 lakhs, which means how much decreased? 3 lakhs decreased, correct or not? Everyone. From 12 lakhs to 9 lakhs means 3 lakhs decreased of PPE value. PPE value decreased by 3 lakhs, correct or? So then what is the entry? Everybody. General entry. This is downwards, sir. Downwards, then what is the entry? P&L to PPE 3 lakhs. So generally this is the entry. If it was the first time, okay, then you can write this entry only. But it was not the first time revaluation. Previously already revalued. So at that point of time, you have to check, is there any revaluation surplus previously? First of all, please adjust that revaluation surplus, and any other extra amount is there, then go to P&L. Which means we already have 2 lakhs revaluation surplus account in credit balance. Now you can adjust means you need to debit that. So revaluation surplus account 2 lakhs. The balance amount how much? 1 lakh. That should be debited to P&L. That's it. Are you getting my point? It's the first time. You can write P&L to PP only, but it was not the first time. Already we have a revaluation revalued, and also we have revaluation surplus. How much? 2 lakhs. So first of all, adjust that to 2 lakhs. We already have 2 lakhs credit balance. Now you need to debit that, adjust that, and the balance will be transferred to P&L. Suppose example, if it is reduced by 10 lakhs only, from 12 lakhs to 10 lakhs means only 2 lakhs. So then this P&L is not required. Only revaluation surplus to PP. That's it. Suppose example, if it is 8 lakhs. 8 lakhs means PP value decreased by how many lakhs? 4 lakhs. So to PP 4 lakhs. Revaluation surplus how much? 2 lakhs only we have. 2 lakhs only we have. So you need to debit that. The balance how much? P&L. 2 lakhs. That's it. Clear everyone? Come to case 2, second point. Case 2, second point. What is that? Initially the value is 10 lakhs and then reduce it to 7 lakhs. Now increase it to 11 lakhs. Assume that. Okay now. Clear? Initially the value is 10 lakhs. Okay. The value reduced by how many lakhs here? 3 lakhs. What is the entry? P&L to PP. P&L to PP. P&L to PP 3 lakhs. Now in second year the value increased by 4 lakhs. So generally students will write what is the entry here? PP account increased by 4 lakhs. Okay. Nice. To revaluation surplus account 4 lakhs. Generally you will write this entry. You will write this entry if it was the first time. But it was not the first time revaluation, already revalued. At this point of time also you need to check, is there any previous balance in P&L? Because it is initially it was downward. Downward means so obviously it will go to P&L only. Obviously it will go to P&L. So how much here we have balance? 3 lakhs. First of all you need to adjust that 3 lakhs balance. And then any extra amount increased, then it will be transferred to revaluation surplus account. So then what is the entry? PP account debit 4 lakhs to P&L 3 lakhs to what is that? To P&L 3 lakhs to revaluation surplus 1 lakh. That's it. This is the way of understanding revaluation concept. If you want, you can revise this concept again. Okay now. Sometimes initially 10 lakhs. First year 12 lakhs, next year 14 lakhs it may be. Then what is the entry here? PPE to revaluation surplus 2 lakhs. Here again PPE to revaluation surplus again 2 lakhs. So don't confuse. Here there is no need to confuse. One time increase, second time decrease, then only you need to think like this. Correct or not? Obviously. Every time increasing or every time decreasing, no issue will come. Sometimes decreases, sometimes it increases. So at that point of time only we will get some doubts. Initially decreased, which means transfer to P&L. So and next year increased, you need to adjust that decreased amount. Whatever charge to P&L, you need to adjust that. In first case also same. That's it. Clear, everyone? So I think everyone good at this revaluation concept. So this revaluation concept will be helpful in case of a depreciation calculation also, sir. So for the example, the cost is, so I don't want to waste my time, almost 22 minutes for this topic. Okay, so cost is 10 lakhs initially. Okay, depreciation for 5 years equally, assume that life is 5 years, depreciation you need to charge for 5 years. Every year how much? 2 lakhs. After 2 years, after 2 years the value will get revalued to again 10 lakhs. After 2 years, what is the balance of asset? 10 lakhs minus 4 lakhs we need to reduce, so balance is 6 lakhs only. Again it was increased to 10 lakhs. Are you getting my point? So, and after that you need to charge depreciation on this 10 lakhs only, not on this 6 lakhs. Okay. Sometimes life may be revised. Don't confuse at that point of time. Okay, now. So, revised useful life. So, this type of a questions also may ask. Okay, now. Don't scrap value. The scrap value may be given. Please don't ignore the scrap value. So, when you are calculating depreciation, you need to consider scrap value also. Cost minus scrap by life. Cost minus scrap by life. Useful life. Correct? Yes. ఓకేనా అర్థమవుతుందా తెలుగు వాళ్ళు ప్రాబ్లం నెంబర్ 2 B Limited incurred the following transactions in respect of acquiring a plant is exchange of an old plant. So very important here, exchange of old plant with new plant, replacing. Okay, so sorry for disturbance. Next question number 2 kada, question number 1 అయిపోయిందా? We are done with question number 1. Now we are going to discuss about question number 2. Already. Okay, once again, B Limited has incurred the following transactions in respect of acquiring a plant is exchange of an old plant. Simply, B Limited wants to acquire a new plant and machinery through exchange of an old plant. Okay, B Limited have one plant, is old. They want new plant. They're replacing simply. Next, the old site was dismantled at a cost of 8,000. So first of all, they have to dismantle the old site, right? So for that, the cost is 8,000. No estimated dismantling cost was capitalized for the old plant. So generally, in case of a calculation of cost of a PPE of old, nothing but old PPE, old plant. Okay, when calculating cost of a old site, generally when we are calculating cost of a PPE, okay, we should consider dismantling cost also. The two present value, right? Present value of dismantling cost should be capitalized. Nothing but added to the value of asset. కరెక్టా? ఎస్. అయితే ఇక్కడ ఏమవుతుందంట, ఓల్డ్ సైట్ డిస్మాంటిల్ అవుతుందంట. సో ఓల్డ్ సైట్ వాస్ డిస్మాంటిల్ at a cost of 8,000, but no estimated dismantling cost was capitalized for the old plant till now. Okay, there is no dismantling cost added to the value of asset. It's a mistake or not? Yes. Okay, they are incurring a dismantling cost of rupees 8,000 at a cost of rupees 8,000. This was not capitalized, means not added to the value of asset. Correct or not? Not added to the value of asset. So what should we do? No, that is the question. So previously it was not capitalized to the old plant. So now you have to capitalize. Now you have to capitalize. Your pay dismantling cost is incurring 8,000. So 8,000 should be, you're paying cash 8,000. How only? What should be debited, sir? Simply PP, old PP, the old plant or old site. Okay, old plant means whatever maybe. you should be debited, that old site account should be debited because the asset value should be increased. Correct or not? Simple, sir. Present value of dismantling cost should be added to the value of asset only. But it was not made till now. You have to do. Entry will be old plant account, the old site account debit to cash or the initial years. Suppose example, when we are purchasing this old plant, at that time, what's entry? Old plant to liability for dismantling cost. That is the entry at that time. But we have not written that entry. So that's why you have to write this entry right now. Because it was dismantling. Okay, now because it was dismantling. Now what's the entry? Old site account to cash or bank 8,000. Clear? Next, scrap from the old site sold at 1,000 rupees. Now you are selling at scrap. So you will get cash or bank account debit to old plant or old site 1,000 rupees. That's the two entries for this first point. If you forget this, everything will be wrong. So please don't ignore. Everyone understand point number one. Correct? Yes or no? Yes. Next, the new site was constructed at a cost of 48,000. Now, they have constructed new site at a rupees 48,000. Okay, very good. The supplier of the new plant agreed to take away the old plant at a fair value of 1,26,000. So, actually, I am B limited. Okay, I want to acquire new plant from some supplier. We don't know the name of supplier. Okay, the point is saying that the supplier of the new plant agreed to take over the old plant at a fair value 1,26,000. So supplier accepting old plant of B limited, right? B limited old plant accepted by supplier. At what cost, sir? Means cost, what cost? In the cost of 1,26,000. We don't know. We will calculate old plant cost. Okay. Before that, they're acquiring at 1,26,000. They're accepting at a 1,26,000. Who is accepting at 1,26,000? Supplier accepting at a 1,26,000. Okay. It is a benefit or not? Benefit or loss to the entity. How to recognize that? So, see, next point, the new plant price is still at 20. The carrying amount of the old plant is 1 lakh. Carrying amount of the old plant is the old plant and machinery carrying amount and the book value. Book value how much? 1 lakh. But they're accepting it 1,26,000. Correct? 1,00,000. Is that clear? Before that, you should make some adjustments regarding old plant and machine, old site. Because see here, old site dismantling at a cost of 8,000 and the scrap sales 1,000 rupees. Included in old plant and machinery, right? Yes or no? Because plant and machinery installing on that land only. So plus 8,000, scrap sales 1,000 rupees. How much? Like 7,000. Are you getting my point? This is the actual carrying amount for PP. Old PP. Old plant. అర్థమవుతుందా? అర్థం కాలేదు సార్. Seeing white faces. చూడమ్మా, simple. 1 lakh is the carrying amount of old PP, right? It was accepting at 1,26,000 by supplier. Generally, students may thought like this only. 1 lakh, they're accepting at 1,26,000. Okay, 1 lakh value of asset is going out, but the benefit is 1,26,000. Yes, I got benefit 26,000. B limited is a benefit to the B limited, right? Say yes or no? Yes, because I'm giving 1 lakh value, but they're accepting 1,26,000. The 26,000 is a benefit to me, gain to me, B limited. But in reality, 26,000 only, but we have to make two adjustments. Okay, we have a point number one. What is that? Dismantling cost is not adjusted till now. So now you have to adjust. How much? 8,000. You are selling a scrap sales of that old plant. 12,000 rupees. Or no? 8,000. What is this? 8,000 sir. Dismantling cost. Yes, you should calculate that. You are selling that asset. So asset will get reduced. That's a minus 1,000. Like 7,000 is the carrying out. But they are accepting at 1 lakh 26. What is the benefit here? 19,000. So 19,000 is the gain on change of old plant. This 19,000 is gain on exchange of old plant. Is that clear? This 19,000 is gain on exchange of old. Clear? Okay. Everyone clear about this? Okay. Simple. The gain on exchange of facilities old plant is 19,000. Clear? Okay. Come to question. Next, the new plant price is 3,20,000. This is the new plant price. This is new site price. Okay, we want PP, both comes under same class of asset. So that's why I want to calculate the cost of a PPE right now after considering all the points. Next, the present value of dismantling the site is that is nothing but this is new site. How much? 16,000. Wages for installation of a plant 4,000. Trial run cost 1,600. Freight 8,000. These are the costs, direct costs or indirect costs. Yes, direct costs related to installation. Next, GST at the rate of 18% on plant, on freight 18% intrastate. Loss amount to 40,000 for low capacity utilization for the plant after installation. 10,000 was paid at a cost of launching the product to be produced from the plant. Recognize the asset value and pass journal entry. Simple, sir. Here, nothing but initial operating losses. Okay. We can also say this. Okay, loss amount to 40,000 for low capacity utilization. Suppose the capacity of a machine is 10,000 units, but it was produced only 6,000 units only. Okay, after installation, the low capacity utilization, due to low capacity utilization, I got a 40,000 loss. But such loss generally it will be transferred to P&L. It will not be added to the value of asset. It should not be capitalized. Generally, it will be treated as a expense transferred to P&L. Next, 10,000 paid as cost of launching the product. Sir, this is excludes. This cost is included in cost excludes. Do you remember that? Cost includes, cost excludes. Okay, out of that cost excludes, these 2 points are included there. Are you getting my point? Please go and check first inauguration cost, cost of launching the product, and for low capacity utilization. These two losses, but these two costs should not be included in the cost of PPE. Are you getting my point? That's why these two costs should be transferred to P&L. Okay, cost generators. So simple. Then GST applies on supply of a plant, 18% freight 18%. Assume that GST accounting has not been made. Okay, now so we can also take assumption for this also. Okay, for this clear. Okay. Next, first of all, recognize the asset value. First question is recognize the asset value. Nothing but cost of a PP. Anybody? What is the cost of PP? New PP or old PP? New PP, sir. New PP nothing but new site cost how much? 48,000. New plant cost 3,26,000. Next, present value of dismantling cost 16,000. It also should be added. Next, supplier wages how much? 4,000. Yes, you can add. 1,600 trial run. Yes, for installation purpose only. You should add here this one also. Right, 8,000 add. But these two will not consider. Next, this is not included in this. This is also not. Okay. This is for old plan, not for new plan. Correct? So then what is the cost of PP? 48 plus 3 lakh 20 plus 16,000 plus 1,600 plus 4,000 plus 8,000. The total. Check. Cost of construction of new site 48,000. New plan 3 lakh 20. Present value of dismantling cost 16,000. Wages and trial run cost 4,000 plus 1,500. Next, freight 8,000. Total 3 lakh 97,600. This is the cost of a new PP. This is the cost of new PP. First of all, I should write journal entries. For the first entry, sir, adjustment to which one? Old site. Write down. First entry related to old PP, right? Right. First journal entry. For dismantling cost of old PP. What is the entry, sir? Old PP to cash. Because he was paying. Entity paying cash right now only. How much? For sale of a scrap of old PP. So entity will get cash account debit to old PP. Okay. Here. Next. Third. Very important, sir. Simple. I am B Limited. I am acquiring a new machine. What's the cost? 3,97,600. Okay, right. Machinery account debit 3,97,600. Two. What's the payment? This is the question. First, supplier agreed at 1,26,000. Yes, I got a 19,000 profit, right? Yes or no? So go and check there. How much? 19,000 profit. Yes or no? But actually the carrying amount is 1,07,000 only. Yes or no? Yes. So old PP, how much? 1 lakh or 1,07,000? Yes, sir, 1,07,000 because actual carrying amount of old PP is 1,07,000 only after making adjustments. We already discussed here, right? How we will get 1,07,000 clear? Next, machinery to old PP to P&L. What's the profit here? 19,000 profit to the BL Limited. B Limited, sorry, B Limited. 19,000 profit to B Limited. Next, when I'm purchasing, I'm paying to supplier, right? Supplier accepted at 1 lakh 26,000, right? Supplier accepted at 1 lakh 26,000. Correct? Supplier accepted at, go to question. The supplier of the new plant agreed to take away the old plant at a fair value of 1 lakh 26,000. Clear up? 1,26,000 దగ్గర తీసుకుంటున్నాడు. Actually, what is the amount we have to pay to that supplier? What's the amount? The total amount. The new plant price is 3 lakh 20. He's the only plant supplier. Supplier of the new plant is agreed to take away the old plant at a fair value of 1,26,000. New plant is 3,20,000. How much? 3,20,000 new plant value, but paying 1,26,000. How much? Like 94,000. Like 94,000. Or not? What is this 1,94,000? Anybody? The simple sir, I'm purchasing new machinery. He's taking 1,26,000. Balance 1,94,500 has to pay it by me. Correct? To whom, sir? To whom? To supplier. Like 94,000. You know? Are you getting my point? Clear? 1,94,000 calculation. 3,26,000, 20,000 minus 1,94,000. Clear? Next, two. Simple. This is the cost of PP. How much? 3,97,600. Out of that, we will not pay the 16,000 immediately. We will pay after end of a useful life of the asset. Correct? Yes, this one, this one. How much? Simple, sir. How much cash we are paying right now? Please take expenses 5,600, 8,000, 13,600. Correct? 13,600. Next, please go and check the question. How much? 1,94,000. The balance. What's the balance? Before going to that, we have a dismantling cost, right? Dismantling cost. What's the entry for dismantling cost? Machinery to చెప్పండమ్మా liability for dismantling cost 16,000. Then go to what is the balance? Please take the calci. The balance amount is paying by the 51,600. How it will come, so simply 5,600, 8,000, 13,600, 13,006. Okay, now next balance. What's the balance, sir? How much cash we are paying immediately? 8,000, 13,600 plus 48,000. 13,600 plus 48,000. How much? Given 600. Okay, very good. So this is the cash we are paying. You can write the entry also. 5,600 plus 6,000 plus 48,000. Given 600. This is the journal entry. Very, very important, sir. Please don't get any. Simple, sir. I'm acquiring a new machinery for rupees 3,97,000. I'm ignoring the GST. Okay, to old PPE, actually the cost is 1 lakh only carrying amount, but old PPE have two adjustments. One is dismantling cost, another one is scrap sales. So after adjustment of those 2 points, what the amount? 1,07,000. 19,000 is the profit. Those are simply they are accepting old plant and machinery at 1,26,000. So that's why I got a 19,000 profit. So 1,94,000 is a Amount to be paid to supplier. Amount paid by the entity is 61,600. Liability for dismantling cost is 16,000. Clear? Okay. This is question number 2. Right? Very simple. Very simple question, sir. Clear? Right? These 2 points also. Not points. These 2 shall be transferred to P&L. Okay. Ignore GST calculation. Ignore. Assume that there's no GST calculation. Okay, now. Clear? This is question number 2. Yeah, guys, so we are done with the question number 1. Now come to question number 2. Very simple question. Just a capitalization. Just a capitalization. We already done with that. What do we have to capitalize? Just wait. Yeah. Actually, this was the regular note. We will discuss each and every problem here. Yeah. Initial recognition cost calculation. Okay. So what do we need to capitalize? What do we need to charge to P&L? That's it. So plant and machinery 100 lakhs. Okay. Yes. Trade discount we need to reduce from it. Obviously, import duty, it's a non-refundable tax. Yes, we need to add that. Next, testing cost. Yes, we need to add. Consultancy fees for installation purpose. Yes, we need to add. General overheads, don't consider, ignore that. Dismantling cost. Yes, present value, we need to add that 1 lakh. If the question is given the present value separately and actual value separately, you need to take present value only. If the question is nothing said about the present value or just only given the dismantling cost, you can take that directly. Assume that it is a present value. Next, direct material cost. Yes, you can take that. See here, out of this 10 lakhs, 5 lakhs goods were spoiled and 2 lakhs is the faulty design work. Faulty design work. So both were abnormal loss. So can you consider that? No, don't consider. You have to take only out of the 10, 7 is not there. So only 3 should be added. So please remind this point. Example. Are you getting my point? So 5 is spoiled, 2 is due to faulty design work. So don't consider, we can call it as abnormal loss. So ignore that. Only balance relax only should be added. Standard, yes, you need to add that. Site preparation cost, yes, you need to add that. Architect fee, yes, you need to add that. So then, and then total. You will get the cost of a PPE to be capitalized. That's it. Clear? So same question. This is also same question. Question number 2. So an entity acquired an asset 3 years ago cost of 5 million. The depreciation method adopted for asset was the 10% reducing balance method. At the end of the year 3, the entity estimates that the remaining useful life was 80 years and determines to adopt a cycling method from that date to reflect the revised estimate pattern of recovery benefits. Calculate the depreciation charge for respective years in accordance with Ind AS 16. Okay. So this is the example question for you. Okay, now. So please do that. Actually, question number changes. Okay. Okay, guys. Actually, I have not separated the question numbers. Actually, this is separate question. This is based on change in method of depreciation. Change in method of depreciation. Simple question. The cost is 5 million. 5 million means how much? 50 lakhs. This question was not discussed in regular also, I think so. Okay. So it will be very useful. So examination point of important only. So the rate of our depreciation is 10%, reducing balance method, which means WDV method. We need to calculate depreciation on balance amount, nothing but carrying amount. At the end of the year, the entity estimates the remaining useful life is 8 years only. Okay, under SLM method. So simple calculation, come to the solution. So this is the cost of 50 million. Depreciation for year one. So 10%, right? 10% means 50 lakhs into 10%, 5 lakhs. That's the first year depreciation. Second year depreciation, you need to reduce this depreciation from this value, right? So cost minus depreciation. So 45 lakhs. So 45 lakhs into 10%, 4 lakh 50. And third year, 45 lakhs minus 4 lakh 50, you will get 40 lakh 50,000. So in 40 lakh 50,000 into 10% again, 4 lakh 5,000. These are the 3 years depreciation. Now that they're changing from WD method to SLM method. So please calculate the carrying amount on that date. Nothing but after 3 years. So 50 lakhs minus 5 lakhs minus 4 lakh 50 minus 4 lakh 5,000. You will get a 36 lakh 45,000. That is the carrying amount after 3 years. Now they want to change, move from WD to SLM method. Okay. The useful life how many years? 8 years. So simply you can calculate based on that useful life only. 36 lakh 45,000 divided by 8. Every year same depreciation. So 4 lakh 45,625 per annum. That's the depreciation for all the years, remaining years. Year 4 to year 11. 4, 5, 6, 7, 8, 9, 10, 11. Then 4, 5, 6, 7, 8, 9, 10, 11. Total 8 years. Correct? So year 4 to year 11. That's the same depreciation. That's it. So I don't want to discuss that. And this question you can solve. This is the question number 4. Sorry, question number. This is the 3. So simple. List price. Yes, 80,000. Duty unit add. Delivery fees add. Installation add. Production cost add. Maintenance cost ignore. Charge to P&L. Next we have in the question given the trade discount 10%. So first of all you need to reduce 10% on 80 lakhs. So how much? 80 lakhs minus 8 lakhs, 10%, right? So can you take the settlement discount? Nothing but cash discount. Can we consider this? No, don't consider this, ignore that. That's it. Then the balance is the cost of a PPE. That's it. I don't want to discuss that bloody question. Okay. So okay, this is the basic question you can solve. Okay, it's up to you only, basic question. I don't want to discuss that. Next, come to question number 4. Revaluation. Sorry, I think this was a solution. Okay, this is the question actually. These two entries are the solution. So see, an item of a PP was purchased for 9 lakhs. That's the question. On 1st April 2011, it was estimated a useful life of 10 years, depreciate over SLM method. Thus it is revalued to 9 lakh 60, useful life to unchanged 10 years, ignore the deferred tax, calculate depreciation, revaluation surplus. So I have discussed about the complete revaluation concept. Easily you can solve. The solution also given here. You can solve easily. Are you getting my point? So one more note point I want to discuss here. One note point you need to write down. Just wait. Yes. Please note down this note point. The revaluation surplus in respect of PPE transferred directly to retained earnings when the asset is derecognized. When the asset is derecognized, what is that, sir? Sorry. Okay, the revaluation surplus. What are the revaluation surplus we have? We need to transfer to retained earnings over the life of the asset. Over the life of the asset. Okay now. So this point will be helpful in questions also. You need to transfer from revaluation surplus to retained earnings. Okay. Clear everyone? Right. So simply this is Ind AS 16. That's the more than enough, sir. More than enough. And one more point you need to remind: overhauling expenses. Nothing but renovation expense. Sometimes renovation will do for every 4 years, 5 years. Okay, we can consider this expenses also capital expenditure only, not revenue expenditure. Don't charge it to P&L. You need to add to the value of asset. And also you need to amortize over a period of suppose example, they're incurring overall expenses for every 4 years. You need to charge depreciation for 4 years only. Suppose example, the life of the something um, suppose example, a machinery example, plant and machinery, the life is 10 years actually. Okay, the overhauling expenses example or any renovation expenses will do for every 4 years. You need to charge depreciation for this plant and machinery for 10 years, but for this overall expenditure you need to charge for 4 years only. You need to charge depreciation for 4 years only. That's the point I want to discuss here. Very special point. This point will be helpful to you when solving a problems. Okay. Actually, we have a lot of problems. We don't have a lot of time to discuss this. Ind AS 60. That's it. Clear? Yes. Come to Ind AS 23. Simple, sir. Borrowing cost. Borrowing cost means cost incurred for borrowing of a fund. Simply we can say interest. Interest is only the point we'll cover here. Okay, now stand also they are talking about most of the questions, everything they're covered with they're using only interest only. So how to account the borrowing cost? That's the main point. How to account the borrowing cost? Okay, now first of all, borrowing cost are the interest and other costs incurred by enterprise in connection with the borrowing of funds. So for example, you are borrowing funds from the bank. Okay, sometimes you need to pay processing charges or something, brokerage charges also you need to pay. Okay, so that also the cost covered under this borrowing cost. Interest and commitment charges, ancillary cost relating to borrowings, finance cost requiring a asset or finance lease. So there are different costs we will incur, right? So mainly we are talking about interest. That's it. Okay, ignore everything, and this exchange difference point is separate. This we'll discuss later actually. Okay, clear? So we are talking about interest. Clear? Simple, sir. Simple logic. Simple logic. Just wait. Ind AS 23. Correct? Ind AS 23. Okay. See, borrowing cost. Simple, sir. Simple logic. Borrowing cost. Actually, generally, interest will be charged. Interest is the expense, right? Generally, it will be charged to P&L only. P&L only. But here the stand is saying that interest should be capitalized. That interest should be capitalized. Sir, why interest should be capitalized? What's the concept behind this? Simple, sir. Simple, sir. Suppose example, you have take a loan from a bank. Take a loan from a bank 10 lakhs for the purpose of construct one building. For the purpose of constructing one building, it will take almost 2 years. Example, 10 floors building. Assume that. Clear? Now, simple. You have taken a loan from a bank of rupees 10 lakhs. You need to pay interest to the bank. Suppose example at the rate of 10%. At the rate of 10%. Clear? At the rate of 10%. Sir, you are paying interest to the bank, right? So why this interest should be capitalized means simple, sir. With that bank loan, you have to acquire or construct one qualifying asset. What is that, sir? The point, please remind this word. Qualifying asset. What do you mean by qualifying asset? We'll discuss, just wait. Okay, I assume that building is a qualifying asset. Okay, I constructed one building. Okay, now so simply I am using that bank loan for the purpose of construction of a building only, right? Then you can capitalize that interest. Whatever the interest you are paying until completion of building only, not after completion of building. Up to the completion of building only, whatever the interest you are paying, that should be capitalized. That's it. That's the stand is saying. Are you getting my point? You are clear? So come to qualifying asset. First of all, what do you mean by qualifying asset? A qualifying is an asset that necessarily takes substantial period of time for its ready and for its to get ready for its intended use or sale. To get ready for its intended use or sale. Which means I constructed one building. Okay, if it is ready, then you have to stop the capitalization. Sir, I'm not understanding, sir. Simple. So I will tell again. Qualifying asset means simply an asset that necessarily takes substantial period of time. What do you mean by substantial period of time? Generally 12 months we will talk. We will tell generally 12 months. Sometimes it may be 9 months or 10 months also, but generally 12 months it will take. Okay, that's a substantial period. Okay, suppose example of the plant, you want to go, you want to purchase one plant and machinery. That plant and machinery already ready to use. You are purchasing with that bank loan. Can we say it's a qualifying asset? No, it's not a qualifying asset. Definitely, it will take some time period to get ready for its intended use or sale. If you want to use, it must take some time. If you want to sell also, it must take some time. So we can call it as a substantial period of time. Then only we can call it as a qualifying asset. Okay, up to the completion of a qualifying asset, only the interest will be capitalized. After that, don't capitalize. Okay, now are you getting my point? So examples, manufacturing plants, power generation facilities, investment properties, construction of building, etc. So recognition for borrowing cost. Simple. Borrowing cost are the cost directly related to acquisition, construction, production of a qualifying asset that only should be capitalized. Are you getting my point? Next, qualifying asset must satisfy the recognition criteria as per Ind AS 16. Two conditions are there, right? It is probable that future economic benefit will be flowed to the entity, cost will be measured reliably. Those 2 points must satisfied by the qualifying asset. Yes. So most of the qualifying assets were construction of a building. Okay. Next, manufacturing of a plant and machinery. Are you getting my point? So these are the examples we will use generally. Next, working capital. Sometimes they will use working capital. So working capital is used for the purpose of meeting the daily operations. So this is not a capitalized qualifying asset. Advance for truck. Sometimes they will use advance for truck. You want to purchase the truck, you have given advance initially. So it is also comes under non-qualifying asset, not a qualifying asset. Only qualifying asset purpose, whatever the interest you have incurred, that only should be capitalized. Whatever the interest you have incurred for non-qualifying asset, that must be charged to P&L only. Okay, na? Interest on capitalized asset only should be capitalized. Interest on non-qualifying asset should not be capitalized. It should be charged to P&L. That's it. Okay, na? So other borrowing cost should be charged to P&L. That's it. Period of capitalization. When to start capitalization, when to suspend capitalization, when to stop. Simply, when to start capitalization means it must satisfy the 3 conditions. What is it? Expenditure on qualifying asset being incurred. You need to incur the expenditure on qualifying asset. Nothing but you have to start the operations. Okay, you want to construct one building. For that purpose, you need to purchase the raw material, etc. So borrowing cost also need to be incurred, and activities are in progress, sir. So the work is in progress. Okay, if you suppose example you stopped for your personal work, the work has been stopped for 2 months. Can we say the activities are in progress or not? No, not in progress. So it must be in progress. Then only we need to capitalize. Otherwise, charge to P&L. So activities are in progress means physical construction must be there, or technical and administrative work prior to commencement of physical construction. Sometimes for construction of a building we need to take approval. We need to take approval from the authorities, local authorities, etc. Okay, so that time I'll cover the example. Simple. Okay, I have taken a loan from 1/10/2023. Okay, I have started. I want to take approval for the purpose of a building. Okay, I have started on this day only, but I have started real construction, physical construction on 1/12/2023. That means after 2 months I have started the building construction. For these 2 months, approval take time. Approval time is 2 months. So from which date I should capitalize the interest? This date or this date? Anybody? This date or this date means this date only. This date only, not this date, because this is also the part of the work. Because without approval we can't construct, right? So that's the MCQ purpose point. Suspension of capitalization. Sometimes active development is interrupted. Suppose example workers strikes. Okay, lockouts. So because of that the work may be delayed. So interruption may come. So no active development or active development is interrupted. So then you need to suspend it. Suspend means stop for the time being. After when the work is going, when the work is started, then you can capitalize. Up to that point, don't capitalize. You need to charge it to P&L. So except technical work is carried out or such temporary work is delayed for an asset ready. Sometimes the delay is also necessary. If it is necessary, then don't then you can capitalize. This exception point means what's the meaning of it? You can capitalize in these cases also. If any technical work is carried out during that period, okay, you can capitalize. If the such temporary delay is necessary for the asset ready, yes, you can capitalize. Don't stop. Don't stop loading. So don't stop dancing. Phone call loading. Okay, now clear? Okay, next. Cessation means stop. You need to stop the calculation. When you need to stop? Simple. When the asset is ready for use. When the asset is ready for use, you need to stop. Okay, now suppose example we have you want to start you started 3-floor building, 1 floor completed. Okay, can you stop the calculation for this 1 floor? Yes, you have to stop. When if you can use without the completion of the these 2 floors, you can stop the calculation. You have to stop the calculation. You cannot use without the completion of all the floors. Don't stop. You can capitalize. Don't stop calculation. You can continue the calculation. Are you getting my point? Part of the work completed, sir. Out of the 3 floors, 1 floor completed. Independent of the completion of irrespective of the completion of these 2 floors, you can use this. If you can use this first floor, then you have to stop this calculation for this 1 floor. You can continue for these 2 floors. Without completion of these 2 floors, you cannot use this first floor. Then don't stop calculation. You can continue the calculation until completion of these 3 floors. That's it. I don't want to waste my time actually. So types of borrowings, we have 2 types of borrowings: specific borrowings and next one, general borrowings. Specific borrowings means borrowings taken for particular purpose, specific purpose. Suppose example, I want to construct one particular building for the purpose of poor people, something, whatever may be the government project or whatever may be. Okay, I have taken I borrow funds for the specific purpose. Okay, for particular qualifying asset only, not any other asset, only qualifying asset. It must be qualifying asset. Then you need to capitalize. Suppose example, I have taken a loan, special loan, 10 lakhs at the rate of 10%. Under specific borrowings, you can directly identify the borrowing cost. What is the borrowing cost here? 10 lakhs into 10%. 1 lakh. This 1 lakh is the borrowing cost. This is the meaning of directly identified. Readily identified. See here, the borrowing cost that directly relate to the qualifying asset can be readily identified. Yes, I can identify directly, readily. Clearly identified. Correct or not? So, suppose example, I have taken a loan, 10 lakhs. Okay. I want to use for the purpose of construction of a building only. Actually, I want to, for 6 months, I want 5 lakhs only. Balance 5 lakhs, I want to invest some other place or some other stocks. I need to earn some income on that. Okay, if you earn any income on that particular borrowings, that you must be reduced from the actual borrowing cost. See, suppose example, 10 lakhs is the borrowings, 10% is the borrowing cost. How much? 1 lakh. This is the actual borrowing cost you need to calculate. But out of that, I invested 5 lakhs in some other Reliance shares. I got 50,000 return. How much? 50,000 return. So, income on temporary investment, how much? 50,000. Reduce that 50,000. Only 50,000 should be capitalized. MCQ purpose important. Only what is that, sir? 50,000 should be capitalized. Income on temporary investment must be reduced from the actual borrowing cost. That's it. Next, come to general borrowings. I don't want to repeat everything. So we don't have a lot of time. So that's why if you want to listen, you can listen again. That's it. Okay, now general borrowings. So general borrowings means simply not for the specific purpose simply. So in that case, we need to calculate the capitalization rate. What is that, sir? First one, you need to calculate the capitalization rate. How to get the capitalization rate? Simply average borrowing cost divided by average borrowings into 100. Average borrowing cost divided by average borrowings into 100. Again, I am repeating, average borrowing cost divided by average borrowings during the year. How to calculate average borrowings and average borrowing cost? Average borrowing cost means easily we can identify based on the time. Okay, now so we will discuss one problem. You will get to know the every point. So average outstanding borrowing, simply amount of borrowings in the number of months outstanding divided by 12. Suppose example 1/4/2021 have taken a loan. Okay, now taken a loan of rupees 10 lakhs. Next 1/9/2021 5 lakhs. How to calculate the average borrowings? So how to calculate that, sir? So first amount is 10 lakhs, right? So 10 lakhs into 12 months. So 12 by 12 plus second amount I have taken on 1/9/2021. How many months? 4, 5, 6, 7, 8. 4, 5 months done. Nothing but 7 months remaining. 5 lakhs into 7 by 12. Total 10 lakhs plus 5 lakhs into 7 by 12. How much? Just wait, calculator. I am taking the calculator. How much, sir? 5 lakhs into 7 by 12. So I want to change this 5 lakhs to 6 lakhs. Actually, for easy calculation purpose, 6 lakhs into 7 by 12, 3.5. So 10 lakhs into 12 by 12, 10 lakhs plus 3.5. Total 13.5. That is the average borrowings. This is the calculation. Okay, now average borrowing is equal to 10 lakhs into 12 by 12 plus 6 lakhs into 7 by 12. Nothing but 10 lakhs plus 3.5. Total 13.5 lakhs. This is the average borrowings calculation. Clear? So ultimately we want whatever the interest to be capitalized. This is the point we want, sir. What is the interest to be capitalized? Nothing but what is the interest amount to be added to the value of asset. Okay, now so how much interest? How do we know that? How do we know that? Simply, what is the formula? Expenditure incurred on asset into calculation rate. This is actual formula you need to remember. First of all, whatever the interest need to be capitalized, that equal to expenditure incurred on the asset into calculation rate. For general borrowings, I am talking about general borrowings. Expenditure incurred on the asset. This is very important, sir. Very important. Sir, I have taken loan from a bank is 10 lakhs, but I am incurring out of the 10 lakhs, 7 lakhs only I am incurring the expense. I incur the expense, expenditure incurred on the asset is only 7 lakhs. So you need to calculate the interest on 7 lakhs only, not on 10 lakhs. You have to remind this. You don't forget this point. Okay, now. Okay, now are you getting my point? So for example, I incur the expense in phases. Not all the expense I will incur at a one day. Correct or not? In one day I cannot incur all the expense. I will incur day by day or month by month. I will incur the expenses. So for that purpose, you need to calculate the accumulated average expenditure. What is the meaning of it? Expenditure incurred on the asset means accumulated average expenditure you need to find out. Calculation, I already know that. We already know the calculation rate. You need to find out the accumulated average expenditure. For this purpose, one date must be reminded. What is that? Construction completion date. This date is very, very important for calculation of accumulated average expenditure, because you will incur because when the asset is got completed, don't capitalize. Correct or not? Up to that construction completion date only you need to capitalize the interest. After that, don't capitalize, sir. So you have to find out up to completion date only. You have to find out the accumulated average expenditure up to construction completion date only. If you come to a question, you will get to understand that point. So directly I will come to question number 2. You will understand everything. Excellent to begin construction on 1st January 2001. Okay, he obtained special loan 1 lakh for the construction of the building. Interest rate 10%, which means special borrowing cost how much? 1 lakh into 10%, 10,000. This is the special borrowing cost. It should be added. Okay, nice. Next, to non-specific loans, nothing but general loans. So 5 lakhs 11%, 9 lakhs 13%. So assume that everything on 1st January 2001 only. So first of all, you can calculate the calculation rate. How much? 5 lakhs into 11%, 9 lakhs into 13%. See the calculation right here. 5 lakhs into 11%, 9 lakhs into 13%, total 1,72,000. The total borrowings 14 lakhs. So calculation rate equal to average borrowings 1,72,000 divided by average borrowing cost 1,72,000 divided by average borrowings 14 lakhs into 100, 12.285%. Correct? This is the calculation. Actually, in this question, both the borrowings on same date only. Sometimes both the borrowings may be on different dates, so you don't confuse about this point. This is our example 141 only. This is maybe 191. So then the average borrowings may be different. This is also will get changed. Correct or not? Average borrowings also may change and interest also may change. Based on that only you need to calculate the average, calculation rate. Next, calculate we want accumulated expenses rate. So in this question, he incurred expenditure on different months. January 2001, which means assume that it is on 1st January only. Assume that it is on 1st January only. April 1st April, July 1st July, December 1st December. Sorry. So January to you need to consider building completion date is very important in this case. For calculating accumulated expenses, building construction date is very important, but not for borrowings calculation, but not for average borrowings calculation. Only for expenditure purpose, this completion date is very, very important. January to December, how many months? 12 months. So 2 lakhs into 12 by 12. April to February, December, how many months? April 1st means 9 months. 9 by 12. July means 6 months. 6 by 12. December means 1 month. 1 by 12. Correct or not? Yes. You got this answer. This is the total expenditure you have incurred. How much? Total expenditure how much? 6,22,500, right? This is the total accumulated expenditure. It includes special loan also, because special loan taken for the purpose of specific purpose. Correct or not? So obviously that 1 lakh is the special loan. It must be incurred from this 6,22,500. So what is the balance amount? 5,22,500 is only the general borrowings related expenditure. Expenditure related to general borrowings how much? 5,22,500. On this only you need to apply the calculation rate. On this we have already special interest rate. How much? 10%. Total 10,000. Total how much? See here. Special loan 10,000. 5,22,500. 12.285%. 64,189. Total 74,189 need to be calculated. This is the interest to be calculated. That's it. I think everyone have a good clarity about this right now. Correct or not? Everyone. So when you are please remind this point. When you are calculating the accumulated expenditure, you need to be set aside that particular specific borrowings, and the balance on that balance only you need to apply the calculation rate. Then you will get this calculated amount of interest. That's it. Clear? And one more point. First, construction of a building, working capital, advance for a truck, okay, installation of manufacturing of a plant. So what are the qualifying assets? What are the non-qualifying assets? Construction, obviously construction takes substantial period of time, so qualifying asset. Working capital, not a qualifying asset. Advance for truck, not a qualifying asset. Manufacturing of a plant, yes, qualifying asset. Simply it will take some substantial period of time, then we can call it as a qualifying asset. Correct? So interest on qualifying asset only you need to be capitalized. Balance should be charged to P&L. So if you see the question number 1, you will get the answer. See here, show the treatment of interest. Total interest charged by the bank for the lending is 18 lakhs. So total interest is 18 lakhs. Now, what amount of interest should be charged to P&L? What amount of interest should not be charged to P&L? How to find out that? Construction of a shed, qualifying or not qualifying? Qualifying. Purchase of machinery, not a qualifying. Working capital, not a qualifying. Advance or purchase of truck, no, not a qualifying. So please take proportionately. Total how much? 50, 40, 90, 20, 110, 120. So on the cost basis, you can apportion this interest. So 50 divided by 120 into 18. How much? 50 divided by 120 into 18. 7.5, correct? So only 7.5 lakhs, all rupees in lakhs, right? 7.5 lakhs will be capitalized. Out of the 18 lakhs, only 7.5 lakhs only should be capitalized. Balance 11.5 charge to P&L. That's it. This is the point you need to learn. This is all about Ind AS 23. Okay now. So next we are going to discuss about Ind AS 36. Clear? Everyone. So actually I want to discuss one more point regarding the Ind AS 23, that is exchange difference, right? Okay, if time permits I will discuss, don't worry. So let's go to the Ind AS 36. Okay, next standard Ind AS 36, impairment of assets. Correct? Impairment of assets. Clear? So come to point. So first of all, what is impairment? Simply decline. Correct or not? Yes. So actually in this standard we are going to discuss about the point impairment loss. What is impairment loss? Okay. So this is our material, right? See here. Simple, sir. Okay. So simple, sir. Impairment loss. We are talking about mainly. One more point I want to say. Actually, we have a different type of asset standards. What are those? Ind AS 16, Ind AS 40, 105, and 36, and 38, and 41. Do you know about this? Ind AS 16, PPE, 40, investment properties, 105. What's that, sir? Non-current asset held for sale, 36, impairment, 38, intangible, 41, agriculture. So I think these are the asset standards actually, overall asset standards. But we have we have only 3 standards. Correct? Yes. Okay. We can also call borrowing cost also one type of asset standard only. Okay. So clear. So now I am going to discuss about 36. So first of all, what do you mean by impairment loss? Okay. I will discuss only the exact important points for examination. That's it. I don't want to discuss all the stuff. Okay. Clear. So what do you mean by impairment loss? Simply, impairment loss means if the carrying amount of an asset is more than the recoverable amount of asset, then the difference is known as impairment loss. Simply. Suppose example, carrying amount of asset is 10 lakhs. Recoverable amount is 8 lakhs. The difference 2 lakhs is known as impairment loss. Suppose the carrying amount 10 lakhs. Recoverable amount 12 lakhs. The difference amount 2 lakhs. We can call it as the impairment gain. Correct or not? No. We are talking about only loss. Because we have one concept is there, that is prudence concept in our accounting. Okay, estimated losses should be recognized immediately, but not profits. Impairment loss is a loss. Okay, you can recognize, no issue, but impairment gain, don't recognize that. We are not talking about this bloody point. We are talking about only impairment loss. Can you please repeat? If the carrying amount of the asset is more than the recoverable amount, then the difference is known as impairment loss. So what do you mean by carrying amount? Carrying amount means cost minus depreciation. Cost minus depreciation, we will get a carrying amount. If you remember in Ind AS 16, I reduced impairment loss minus, if you remember, cost minus depreciation minus impairment loss, then I will get a carrying amount. If you remember, we have seen there, correct or not? So Why this impairment loss also we are reducing? Means simple sir, impairment loss, because of that impairment loss asset value will get decreased. So that's why we need to reduce from it. Okay, now for the purpose of impairment loss calculation, carrying amount means cost minus depreciation. Are you getting my point? Simple sir. Cost 10 lakhs, depreciation 1 lakh. Calculate next recoverable amount 7 lakhs. Please calculate impairment loss. How to calculate impairment loss? How do we get this? Carrying amount minus recoverable amount. We have recoverable amount how much? 7 lakhs. Carrying amount how much? 10 lakhs minus 1 lakhs, 9 lakhs. Balance 2 lakhs. This 2 lakhs is known as impairment loss. The revised actual net carrying amount of asset how much right now? Cost 10 lakhs, nice, very nice. Depreciation 1 lakh minus impairment loss. These 2 lakhs also we need to be reduced. We will get a 7 lakhs. This is the actual carrying amount right now. After considering impairment loss, what is the carrying amount? 7 lakhs. Nothing but recoverable amount is nothing but when the impairment loss concept arises. Okay, obviously the recoverable amount will be the revised carrying amount of asset. Correct or not? Yes, obviously. Are you getting my point? So this is the revised carrying amount after considering impairment loss. Are you getting my point, everyone? Clear? So what do you mean by recoverable amount? How to calculate that recoverable amount? Anybody? Recoverable amount, whichever is higher. What is that? Fair value less cost to sell and value in use, whichever is higher. Fair value is given in the question. Minus cost to sell. For selling that some cost may be incurred. Okay, that should be reduced. The selling cost that should be reduced from the fair value. Then we will get some value. Value in use. Value in use means a present value of future cash flows. Value in use means a present value of future cash flows. The question given, the suppose example, year 1, 2, 3, 4. Cash flows 1 lakh, 1.5 lakh, 2 lakh, 4 lakh. So like this cash flows will be given. You need to bring it into the present value by using a present value factor. Example 10%. Assume that at the rate of 10%, you need to bring all the cash flows at a present value. At that point of time, what is the value we are getting? That is known as value in use. Value in use, whichever is higher, that should be the recoverable amount. Clear? So ultimately, for calculation of impairment loss, just wait. Impairment loss equal to carrying amount minus recoverable amount. Recoverable amount means fair value less cost to sell or value in use, whichever is higher. Value in use means present value of future cash flows. This value will be given. This is also given. Or we can also call it combinedly as net realizable value. They may use this wording also. So you can find out the carrying amount. Then we will get impairment loss. Okay, now clear? Next, cost example. One more example. Okay, cost 10 lakhs. Depreciation. Sorry, cost 100 lakhs. 10%. Suppose example depreciation life 10 years. Example. Assume that life. Life 10 years. Clear? So come to year 1. Cost 100 lakhs. Depreciation how much? 10 lakhs. Total 90 lakhs. Correct? This is the carrying amount. In first year, recoverable amount. We have to estimate the recoverable amount, right? Assume that recoverable amount is 100 lakhs. Is there an impairment loss here? Is there an impairment loss? No, there is no impairment loss because the carrying amount is less than the recoverable amount. No impairment loss. Second year, for next year carrying amount how much? 90 lakhs. Depreciation. Again, suppose example 10 lakhs. Assume that not a WDA method, we are following SLM method. How much? 80 lakhs. This is the carrying amount, net carrying amount. On this date, the recoverable amount is 70 lakhs. The recoverable amount is 70 lakhs. Is there an impairment loss here? Yes, carrying amount is more than the recoverable amount because the recovering is less than the carrying value. At least carrying value also not met by the recoverable amount, right? So that's the difference is known as impairment loss 1. How much? 10 lakhs. Impairment loss 10 lakhs. For third year, this is year 2. For third year, what is the carrying amount right now? For third year. For second year ending, what is the net carrying amount? Can we take 80 lakhs or 70 lakhs? 70 or 80? 70 lakhs. That's it. That is the point, sir. We need to take the recoverable amount, or you can minus the impairment loss from the net carrying amount. 80 minus 10, how much? 70 only we will get. I already discussed about this point. So based on that, calculate the depreciation. Assume that it is also 10 lakhs, no issue. Okay, now this is the way of what is that, sir? Calculating impairment loss. That's it. This is the best example to cover all the things. Clear? So we know about the carrying amount. Cash generating unit. So this is the point we need to discuss. A small discussion about this. So CGU means is the smallest identifiable group of assets. Smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from the other assets or group of assets. What is the meaning of a cash generating unit? What is the meaning of a cash generating unit? Simple, sir. Suppose example, okay, we have a classroom. In that classroom, suppose example we have to take a lease one building. It contains a total 3 floors. Assume that. How many floors? 1, 2, 3. Assume that 3 floors. Okay, now I am paying rent of rupees 10 lakhs. Paying rent, lease rent. How much? 10 lakhs I am paying. Clear? Okay, so we have a total 3 batches. Assume that CMA final, CMA inter, CMA foundation. We have 3 batches. Okay, so we are getting an income overall, right? Overall or floor wise. We can call it as a one CGU. If we can separate the income or cash flows, whatever the cash flows we are getting, we can separately, suppose example, the cash flows getting from the CMA final is independent of the remaining 2, then we can say it's one cash generating unit. If the inter-level also can generate the cash inflows independent of the remaining 2, yes, it is also one cash generating unit. If the foundation level also, first floor also generating the cash inflows independent of the other 2 assets, other 2 floors, yes, we can also call it as one cash generating unit. We cannot say separately. We can say only combinedly only, nothing but building wise. Yes, building is one CGU. Are you getting my point? So we need to go minute level. If we can generate the cash flows independently, if the particular asset can generate cash flows independently, we can call it as one CGU, cash generating unit. So if you take one classroom, we have a laptop, we have a projector, we have a camera, and we have a furniture, AC, all are there. So for example, AC can generate the cash flows independently of other assets. Yes, AC also one CGU because it is also generating cash flows. But if I come to practical, it will not generate independent cash flows, right? So that's why we cannot say those all are CGUs separately, not separate CGUs. We can call it as the overall one CGU. In that CGU, we may have different assets. In this CGU, we may have different assets. Correct or not? Are you getting my point? That is the meaning of it, sir. That is the meaning of it. If you want, you can read this again. You will get a clarity. Is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash flows from other assets or group of assets. That is nothing but CGU. Next, what is corporate assets? Suppose example, I have two institutes. Okay, I have institute. One is Hyderabad. Sorry, one is Amirpet and the second one is SR Nagar. But we have one common head office at Panjagutta. Common head office. This is a corporate office. It will not generate any cash flows, but it will deal with all the administrative or accounting issues, everything related to both the institutes. Okay, so is this corporate asset will generate the cash flows or not? No, it will not generate any cash flows. Are you getting my point? So see here, corporate assets other than goodwill that contribute to the future cash flows are both the CGU and review and other cash generating units. Just it will contribute. These corporate assets only will contribute to the future cash flows of the both CGUs under review and other cash generating units. Are you getting my point? So come to here once again. Just wait. You see here, yeah, requirement of a CGU. See, you will get a good clarity right now. Okay. See, we already done with the definition of CGU. Come to requirement of CGU. It is not possible to estimate recoverable amount of an individual asset. An entity is required to determine recoverable amount of the CGU to which the asset belongs. Sir, can we find out the recoverable amount of, suppose example, fan or a furniture, table? Okay, is it possible? Can we generate one particular square feet recoverable amount? Is it possible? Suppose example, one floor, one room recoverable amount I want. Can it is possible? If possible, okay. If it is not possible, it is not. See, the point is why CG is required. Why CG is required? That's the point I am going to discuss. It is not possible to estimate the recoverable amount of individual asset. Yeah, we have a lot of individual assets in our building. So, but it's not possible to find out the recoverable amount because ultimately we want to find out the impairment loss. For that, we need a recoverable amount. Without knowing recoverable amount, how can we find out that impairment loss? Yes, it's not possible. So, an entity is required to determine the recoverable amount of a CGU. At that point of time, we need to consider the CGU to which the asset belongs. Suppose example, the asset belongs to plant building category. Okay, in that building we have different types of assets. That assets belongs to building right now. So we can call that building as one CGU. Are you getting my point? See, goodwill and corporate assets cannot generate independent cash flows. Please remind this point. Please note this point. Goodwill and corporate assets cannot generate independent cash flows. Goodwill acquired in a business combination. See, one more point. Since goodwill and corporate assets contribute assets in generating cash flows, because of the goodwill, because of the corporate assets, it will only contribute other assets. It will contribute to other assets in generating cash flows, but it does not generate any independent cash flows. That's the point I want to say. Goodwill and corporate assets does not cannot generate failure. We cannot generate independent cash flows, but it can contribute to other assets in generating cash flows. Is it possible? Yes. Goodwill and corporate assets can contribute other assets. It can contribute other assets. So impairment loss of a goodwill and Impairment loss of a goodwill and corporate assets will be done in CGU only. Because we cannot find out any value, right? It does not generate any independent cash flow. So that's why we need to include in CGU. We need to include in CGU only. Otherwise, we cannot find out, sir. Are you getting my point? If we discuss one problem, you will get a full clarity about it. Because we cannot find out a recoverable amount of a goodwill, recoverable amount of a corporate asset, is it possible or not? No, not possible. So that's why we need to include in CGU only. Will be done in CGU only. Cash generating unit. See, allocation of goodwill and corporate assets to multiple CGUs for impairment testing. Allocation of goodwill and corporate assets. We need to allocate the impairment loss related to. Okay, so goodwill and corporate assets. See, goodwill and corporate assets are allocated to multiple CGUs on the basis of ratios given. We need to allocate to, what is it, sir? Multiple CGUs. Also possible. If the ratio is given in the question, okay, please allocate in this ratio. If the question saying, okay, you need to do like that. If the question asks to allocate on pro rata basis, then allocate to multiple, what is it, sir? Multiple cells. CGU, sorry. Okay, so carrying amount of other asset in CGU into useful life of the CGU. This is a special point. Actually, we have a separate question on this. So that's why I have taken this example. This note point actually. Okay, simple, sir. Goodwill and corporate assets cannot generate independent cash flows, but they contribute to other assets in generating cash flows. So that's why we need to allocate suppose example, if the ratio is given specifically, you need to allocate in the specific rate only. Specific ratio only. Clear? See, example, calculation of a carrying amount of CGU. How to find out the carrying amount of a CGU? CGU means it includes a number of assets. See example, carrying amount of a PPE in CGU, carrying amount of intangible asset in CGU, carrying amount of a goodwill allocated to CGU, carrying amount of a corporate asset allocated to CGU. Then you will get a total carrying amount. Are you getting my point? So CGU may include different assets. It includes the corporate assets and goodwill also. Because for the purpose of a calculation of impairment loss, we cannot calculate the impairment loss separately for goodwill and corporate assets. So that's why we need to include in CGU only. Okay, here PPE also there, here intangible asset also there. So take the total carrying amount. And also we have a recoverable amount they will give, or you have to find out. Then you can calculate the impairment loss. See, once you calculate the impairment loss, what we need to do? First point. Firstly, by goodwill up to carrying amount of the goodwill. Remaining impairment loss of a CGU on pro rata basis. So suppose example. Okay. Impairment loss. Suppose example 10 lakhs. Goodwill carrying amount 2 lakhs. Goodwill carrying amount 2 lakhs. Asset A, asset B, asset C. We have different 3 assets are there. The point is saying that this impairment loss should be allocated to all the assets because it is also included in the CGU, right? So we need to allocate the impairment loss. First of all, you should adjust out of this 10 lakhs. You need to give the first initial, your priority should be to the goodwill only. Goodwill 2 lakhs. So up to the carrying amount of the goodwill, you need to adjust that. You need to give that. You need to allocate that impairment loss to goodwill. Because of that impairment loss, the goodwill value will get reduced. Correct or not? It will become 0. Next asset is suppose example 3 lakhs, 3 lakhs, 2 lakhs, 1 lakh. Suppose example 3:2:1 ratio, I have apportioned it. Then you can calculate the total net carrying amount. We need to minus this impairment loss. That's it. That's the point I want to say. Are you getting my point? Firstly, you need to adjust the goodwill only. First by goodwill up to the carrying amount of a goodwill and remaining of a impairment loss of CGU to pro rata basis. Carrying amount ratio of assets. What the pro rata means? So we have a carrying amount of assets, right? Based on that ratio, you need to allocate. That's it. That's it. Clear? So we have one example on allocating corporate assets too. So one more point. So I am talking about no corporate assets. Example is there. So CGU A, B. In the CGU two assets we have A and B. A carrying amount 20, B carrying amount 30. A recoverable amount 18, B recoverable amount 38. So this is the question. Corporate asset carrying amount is 10. Corporate asset carrying amount is 10. Okay. Okay. See, now come to CGU. Carrying amount how much, sir? 20, 30. 20, 30 is there an impairment loss here? The carrying amount is more than the recoverable amount. How much impairment loss? How much, sir? How much, sir? Generally 2, huh? Okay. Here, carrying amount is less than the recoverable amount, there is no impairment loss, general case. But we have a corporate asset also there. We need to consider this all or not? We need to consider this or not? Yes, we need to consider that. Because we have a carrying amount of a corporate asset, it does not generate any cash inflow separately, but we need to calculate impairment loss by considering the corporate asset value also, because it helps to generate cash flows, right? So now we need to allocate the carrying amount of the corporate asset. In which ratio? In which ratio, sir? Carrying amount ratio 2:3. So 10 into 10 is the value, right? 10 into 2 by 5, 10 into 3 by 5. Total carrying amount how much? 24 and 36. Are you getting my point? Don't calculate if the carrying amount, if the corporate asset carrying amount is not there, then you can calculate the impairment loss directly. But we have corporate asset carrying amount, so we need to consider that. So I included in CGU only. Yes, as per the point what I have said previously, based on the time followed. That's it. So yes, I am included in carrying amount of a CGU. So total 24, 36. Recoverable amount is 1838. 1838. So the net impairment loss is 6. Here there is no impairment loss. Total impairment loss how much? Now what we need to do? We need to allocate this impairment loss to all the assets. We have a corporate assets and other assets also. For corporate assets, what's the value? Carrying amount 4 is allocated to A, 6 is to B. But we have impairment loss on only A only. Only for A asset only have a impairment loss, not for B asset, right? So ignore that B asset. So total value, carrying amount 24, total 24, right? So what is impairment loss? 6, right? We need to allocate that. 6 into 4 by 24, 6 into 20 by 24. 20 is for other assets, 4 is for corporate assets. Just apportion that. 4 by 24, 20 by 24. 4 by 24 into 6, 20 by 24 into 6. 105. This is the allocation. This is the allocation. Allocate. We need to allocate that. First of all, we need to find out the impairment loss, and then we need to allocate. That's it. I think I have a good clarity about this concept, everyone. Clear? So this example is very important. Allocation, CGU. So we know about the depreciation, impairment loss, recoverable amount, useful life, value in use, everything we know that. Next. Sir, why? When we need to estimate the recoverable amount? That's the second question. In which time we need to estimate that recoverable amount? Means if you have any impairment condition, if you got any doubt about it, then only we can go with that impairment testing. If there is any indications, then we need to go for impairment testing. So irrespective of whether there is an indication of impairment, it is required to test the following for impairment at least annually. What are these? MCQ purpose important. Please remind this, everyone. For these three, there is no impairment condition required, irrespective of whether there is any indication for impairment or not. No issue. You need to test for it every year. Test it every year. What is that? Intangible asset with indefinite useful life, not definite useful life. Indefinite useful life. Intangible asset not available for use, not yet available for use. Goodwill acquired in a business combination for impairment annually. These three must you need to test. Impairment test. Okay now. Clear? So there may be different reasons when we need to impair. We have some conditions actually. External conditions, internal conditions also we have. Okay, so not required to discuss those points actually. So general indications are there. If asset market value has declined significantly, drastically changed, market rates increases drastically. So these are the some few points we need to revalue, right? We need to test that impairment. Clear? Everyone? Everyone? Next topic is reversal of impairment loss. Very important. Reversal of impairment loss. If impairment loss recognized on asset in earlier years can be reversed if on the date of reversal its carrying amount must be less than recoverable amount. Are you getting my point? If the impairment loss recognized on asset in earlier years can be reversed. Suppose example, in last year the carrying amount is 1 lakh, recoverable amount is 80,000, 20,000 is impairment loss. In next year, okay, the carrying amount will become how much? How much, sir? 9 lakhs, sir? 9 lakhs. Suppose example 10 lakhs. I will take an example. Don't get confused, sir. Carrying amount of 10 lakhs. Carrying amount 10 lakhs. Impairment loss 1 lakh. Carrying amount is less than. Carrying amount is more than recoverable amount. So recoverable amount is less than actual carrying amount, right? So impairment loss. For next year, carrying amount is 9 lakhs only. Suppose example here the recoverable amount is 12 lakhs. Recoverable amount is 12 lakhs. How much? 3 lakhs. So now we need to consider the one point. If we have any impairment loss previously, we need to reverse it in next year. If we have provided the carrying amount must be less than recoverable amount. Must be less than recoverable amount. That's it. If the carrying amount of amount is less than the recoverable amount, sorry. So carrying amount should be more than recoverable amount, right? Generally, carrying amount is more than recoverable amount, then only the difference is known as impairment loss. Correct? Then only we can say impairment loss. Correct or not? Here, it must be recoverable amount must be more than carrying amount. So nothing but carrying amount is less than recoverable amount. So at that point of we can reverse it. We have some specific procedure. We need to follow that. See here. For individual asset, we can reverse. See here, calculate carrying amount of asset on the date of reversal of impairment loss. On the date of reversal of impairment loss, you need to calculate the carrying amount of the asset. First of all, you need to calculate the carrying amount of asset. Next, calculate carrying amount of which asset should be shown after reversal of impairment loss. That is, recoverable amount of asset on the date of reversal of impairment loss, carrying amount of asset on the date on which reversal of impairment loss if the asset was never impaired, whichever is lower. What is the second point? Okay, guys. So once again, come to reversal of impairment loss. Okay. So we already seen one example. We need to reverse the impairment loss, but to what extent? Not don't reverse all the total amount of impairment loss. Okay. So we have some rules given as per Ind AS 36. We need to follow that. See, once again. Calculate carrying amount of asset on the date of reversal of impairment loss. So today if you want to reverse the impairment loss, okay, so you need to calculate the carrying amount today. Next, calculate carrying amount of which asset should be shown after reversal of impairment loss. You need to find out the carrying amount. Okay, you need to find out the carrying amount of which asset should be shown after reversal of impairment loss. So how to calculate this value? How to calculate this value means simple, sir. Recoverable amount of asset on the date of reversal of impairment loss, and a carrying amount of asset on the date of which reversal of impairment loss if it were not impaired, which means so I will discuss one example, then only you will understand, otherwise you will not understand. See the example. Suppose example, in first year the carrying amount is 100, right? Next, the recoverable amount is 90. Carrying amount is 100, recoverable amount is 90. What is the impairment loss? 100. 100 is the impairment loss, correct? Yes or no? 100 is the impairment loss. Okay, what is the entry for impairment loss generally? Impairment loss to asset account. Impairment loss to asset account because it's a loss. So that should be transferred to P&L. So then what is the entry? Closing entry? P&L to impairment loss 10. Correct or not? That is the entry. So ultimately the revised carrying amount how much? Recoverable amount will be the revised carrying amount, obviously 90. So 100 minus 10 impairment loss we need to reduce. Here there is no depreciation. Assume that there is no depreciation. So overall the revised carrying amount is 90. Correct? Come to second year. Carrying amount is 90. In second year the recoverable amount is 105 because the estimation is wrong. Whatever we have estimated the carrying amount previously, it was wrong right now. Previously I estimated the value is 90 only. Now the estimation is 105. So estimation may go wrong. Obviously it's an accounting estimate, sir. Obviously it may go wrong. Here there is no impairment loss. Correct or not? Because the carrying amount is less than the recoverable amount. So recovering is more than the carrying amount, which means there is no impairment loss. But in previous year we have already impairment loss is there. Now, correct or not? In previous year there is no impairment loss. Sorry, in previous year we already recognized the impairment loss. Now the estimation is wrong. Estimation is wrong. Yes, obviously. So actually I expected. So I will loss may come. Impairment loss may come. Okay. So that's why I recognize the 10 rupees in previous year. But current year there is no impairment loss. My expectation is wrong. So whatever the loss we have recognized previously, what we need to do? We need to reverse that. That's a simple logic. So now reverse the impairment loss. How much? How much, sir? So come here. So on the date of reversal, step number 1. Come to step number 1. What is step number 1? Carrying amount on the date of reversal. On the date of reversal, here what is the carrying amount? 90. Yes, 90 is the carrying amount. Not this 90. Okay, this is 90. Okay, now next, second one. Carrying amount after reversal of impairment loss. What is the second step? Carrying amount after reversal of impairment loss. For that we need to calculate. See, what are the steps? Carrying amount after reversal of impairment loss. First one. Recoverable amount on the date of reversal. First of all, we need to take recoverable amount on the date of reversal. Yes, in second year, what is the recoverable amount? 105. Second one. Carrying amount of asset if it does not impaired. Which means if there is no impairment loss, then what is the carrying amount right now? Previously, actually, first year the cost is 100. Because of the impairment loss, the net carrying amount becomes 90. Okay, 90. Correct or not? So the point is saying that second point, if there is no impairment loss, then what is the carrying amount? Obviously, how much? How much there? 100 only. So because of that 10 rupees impairment loss, the value becomes 90. If there is no impairment loss, then what is the carrying amount? 100 only. Assume there is no depreciation. Sometimes students may got doubt about this. Yes, sir. Depreciation will be there obviously. But in our example, for understanding purpose, there is no depreciation. Okay. So the carrying amount should be 100 only. So whichever is lower, how much? 100. This is step number 1. So the reversal amount should be 2 minus 1. 2 minus 1. Step number 2 minus step number 1. How much? 10. You can reversal that 10 rupees. So then what is the entry? Previously asset value will get reduced because of impairment loss. What is the entry there? Impairment loss to asset account. Now asset should be debited. Asset value should be more. So asset account debit to impairment loss reversal account. Correct or not? See here. Asset account debit to impairment loss reversal account. Are you getting my point? Clear? So this impairment loss reversal account should be transferred to generally P&L. But see, what is this? Revaluation surplus. Revaluation surplus. Generally, this reversal is gain to the company, correct or not? This reversal is a gain to the company, correct or not? Yes. Previously, I recognized as a loss. Now it's a gain actually. Gain means not actually gain because we have already lost that we need to be reversed. Correct or not? That we need to be reversed. So simply you can write impairment loss to P&L. That's it. Aish. Are you getting my point? Clear? Because there is no chance of more than extra amount. We will not get extra amount more than the impairment loss amount, right? Reversal should be less than or equal to impairment loss only. So obviously impairment loss to P&L, that entry is more than enough. No need to worry. Clear? I think everyone understood all these steps for reversal of impairment loss in case of individual asset. Clear? Can you please tell me the steps? Calculate the carrying amount of the asset on the date of reversal of impairment loss. Next, step number 2. What is that? Whichever is lower. What is that? Recoverable amount on the date of reversal plus or carrying amount of the asset if there is no impairment previously. Then whichever is lower should be taken. Step number 2 minus 1, you will get reversal of impairment loss. Clear? Everyone? So, I don't want to discuss this question number 1. Yes, question number 1 is homework. I already discussed the examples. A lot of examples I have discussed. And question number 2 I will discuss. Just wait for that. And question number 3 also you need to do because you have already solution. One point I need to be explained. I need to explain one more point. Just wait for that. Impairment loss revaluation. One link is there. Impairment loss revaluation surplus. One link point is there. I will tell you. Just wait. Before going to that, I will discuss the question number 2. So, clear? Important question. Very simple question. If you have a knowledge, okay, if you have a complete clarity about a theory, then you can easily solve it. Carrying amount given, fair value cost to sell given, value in use given. By using these two values, what should we get? Recoverable amount. Correct? Whichever is higher. Okay. Next, asset C and D were revalued before. Why this point is given? Why, sir? Because for adjustment of impairment loss, right? See, the carrying amount of revaluation surplus are 40 lakhs and 30 lakhs respectively. So asset C includes 40, assets D includes 30 revaluation surplus. Asset E falls in the cash generating unit consists of goodwill and intangible assets. So asset E, nothing but this one. It includes what is that? Goodwill as well as intangible asset. Okay, clear. Next, the fair value as cost to sell of CGU is 180 lakhs and value in use is 170 lakhs. So here what amount should be taken? 170 or 180? Okay, 180. Determine impairment loss and revise the carrying amount of all assets. State the accounting. Very simple, sir. If anyone, okay, please pause the video. Just try yourself. Just try yourself. What's the question they are asking? Impairment loss. Simply comparing the carrying amount as well as recoverable amount. You will get impairment loss. Simple. Correct or not? Okay, na. See. Here we have individual assets as well as multiple assets in CGU, right? Where is multiple assets? E. In asset E includes we have two assets. What is that? Okay. Okay. See, asset A carrying amount how much? 280. Okay. Just wait. Okay. Please take a note. We will solve this problem. First of all, calculation of impairment loss. Right? Asset carrying amount, recoverable amount, then you will get impairment loss, and then you will get revised carrying amount. So take four columns: one, two, three, four, five. Five columns. Asset A, asset B, asset C, asset D. Okay. Then what is asset E? It is CGU, right? It includes number of assets. Okay. So please ignore that point. Just write. Next, what's the carrying amount of A? What is the carrying amount of A? 280. Yeah. So please. Next, please copy paste 460, 220, 180. Okay. Now, what's the recoverable amount? 300 or 250? 300. Which one is higher? 400 or 390? 400. 240 or 270? 270. 150 or 170? 170. Okay, na. So 300, 400, 270, 170. Please copy paste 300, 400, 270, 170. Correct? Yes. Now, what is the impairment loss? Here the carrying amount is less than recoverable amount. Impairment loss or not? No impairment loss. Here the carrying amount is more than recoverable amount. Yes, here impairment loss. How much? 60. Here carrying amount is less than recoverable amount. No impairment loss. Here carrying amount is more than recoverable amount. Then is the impairment loss. Clear? Are you getting my point? Next, last point is CGU. So in the given question, they have given already about CGU. What is the fair value less cost sale? 180, and the all in use is 170. Whichever is higher. How much? 180 is the recoverable amount, correct? 180 is the recoverable amount. Then what is the carrying amount? That is the main point. Anybody? What is the carrying amount of CGU? How to calculate carrying amount of CGU? I already discussed one small chart, small statement like carrying amount of asset, carrying amount of intangible asset, carrying amount of goodwill, carrying amount of allocated corporate asset. Then you will get a total carrying amount of CGU. Here in the given CGU, what are the assets? Here in the given CGU, what are the assets? Asset E falls under CGU consisting of goodwill 50, correct? Okay, take 50 plus intangible assets how much?
90 total 140. Yes, 140 plus asset E 100 total 240. Correct or not? Yes or no? It includes asset E plus intangible asset plus goodwill. Yes. What's the values? 100 MO asset E. Intangible asset how much? 90. Goodwill 50. 90 plus 50. How much? 100 plus 90 plus 50, 240. What's the recoverable amount here? 170 or 180, whichever is higher. So 180. అర్థమవుతుందా? వెరీ సింపుల్, మీరు సాల్వ్ చేసేయచ్చు ఈజీగా. Then 60 is the impairment loss. Then what is the revised carrying amount? Revised carrying amount. How much? In first case, 280 only, sir. Here, recoverable amount becomes revised carrying amount 400. Next here, 220 only. Here, 170. Clear? Here, 180. Then, when there is an impairment loss, then recoverable amount is nothing but revised carrying amount. If there is no impairment loss, then carrying amount is nothing but revised carrying amount. Assume there is no depreciation in the given case. Clear? Now the topic is nothing but now the point is here what is impairment loss in case of a CGU? Here there is no allocation. Simply directly it's an individual asset. There is no need to allocating to any asset. But in a given CGU, what is impairment loss here? 60. So this is 60 impairment loss. You have to allocate all the assets. Correct or not? Yes. Out of 60, first of all, you should allocate to which one? Out of 60, first of all, you should allocate to which one? Goodwill or asset A or intangible asset? Asset A na intangible asset or goodwill? Goodwill. What's the goodwill? How much is goodwill? 50. So now, please write down. Oh, just wait. Just wait. Simply allocation of impairment loss to all assets in CGU. Allocation of impairment loss to all assets in CGU. Okay. Just wait. Just wait. Particulars. Goodwill. Intangible asset. Third one asset E. Right. Carrying amount. What's the carrying amount of goodwill? 50. Intangible asset 90. Asset E 100. But impairment loss. How much? 60. You should allocate initially to goodwill. Yes, 50. Next step. You should allocate balance 10 in the ratio 9 is to 10, right? So 10 into 9 by 19. Again 10 into 100 by, sorry. Okay. Just wait. 100 by 19 here. 10 by 19. Correct? Or 90 by 100 or 100 by 190. So 90 by 190 or 100 by 190. So 0 cancels. So that's why simplified value. Simply balance 10 into 9 by 19. Balance 10 into 10 by 19. Just I am apportioning in the ratio of carrying amounts. How much? Please calculate. Please take the calci. How much, sir? 10 into 9 by 19, 4.74. 10 into, so 10 minus 4.74, 5.26. Correct? Yes or no? Yes. Then what's the revised carrying amounts? 50 minus 50, 0. Goodwill, there is no value. Next, 90 minus 4.74. 90 minus 4.74, 85.26. Next, 100 minus 5.26, 94.74. Revised carrying amounts. That's it. If you want, you can calculate directly in this statement also. Okay, but I explained clearly and separately, just for example, for understanding purpose. Simple. I hope everyone understands this question. Clear? First of all, I find out the impairment loss. By comparing carrying amount and recoverable amount, I got a impairment loss only in case of asset B as well as asset D and asset E. Okay. There is no need to allocate impairment loss in case of asset B and D because those are individual assets. But in case of asset E, we have a different assets, nothing but one CGU. Right. So that's why I have to allocate this impairment loss to all the assets included in the CGU. So allocated to all the assets. Clear. First of all, I should allocate to goodwill, and the balance will be allocated to remaining assets in the ratio of carrying amounts of its carrying amounts. That's it. Simple question. Okay. Okay. If you follow this format for solution, okay, it's your wish, but it looks very understanding. I think so. Correct? Yes. That's it. Next, question number 3. Very simple question. Sir, if you have a full clarity about this standard, easily you can solve all the questions, sir. I hope everyone understand this question number 2.
Yeah, guys, I want to tell the link between the revaluation surplus and impairment loss. This is one more important point. Actually, in our this question, actually we have one question also. We don't have a lot of time, so that's why I'm not discussing that question. But please go with that question. Which questions are in this 36? We have a link between these 2 points. Okay. See, so for example, cost of the asset is 10 lakhs, impairment loss 1 lakh, carrying amount is 9 lakhs. That's the first year. In second year, the asset got revalued to 12 lakhs. From 9 lakhs to 12 lakhs, how much revalued amount? 3 lakhs. Generally, when the asset is revalued, that revalued amount should be transferred to revaluation surplus account, correct or not? Yes, it should be transferred to revaluation surplus. Actually, no need to keep in 1.5 or 2 speed. Automatically, our class is in 1.5 speed only. 1.5 speed. Okay, now minimum 1.5 speed I will maintain. Okay, don't worry about it. So, now what is the entry? So, simply PP increased by 3 lakhs. So, PP account debit 3 lakhs. 2. Sir, impairment loss in previous year, how much, sir? 1 lakh. 1 lakh. So, general impairment loss entry, impairment loss to asset account or PPE account 1 lakh. Such impairment loss will be transferred to P&L. So P&L to impairment loss 1 lakh, 1 lakh. So that means already that impairment loss charge transferred to P&L of rupees 1 lakh. So the point is saying that if in case of a revaluation, if there is any impairment loss in previous year, okay, that impairment loss amount, whatever the amount we have charged to P&L in case of impairment loss, that should be adjusted initially. Generally, the increased amount directly we will transfer to revaluation surplus account 3 lakhs. But don't do like that. Whatever the amount you have already transferred regarding impairment loss to P&L, that should be previously you have debited. Now you need to credit it. That's it. Adjustment. So to P&L account 1 lakh, the balance will be transferred to revaluation surplus account. That's it. This is the link between the revaluation surplus and impairment loss. Don't forget about it. Very important. Clear? I think everyone have clarity about this point. So come to question number 3. So I don't want to discuss this question, bloody question. Same, that point only we will discuss. See, if you see the question, depreciation will be involved. Okay, so you will get a revaluation surplus and then adjustment impairment loss. Find out the impairment loss to charge the depreciation for a year. For that's it. So this is every 4 point. This question is very important. This question is very important. So easy to calculate, sir. No need to explain. I think so. Based on the knowledge we got till now, this question you can easily solve. So because the cost is given, scrap value is given, depreciation SLM basis. Easily every year depreciation how much? 2 lakh 40 by 20 how much? How much, sir? 20. 24,000. Huh? Every year 20,000. That's it. That's the depreciation. So the asset I got revalued in year 3, 1st January means, so year 1, 1st January, which means how many years? 2 years already completed. So you need to calculate depreciation for 2 years only. So 2 into 24, 48,000. So correct or not? Yes sir, no sir. Yes. So the question is asking about carrying amount on December 31st year 2, which means for 1 year depreciation. So reduce that 1 year depreciation. We got this carrying amount at the end of year 2. Correct or not? Okay now. Next, what is the question actually? Carrying amount on December 31st year 3, immediately before impairment. So before impairment. So 2,16,000, revaluation done on year 3 2,50,000, revaluation surplus 34,000. So I think this answer was not properly presented. Right? See, simple sir. You can easily answer this question. Yeah, that is only correct only, don't worry. So purchase on which year, sir? 1st January. Suppose example 2001, assume that. Q purchased a machinery how much? 2,40,000 with an estimated useful life 20 years, zero residual value. So every year depreciation. So 1/1/2011, 20 lakhs. Sorry, 28, 24 lakhs. 24 lakhs is the cost. Next, depreciation. Sorry, life and the life 20 years. There is no scrap. So depreciation equal to 24 lakhs by 20. How much? How much, sir? To 12,000. Yes. 12,000 is only the depreciation, not 24,000. Okay, correct? Yes. Because the question is asking about after 2 years. Correct? So therefore 24,000 is the depreciation. Yeah, we go wrong actually. Yes, this for 2 years. 2 years into 12,000, 24,000 we got this value. So yes, the answer is correct only, no issue. So 2,16,000 at the end of the 2 years. At that point of time, the asset got revalued to how much? 2,50,000. There is no change in useful life, so no issue. So how much revaluation surplus? 2,16,000 to 2,50,000, 34,000 is the revaluation surplus. So based on the easily you can calculate this question. Please do solve this question. Please do. Okay now. So basic questions are I don't want to discuss again and again because we already done with that. Examples, more examples, right? Next, come to Ind AS 38, intangible assets. Simple. Intangible assets means which cannot be seen and touch. Which cannot be seen and touch. Previously, as per accounting standards, accounting standard 26. Now it is Ind AS 38. Most of the topic is same as that. Okay. See. So mainly we need to know we need to find out the accounting treatment. The object of the standard is to know the accounting treatment of intangible assets. So the standard deals with the recognition, measurement and presentation of intangible assets. Recognize cheyali, measure cheyali, present cheyali. Is that clear? Clear. So definition of intangible assets is identifiable asset, non-monetary asset without physical substance. Identifiable means independently we can sell that, we can give on license, we can exchange that. If it is possible, then only we can say it's an identifiable asset. Separate. If you want, you can just go to that definition. Yes. Identifiable asset is identifiable if it is either separable that is capable of being separated or divided from the entity and sold. You can separate that and you can sell that. If it is possible, then only it become identifiable. Or you can transfer, license, rented, exchange, or either individual or integrated with the related contract. If it is possible, then only identifiable. Otherwise, we cannot say an identifiable asset. Next, non-monetary asset. Everyone knows about this monetary and non-monetary. Monetary means completely money held assets. Fixed and determinable amount of money. Example, debtors, creditors, cash. So these are the assets and liabilities, current assets and current liabilities. Definitely we have fixed money. I sold 10 lakh value of goods to the customer. So what is the amount here? 10 lakhs. Yes, fixed amount is there. So that is known as monetary item, monetary asset. Correct or not, sir? Yes, monetary item. Non-monetary means other than monetary. If the wife of the first king, if the second wife of the first king, if the second wife of the king is good, which means the first wife is bad. అంతేనా రాజుగారి రెండో వారి మంచి అంటే మొదటి వారి చెడుగానే కదా. సో సింపుల్ లాజిక్. ఓకేనా? సో నెక్స్ట్ we are done with non-monetary assets. Okay, non-monetary assets means other than monetary assets. Example, share capital, issue of investments. So the investment value may got changed. Okay, correct or not? Is it possible or not? Yes. Building, it's a non-monetary. So value does not remain constant. It remains changed. So this is known as non-monetary asset. So for example, we are talking about intangible assets, which means like goodwill, copyrights, patents. These all comes under non-monetary assets. And without physical substance, obviously it don't have a physical substance. Goodwill have a physical substance? Or copyrights, patents? Is there any physical substance? No, there is no physical substance. Yes or no? Yes. Identifiable, non-monetary, without physical substance. That's it. Clear? So sometimes MCQ purpose they may ask compact disc CD. In our childhood, we So they will give some CDs. Okay. There is no value for CD actually. There is a value for content in the CD. Correct or not? Compact disc. Correct or not? Yes. So you may got doubt. Sir, CD have physical substance, sir. How can we say that it's an intangible asset? Yes. Which should have a predominant nature, dominant position. Okay now. So even if the CD suppose example the CD value may be 5 rupees to 10 rupees only, but whatever the content involved in the CD that have a more value. Suppose example pen drive is don't have a lot of value. What are the content in that drive that have a lot of value? Can we touch that? Can we see that? No. Correct or not? Yes. So that's why we can call it as the what is that? Intangible assets. Physical. See here the compact disk in case of a computer software, legal documentation in case of a license or patent. Some students may got doubt. Sir, in case of we are taking a patent rights, everything we have some document, right? Sir, that document they have a physical substance. Why can we call it as a intangible asset? Which means that a document does not have any proper value. It's immaterial value. Correct? So we can call it as a container. The container value is usually immaterial. The container value is usually immaterial. So even though the container has physical substance, its value is commonly treated as a intangible asset only. That's it. So this is one example. You can read it. Recognition of intangible assets. Recognition of fixed assets. PPE. Same 2 points repeated here. Future economic benefit should be there and cost should be measured reliably. That's it. For calculation of a cost, most of the points are same. Purchase price minus trade discount, import duties, registration charges, non-refundable taxes. Government grants as per Ind AS, not AS. 20. Okay. Next, directly attributable cost. Is there any? You can add. Then you will get cost of intangible asset. Here also cost excludes are there. We already know about it. Abnormal loss, overhead, selling overheads, initial operating losses. So these are all not comes under the cost calculation. Ignore that. Okay now? Clear? Everyone? Yes, that's more than enough. Next, definition of some definitions actually. Amortization. So amortization means systematic allocation of the depreciable amount of intangible assets. Simply, in case of a fixed assets, we will use the word depreciation. In case of intangible assets, we will use the word, what is that? Amortization. In case of a mines, we will use the word depletion. Depletion. So please remember, just maybe MCQ purpose, they may come or not. It may come or not, we don't know. Depletion word for in case of a mines. Paris, okay. We know about monetary items. Next, research and development expenses. Before implementing any project, definitely they do some research. Before developing, they have to do some research on it. Correct or not? Yes, sir. See, that is the original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. Just they need to research. They have to make a plan and investigate that. It may be success or not, we don't know. If the research is successful, then only we will go to development purpose. Correct or not? If the research is successful, then only go to development. Otherwise, don't go for development. Correct or not? Yes. So we have one point. In case of intangible assets, if the research expenses, suppose example, research expenses 1 lakh be incurred. So what is the treatment for research expenses? It should be charged to P&L or not? Or it should be capitalized? That's the question. Yes, research expense always should be transferred to P&L only. Always charged to P&L only. Development expenses don't charge to P&L. It should be capitalized. It should be capitalized. Research expenses transferred to P&L. Development expenses, it should be capitalized. Research and development. If the question asking about research and development expenses 1 lakh, what should you do? Transfer to P&L. Simple. Transfer to P&L. So development expense should be capitalized only if it should it should satisfy 5 conditions actually. It should satisfy 5 conditions. Then only. So I think everyone knows about it. Please read that 5 points. Please remember that technical feasibility should be there. Okay. Ability to complete that intangible asset. Next, future economic benefit. Next, cost will be measured reliably. Next, intention to complete and sell that intangible asset. So once we satisfy all these conditions, then only it should be capitalized. Otherwise, don't capitalize, charge it to P&L. Okay. If the question is not saying it, the question is silent about all these 5 points, assume that all the 5 conditions are satisfied, then you should capitalize. You can capitalize that. This is a logic. Okay, now? Clear? Clear. Next, in case of amortization, come to amortization. Meaning, we already done with it. When amortization will start? Simply, when the asset is available for use. When the asset is available from the date of asset available for use, on that date you need to amortize it. Cease. Cease means stop. When you need to stop, simply asset is derecognized or asset is selling or held for sale. You need to stop the amortization. Correct or not? Yes. See the question number 1. Next, one more point. Advertisement expenses. Advertisement expenses should be charged to P&L. At any point of time, advertisement expenses should be charged to P&L only. Sorry. So I don't want to waste your time. Yeah. Actually, the point comes under here only. Internally generated intangible assets. Sorry, actually, you should get the doubt why this research and development phase expenses are intangible assets. It comes under. So that's the point. That's the doubt you should got actually. Okay. See, internally generated intangible assets. If it is self-generated or other intangibles. If it is self-generated, don't recognize as an asset because it is not identifiable. Ignore that. If it is in case of other intangibles, if it meets the recognition criteria, research expenses charged to P&L, development phase capitalized. Nothing but added to the value of asset. This is application of know-how. See, these are the 5 conditions. You can note this. Technical feasibility of to completion of intangible asset, intention to complete intangible asset or user sell it, ability to use it, future economic benefits, cost should be measured reliably. Please note that 5 points. Examples. Please note these examples also. Please, these examples may be used in the questions. Design, construction, testing of pre-production models, design tools, jigs, molds, dies involving new technology, design, construction, operation of a pilot plant. These are the points we find out in the questions actually. This comes under development expenses. Clear? Next, these are not the intangible assets. Please remember, customer list, publishing titles, brands, master LC. That's it. I don't want to discuss more and more. Next, revaluation. Revaluation same as Ind AS 16. Same follow that. Revaluation model. Yeah, this is the point. Sir, please take a snapshot. Actually, this question was came in previous. In old syllabus. We don't know this question may ask or not. So just actually it was not covered in Ind AS 38. But remember the number of years. Actually, the maximum number of amortization period is 10 years only. If you remember here, maximum number of amortization period how many years? 10 years. Please remember that point. Maximum number of years how many years, sir? 10 years only. Generally, the maximum amortization period is 10 years only. But we have different years in these cases. One is computer software 5 years, copyrights 10 years, goodwill of the firm 10 years, goodwill under amalgamation 5 years. Next, broadcasting license or trademark 10 years, root authority reverts 5 years. We need to amortize based on these years. Just to take a snapshot, please remember. Before going to exam, just remember. Okay, all 10 years only, just 5 years remember, that's it. Root authorities, renewal, root authority renewal. Next, goodwill under amalgamation, acquisition under amalgamation. Next, computer software. That's it. That's more than enough. Yeah, clear. I will discuss one amortization example. How many questions we have actually? Yeah, once we are done with it, we will go to amortization. Come to question number 1. See, company has completed a big marketing and advertising campaign. So what we need to do? Transfer to P&L. That's it. No more discussion. A new product developed during the expenditure aggregated 1,50,000 out of which 1,00,000 was incurred prior to 30th September. On the date, it becomes clear that the product was technically viable. The new product will be launched in the next 4 months and recoverable amount is 70,000. Anybody? Sir, up to the date of technically viable, particular product was technically viable. Up to that date, we need to transfer to P&L only, charge it to P&L. After that, you need to capitalize. After that only, we can call it as a development expense. Up to that research expense only. So out of 1,50,000, 1,00,000 was incurred up to 30th September. On that date only technically viable, which means 1,00,000 transferred to P&L, balance should be transferred to nothing but capitalized. Correct? So new product development expenditure appearing in the statement of a financial position will be valued at 50,000. The expenditure prior to the date on which it becomes technically feasible recognized statement of P&L as an expense. How much? 1,00,000. Correct? If you know the logic easily, you can answer. Staff participating in the training program which cost 3 lakhs. The training organization has made a presentation to directors of a Baxter outlining that the incremental profits of the business over the next 12 months would be 5 lakhs. So some employees are the assets of the company. Correct or not? Can we capitalize the expenses? No, because they are not under our control, sir. Correct or not? So training programs, no intangible asset will be recognized because staff are not under the control of the Venus Limited. Where staff leaves the benefit of the training, whatever they also leave. And staff leaves the benefits of the training, whatever they may be, also leave. Which means simple, sir. Completely control not under our staff are not under the control of the entity. Correct or not? So they may leave. They want, they can leave. So we can't do anything. Even if there is a bond, after that bond they can leave the company. Is it possible or not? Yes. We cannot say it's an intangible assets. Correct? So please remember these 3 points also. Yeah. Next, amortization question. So in only advertisement expenses. Next, second point is very important. Up to the date of a technically available, transfer to P&L. After that, development expenses, it should be capitalized. Staff expenses, transfer to P&L. Not an intangible asset. Clear? Yes. Question number 2. Expenditure on new production process on 1st April, 31st December, 1st January. Okay. The production process met the Intangible Asset Recognition criteria for development. On 1st January 2002. The amount estimated recoverable from the process is 1,000. Expenditure incurred for development of the process in financial year 2002 and 3 6,000. Asset was brought into use on 31st March 2003. Expect to be useful for 6 years. What is the carrying amount of intangible asset at 31st March 2002 and the 2003? What is the charge to P&L? Estimated recoverable amount of the process is 5,000. What is the carrying amount of intangible asset at 31st March 2004 and the charge to P&L on 2003-4 on account of impairment loss? So I will discuss slowly this question. Okay now. Simple question. I don't want to discuss also. You only should answer this question. So 1st April to December 31st, 1st January to 31st March. What are the expense incurred? 2,700, 900. Total 3,600. Production process met the intangible recognition criteria for development on which date? On which date, sir? 1st January. Which means on which date? This date. So this expense should be development expense. This is research expense. Correct or not? Are you satisfied with that? Because technically viable. So technically, satisfy the development expense criteria, intangible asset criteria on 1st January only. So we need to capitalize this 900. This should be transferred to P&L. So now the capitalized amount is 900. Okay, very good. Amount of estimated recoverable amount is 1,000. Amount of what is it, sir? Recoverable amount for the process is 1,000. 2002. Okay, no issue. Because here the carrying amount is 900. Development expense 900, right? Next, recoverable amount is 1,000. Any impairment loss? No, because the carrying amount is less than the recoverable amount. So there is no impairment loss, no issue. Next, expenditure incurred for development of the process. Financial second year, 2002 and 3, 6,000. Again, actually 900 is the capital expenditure plus, let's wait. 900 is the capital expenditure plus 6,000. 6,000 is the again capital expenditure 6,000. Asset was brought into use on 31st March 2003 and expected useful at 6 years. Okay. Next, total how much? 6,900. No issue. What is the carrying amount of intangible asset on 31st March 2002 and 2003? Also determine the amount charged to P&L. See here, total 6,900, right? So how many years actually expected life is? 6 years. On this date, brought into use on this date. So we need to amortize from that date. How many years? 6 years. So 6,900 divided by 6. How much? 1150. For 1 year only, sir. So how much balance? 5,750. 5,750. On that date, after on 31st March 2004, what is the impairment loss or recoverable amount? 5,000. So 5,750 is the carrying amount. 5,000 is the recoverable amount. So carrying amount is more than the recoverable amount. Then the difference is impairment loss. How much? 750. So ultimate net carrying amount how much? Recoverable amount should be the net carrying amount. Any difficulty in this question? Nothing, sir. No need to discuss that also. So I want to discuss one example regarding amortization. So for example, year cash flow, year 1, 2, 3, 4, 10 lakhs, 15 lakhs, 20 lakhs, 25 lakhs. These are the cash flows. These are the cash flows. Okay. Now, actually the cost, suppose example 50 lakhs is the intangible asset cost of intangible asset. Now we need to amortize. How to amortize? Generally, if there is no cash flows, you can directly amortize divided by 4 every year 1.25, sorry 12.5. Correct? Sorry, every year how much? Sorry, 60. Assume that 60. I don't want to complicate the solution. 60 divided by 4 means 15 every year amortization value. But the cash flows is given. You need to amortize based on this cash flows only. That's the point I want to discuss. So 60 lakhs into 10 divided by total 45, 50, 60, 70, right? Total 70. So 10 by 70. 60 lakhs into 15 by 70. 20 lakhs into 20 by 70. 20 lakhs, sorry, not 20, 60. 60 lakhs into 25 by 70. So like this we need to amortize every year. Are you getting my point? You need to amortize in this way. Suppose example, after 3 years, the point is saying that, suppose example, first year how much, please tell me. Just very important, sir. I'm talking. This question is very, very important. Last exam. Just wait, where's the calculator? Yes. How much? Tell me. 60 into 10 by 70. How much? Something 8.57. 60 into 15 divided by 70. How much? 12.85. So 12.8. Correct or not? Yes. Generally in third year, what is third year value? 17 point something, 14. 21. So total 21 plus 17 plus 12 plus 8. Sorry, assume the, please ignore the decimals. Total 60, yeah? Okay. Generally, this is the amortization value for every year. The question is saying that assume that there is no recognition in the year 4. We are ready to dispose at the end of year 4. There is no cash flows in year 4. This is the second case. There is no cash flows in year 4. Then what is the amortized value in year 3? How much? What is the balance? 13, 3, 22, right? Total 60. 60 minus 22. 38. 38. So that 38 should be recognized in third year only. Amortized value in the year 3 is 38. The balance should be amortized in third year. Or sometimes case 3, the cash flows may be changed. After 2 years, the cash flows may be changed. They have given different cash flows. 35 lakhs, 29 lakhs, different cash flows. You need to amortize the balance amount should be there, right? After considering this 22, we have balance amount 38. So we need to amortize this 38 based on this cash flows. This is the point I want to say. Very important, sir. This amortization example is very, very important. Please revise this video once again. You will understand everything. Please, we don't have a lot of time to discuss, right? So I think I'm very glad about this. I'm very clear about this. Please go through this again. You will get understand. That's it. Yeah, we discussed one example also here. We are done with it. Clear, everyone? Can I start? Ind AS 102. I don't want to discuss all the things, right? Okay, now. Okay. Come to Ind AS 102. Very simple standard, sir. Very simple standard. The standard name itself saying that share based payment. Payment should be based on shares. Simply. Suppose example, I'm the company. Okay. Suppose example, you are the company. Okay. Customer purchased, another entity purchased goods from you. He needs to pay cash. Or you purchase. For example, A limited is the entity, B limited another entity. Assume that. So sold goods to B limited. Sold goods to B limited. Or purchase goods to B limited. Sold goods to B limited or purchase goods to B limited. Suppose example, if you purchase, you need to pay cash. Correct or not? You need to pay cash or not? But instead of giving cash here, you are giving a shares. Are you getting my point? Share-based payments covers all forms of share-based payment for the goods as well as for the services supplied to the reporting entity. Are you getting my point? You purchase the plant and machinery. You need to pay cash, but instead of that, you are giving us shares. Yes, we can say it's a share-based payment. Yes. In this standard, employees and non-employees also will cover, sir. Sir, actually, we know one ESOP option, and nothing but employee stock option plan is there. In our childhood, we learn that in C level, right? Correct or not? Say, sir, no, sir. Yes, employee stock option plan. In that case, only employees only will cover, but in this standard, non-employees also will cover. Okay, now. Are you getting my point? You are receiving the goods or services. Instead of that, you are paying a sorry, you have to pay cash actually instead of that you are giving a shares to the entity. That's it. Correct or not? So simply we can call it as a share based payment. We have different types of plans actually. Okay. So employee stock option plan, we'll discuss about it. Employee stock purchase plan, stock appreciation rights. This is very important. Okay. Clear. We have different types actually. See, equity share based payments, equity settled, cash settled, and one more, equity with cash alternative. What is that? Equity with the cash alternative. Third option is also there. So these are the three types. We have to learn all these three methods actually. We will discuss three different problems from each of the topic. Based on the time perspective, I will go with that. Don't worry. Clear? Okay. So I will discuss about this equity settled share based payment and cash settled as well as equity cash alternative. See, actually I have given only 4 problems, right? I think so. Problem number 1, 2, next 3, 4, 5, 6. Okay. These are the 6 problems I have given in the marathon material. Okay now. Okay now. So if you know about the employee stock option plan properly, then we can go to share based payments. Okay now, are you getting my point? So let us start with the employee stock option plan. Once we are done with it, we'll come to the employee share equity settle and cash settle and all. Okay now. First of all, I'm going to discuss about employee stock option plan. What is that, sir? Employee stock option plan. Examination point of view, very important. Okay, are you getting my point? In examination they are giving the questions, but this topic is not given completely in our material. Okay, not even one point, just a heading is there. That's it. They have not given any theory based on this. Okay, simple, sir. I will explain clearly with a small example. Okay, suppose Allu Arjun. I think everyone know about him. Allu Arjun, something services private limited, one entity company. Okay. So for example, our AAA movie hall, theater. I mean, it's a mall. Okay, it's a mall, big mall in Amirpet, Hyderabad. Okay. See, he is the owner of that particular company. Okay, whatever maybe. So in that company there are number of employees. The heading name itself, employee stock option plan, not a non-employee stock option plan. So obviously employees only will cover here. So employee stock option plan. What is the meaning of option? Option means right, not an obligation. Option means a right, not an obligation. Clear? So Allu Arjun says that on 1/4/2021, on this date. Okay. If employees provided their services for a period of 3 years, company will give shares to the employees at a discounted price. At what price, sir? At a discounted price. Suppose example, the market price of the share is 100 rupees. Entity says that they will issue at 40 rupees only. So the balance 60 rupees is known as a discount. Are you getting my point? The balance 60 rupees is known as a discount, right? Yes or no? Market price is 100. They're issuing at 40 rupees only. Issuing at 40 rupees only. The balance 60 rupees is known as discount. Clear? Here the terminology is very, very important. This is market price. Okay, market price is nothing but market price only. No change. Here, company issued to employees at 40 rupees only. This price is known as exercise price. This price is known as exercise price. Employees will exercise at 40 rupees. Nothing but they will pay 40 only. Even if the market price is 100, they will pay 40 only. The balance 60 is known as discount, right? That is nothing but intrinsic value here. That is nothing but intrinsic value. Very, very important, this terminology, these wordings. Market price, exercise price, intrinsic value. Are you getting my point? Okay, so company issuing shares, suppose example 10,000 shares, 10,000 share options example. So shares or options, whatever may be. So at what price, sir? 40 only. So balance 60 is loss to the entity. Say yes or no. This 60 is the loss to the entity. Say yes or no. Yes, this 60 is the loss to the entity. Okay. Clear? Are you getting my point? But when this loss can arise to the entity, in first year or at the end of the third year? After 3 years, sir, because they have to provide service for 3 years, right? And then only I have to recognize my loss, right? I have to book this loss. Say yes or no? Generally, yes. But logically, as per dash concept, anybody? As per dash concept, estimated losses should be recognized immediately, but not profits. Which concepts are in your childhood? You already learned about this topic. Prudence concept or conservatism concept. Are you getting my point? Okay, prudence concept or conservatism concept, which is saying that estimated losses should be recognized immediately, but not profits. So here on day one only, I can recognize this. I can estimate this. Yes or no? Yes, because on this date, okay, I am issuing at 40 rupees only. I told to every employee, okay guys, I will issue at 40 rupees to you because you are my favorite employees, lovely employees. Okay, so that's why I'm issuing at 40 only. 60 rupees is benefit to you, it's a loss to the entity. So that loss should be recognized immediately, sir. Even if you are incurring after 3 years, immediately you have to recognize as per prudence concept. Ultimately, it will be benefit to the company only, right? So from starting only they will recognize the loss. Correct? So which leads to reduce the profit from day one. Nothing but from first year. Yes or no? Yes. Here, one more point. So the offer given to employees on 1/4/2021, right? This date is known as a grant date. Grant date. Okay. Next, one more point is so entity told to employees, what is that, sir? If you provide services for a period of 3 years, Okay, then only they will give the shares at discounted price, sir. Otherwise, they won't give. Correcta? Yes. This is nothing but one condition or not? Yes, this is the condition. That is nothing but vesting conditions. We can also call it as vesting conditions. Nothing but they will give some time period to fulfill the conditions kept by the entity. Correct or not? Yes. Entity keeps some conditions, you have to fulfill that. Nothing but you have to, once you got fulfilled, then only you will get shares at discounted price. Okay, so they will give some time, nothing but here 3 years. This 3 years is known as vesting period. What is it, sir? Vesting period. Are you getting my point? Clear or not? Yes. Okay. Once the vesting period got completed, entity will give some time, either maybe 2 months or 3 months or 6 months or 1 year. So generally they will give 1 year minimum. Okay. In this 1 year, employees can exercise their options. Okay. So simple, sir. Entity gave an option, nothing but share. Sorry, give an offer to the employees. If you want to take, okay, you can take. It's nothing but option, nothing but it's a right, not an obligation. If you want to do, okay, you can do. If you want to purchase, okay, you can purchase. Okay, now so that is nothing but exercise. Purchase is nothing but exercise. So they will give some time period for exercising their options. That period is known as exercise period. Exercise period. Are you getting my point? Okay, now clear? Clear or not? Yes. This is a simple topic, sir. Simple topic. Are you getting my point? I will revise all the dates and everything. First of all, grant date. What is grant date? Entity will give offer to the employees. Entity will give offer to the employees to vest their options. Okay, na? Clear? Offer to employees. Okay, offer starts from that day only. That day only. That is nothing but grant date. Second, vesting period. What is the meaning of vesting period? To fulfill the vesting conditions made by the company to the employees. Okay, so for that purpose, they will give some time period to fulfill their conditions. That period is known as vesting period. To fulfill their conditions, entity will give some time period. That is nothing but vesting period. Next, exercise period. Exercise period means after completion of vesting period, entity will give some time period to exercise their options, purchase their options, to purchase their options, to exercise their options. Okay. After this is after vesting period only. Please mind it, sir. After vesting period, exercise period will starts. Clear? Grant date, vesting period, exercise condition. Next, market price. You already know about the market price, right? Next, second point is issue price. Issue price, nothing but issue price means what is it, sir? Issued price, nothing but a discounted price. Entity will give at a discounted price. That is nothing but what is that, sir? Issued price or exercise price. What is that, sir? Exercise price. So MP minus exercise price, you will get some amount that is nothing but intrinsic value. What is it, sir? Intrinsic value. This is loss to the entity, but benefit to the employee. Correct? Yes, because of for 100 rupees value of shares, they were giving at 40 only. So 60 rupees is the loss to the entity, benefit to the employee. That's it. Are you getting my point? But the thing is, this is the loss, right? Intrinsic value is nothing but loss. This loss should be recognized. The next question is, okay, you can recognize this loss in 1 year or all the 3 years. That is the question number 1. Can we recognize in first year only or all the 3 years? Which one is correct? Which one, sir? For all the 3 years, sir. Not in only year one, sir. Year to year is an estimate only. It's an estimate only. It may be changed. It may be changed. Correct or not? Yes. So that's why that loss should be recognized over a period of all the 3 years. Why 3 years, sir? Why not 4 years? Because the vesting conditions is only 3 years in our example. If the vesting period is 4 years for fulfilling their conditions, then you can take 4. Here only 3 years. So simply recognize over a period of 3 years. That's it. Loss should be recognized over a period of 3 years. Simply total loss should be divided into 3 parts. Are you getting my point? Clear? Okay na? Yes or no? Okay, this is the very simple concept. I will discuss with a small example. See, market price 100, exercise price 40, intrinsic value how much? 60 only, obviously. Company issue to employees of rupees 1000 share options. Okay na? Clear? Or 1000 shares, whatever may be. Okay, so they're having some difference. I will set that point. What is the difference between the share values and shares? Nothing but share options and shares. What is shares, sir? Sometimes they will give fair value of a share, sometimes they will give fair value of option also. So they have a lot of difference between these two. We'll discuss about it later. Okay, now please don't forget it. Okay, that's a very important point also. Okay, I will discuss with one example. Okay, we'll discuss later about it. First of all, we are taking up shares. Clear? Okay, simple. So how to present in our exams? Simply here, what is the loss here? 60. How many shares? 1000 shares. Okay, clear. First of all, okay, in exam paper they will ask about journal entries only journal entries. For that purpose, you have to create you have to prepare one working note also. What is that? First one, calculation of employee benefit expense. What is that, sir? Calculation of employee benefit expense. This is the first point you need to calculate. You need to calculate employee benefit expense. Employee is getting benefit, right? So that is expense to the entity. So that's why we can call it as simply employee benefit expense account. So first of all, you should find out this expense. So particulars, we have 3 years, right, in our example. Year 1, year 2, year 3. Same here also, the vesting conditions, vesting period is 3 years. Exercise period is 1 year. Clear? Are you getting my point? Okay. First of all, number of shares, how much? Number of shares, how much? 1000 shares. Number of shares, how much? 1000. Clear? Okay. Next, we should take 100 rupees or 40 rupees or 60 rupees per share. Anybody? 40, 100 or 60? Sir, obviously 60 only, sir. This is loss to the entity. You have to recognize over a period of 3 years. This loss should be recognized over a period of 3 years, not in 1 year. Correct? So, what is it? Intrinsic value. How much? 60, 60, 60. Clear? Next, vesting period. You should write the vesting period next. What is the vesting period here? 3 years. Number of years 1000. Intrinsic value 60. Next, vesting period 3 years. Now you need to calculate the expense for each year. That is the answer. That is the point I should want. Okay, I want that point only. What is the point, sir? What is the expense to be created for each year? What is the expense to be booked? What is the expense to be recognized for each year? That's the point. Simply total expense should be divided into 3 simple. You will get easily. So, first of all, employee total expense. What is it, sir? What is 1000 into 60 into how much? 60,000 now? Here also 60,000. This is for all the 3 years. I want each year. I want for each year, right? So, see, expense during the year. I want 1 year expense. How do we'll calculate? Simply 60,000 is for 3 years. I want 1 year. Simply 1 by 3. That's it. How much? 20,000. Next, second year also. 60,000 into how much? 2 by 3. How much? 40,000. That 40,000 is for 1 year or second year or 2 years? Tell me, sir, this 40,000 is for 2 years expense or 1 year expense? Nothing but second year expense. This 40,000 is for second year expense or 2 years expense? 2 years expense, sir. That's why I'm actually have taken 2 by 3 means for that is for 2 years. I want second year. I want second year expense. How do I find out that second year expense? Simply by reducing the first year expense from this total expense. Correct or not? Because we already created 20,000 in previous year. Now in current year, you need to recognize 20,000 is more than enough. Correct or not? Yes. Because the total amount is 40, already 20 is already created, recognized. So the balance 20 to be recognized in second year. Correct or not? Yes. So that's why we can change the wording. Expense up to date. We can call it as a expense up to date. Nothing but for first year, up to first year, up to 2 years, up to 3 years. So obviously in last year, what is it? 60,000. Nothing but 60,000 into 3 by 3, which means for 3 years. This expense 60,000 is for 3 years. Okay, expense. Okay, now expense during the year, nothing but current year. What is the expense during the year here? First year expense 20 as usual. I want second year expense, not 2 years expense. This 40,000 is for 2 years expense. I want second year. How do I get? Simply this 40 is for 2 years. So out of this reduce this first one. 40,000 minus 20,000. Again you will get 20,000. Clear? Next, when coming to third year, total 60,000 is the expense, right? Because 60,000 into 3 by 3, 60,000 is the total expense for 3 years. I want third year. Nothing but you should reduce first and second year expense, right? So minus 20, minus 20. Simple. First year, second year. Balance how much? 20,000 only. Are you getting my point? This is the calculation of expense during the year, sir. During the year. Okay, now. First of all, you should calculate the up-to-date expense. Out of that, will reduce the previous year expenses. Then you will get a expense during the year, current year, during the current year. Are you getting my point? Clear? Now, in all the years, you have to recognize 20,000, 20,000, 20,000 from today. But nothing but year 1 ending, year 2 ending, year 3 ending. That's it. Clear? This is the working note, sir. Working note. Okay, this is the intrinsic value. Intrinsic value. Please don't forget, it is not 40, it is 60. 40 is exercise price, right? Now, journal entries. Very important, sir, examination point of. That's why I'm discussing very clearly about this topic, right? Yes. Journal entries. First of all, for first year you have to recognize the expense, right? So what is the entry? Expense should be debited, right? So first entry, employee benefit expense account debit to. We are not paying any cash, etc. Simply, what is that, sir? Expense, nothing but employee benefit expense should be, okay, it should be debited, right? Because it is an expense to the entity, loss to the entity. Okay, if the transaction is completed in first year itself, then the employee benefit expense no need to transfer to one particular account, but otherwise you have to transfer. Sir, I am not understanding. Can you please explain me clearly? Yes, I will explain. Correct? Yes or no? Okay. See, employee benefit expense is the loss to the entity, so it should be debited. So for every year, okay, for transferring the employee benefit expense, okay, to a special account, it is a dummy account also. That is nothing but a ESOP outstanding account. But that's an employee stock option plan outstanding account. We can call it as the ESOP outstanding account. We can call it as the ESOP outstanding account. Okay now. So what is the entry? Employee benefit expense debit to ESOP outstanding account. How much? 20,000. This expense will be transferred to P&L. So entry P&L to employee benefit expense account 25,000. Sorry, 20,000. 20,000. Correct? This is first year. Second year also same entries. Employee benefit expense to employee stock option outstanding account. P&L to expense. Sorry, P&L to ESOP outstanding. See, P&L to employee benefit expense. Expense should be transferred to P&L, right? So first year, second year, third year entries will be the same. But at the end of the fourth year, because the exercise price is how much? 1 year time. So everyone exercise after end of exercise period. I think at the end of the exercise period, all the people were exercised. Then entity what we will get? Please think in the point of view of a company. So company will get money. So bank account debit. Which one? Issued price only you will get, sir. Company will get only issued price. Okay now? Are you getting my point? So bank account debit to, you have to issue shares, right? To equity share capital. Which value? Nominal value or face value you should take. To equity share capital. Okay. If we have a security premium, we should also be taken that. Are you getting my point? Okay now? Clear? Here the face value, assume the face value is 10 only, but we are issuing at a 40. The 30 rupees is known as security premium only. So we should take a security premium account also. Now the point is, for every year this ESOP outstanding account is crediting, right? At the end of the payment, nothing but that amount should be, what is that, sir? What do you do? Simply you should debit that. To nullify that amount, you should debit. It is crediting right now, you should debit. So ESOP outstanding account to equity share capital to security premiums account. This is the journal entry. Last journal entry, bank account debit, ESOP outstanding account debit to equity share capital to securities premium. That's it. The bank amount of how much? 40. ESOP outstanding loss is 60. Here equity share capital 10 rupees. The balance how much? 90 securities premium. Here. Okay now. Anybody doubts? Please ask me doubts. This is very important. Bank account debit is outstanding account debit to equity share capital to securities premium. So when securities premium will arise, the value should be more than face value, right? So here maybe the market price is 100. Okay, so the 10 rupees is the equity share value, balance 90 is the equities premium. That's it. Are you getting my point? Feeling drowsy? Hey, చెప్పండమ్మా. Clear a concept? This is very, very important. Clear? Okay, guys. Yeah. Come to share-based payment. It's actually equity settled, cash settled share-based payment, equity with cash alternative, right? Okay, now share-based payment with cash alternative, we can also call it. First one, equity settled share-based payment. Yeah. Ind AS 102, right? First, I'm going to discuss about equity settled and next cash settled. Share-based payment with cash alternative. Okay. These are the three types actually. So second one is cash settled means SAR means share appreciation rights, which means a cash settlement. Okay, come to equity settlement. Okay, simple sir, simple. The settlement should be made in equity, simply settlement in equity. So they will give equity share simply. Here they will give cash. Here just option is there, option. Either he can take a cash or he can take a shares also. There's a third one. So first of all, I am going to discuss about equity. Simple sir, simple. I will discuss only key points. Simple sir. First of all, see, awards given to. If it is employees, you need to measure at a fair value of equity granted. You need to take fair value of equity simply. You need to take the fair value of equity in case of employees. But in case of a non-employees, measure at a fair value of goods or services received. Otherwise, if it is not available, then go through fair value of equity issued. That's it. Equity settled in case of employees, non-employees. Fair value of equity granted. Here, fair value of goods or services received. If it is not available, then go to fair value of equity shares. That's it. We need to measure at this value. Okay, now. So the question will be like this simply. Yeah, we'll go to question and then we'll get a clarity about it. Come to question number 1. See, directly we'll go to question. Don't worry, you will understand. ABC Limited granted to its employees share options with a fair value 5 lakhs. So they granted fair value how much? 5 lakhs on 1st April. What is the condition here? If they remain in the organization up to 31st March 2003. So up to 31st March 2001, ABC Limited expects 91% of employees to remain in the organization. So we already know about it. Sir, actually we need to calculate simply employee benefit expense, correct or not? We already learned in ESOP. We already discussed about ESOP, right? So we need to calculate the employee benefit expense, right? We need to calculate the employee benefit expense. Okay, very good. Then the fair value of a shares, how much are here? 5 lakhs. 5 lakhs is the employee benefit expense initially. But I'm expecting only 91% of the employees only will remains in the organization. So I need to account the expense for only 91% of employees only. This 5 lakhs is for total 100 employees. 100 total number of employees. Okay, number is not given, but for all the employees, 5 lakhs I have to incur. Correct or not? I have to issue share options of rupees, fair value of rupees 5 lakhs for all the employees. But only I am expecting 91% of the employees only. Okay now. So we need to book the expense for 91% employees only for first year. Second year 89. Third year 82. That's it. Same pro forma. See here. Particulars year 1, year 2, year 3. Total employee benefit expense how much? 5 lakhs. So total employee benefit expense 5 lakhs, 5 lakhs, 5 lakhs. Vesting period how many years? Vesting period. If they remain in the organization up to how much, sir? 31st March 2003 means 2010 to 2013. Sorry, 13. Whatever maybe. 10 to 13. How many years? 3 years. Yes. 3 years, 3 years, 3 years. Expected number of employees vesting how much? 91%, 89%, 82%. Then easy to calculate the expense, right? So expense up to date. First of all, we need to calculate expense up to date and then go to expense during the year. See here, 5 lakhs into 91% into 1 by 3. Simple. This is the first year expense, right? Next, 2 by 3 means 2 years expense. 2 years expense. But I want second year expense. How I will get that second year expense? Simply, out of this total, just deduct this first year expense. You will get the second year expense. Because this expense is for 2 years. I want only second year, so I have to reduce that first year expense, then I will get second year expense. Next, 5 lakhs into 82% into 3 by 3. I got a 4 lakh 10,000. That is for 3 years expense. I want third year expense. How I will get this? Out of 4 lakh 10,000, we need to reduce this 2 years expense. Whatever expense you already recognize, we need to reduce it. Then you will get the third year expense. That's it. Simple. Simple, sir. Very, very simple. But the thing is, every year you need to transfer employee expense. Employee benefit expense will be transferred to which account, sir? Actually, in case of ESOP plan, you need to take a share outstanding account. Employee stock option outstanding account. Correct or not? There. In first employee stock option plan, sir, I am talking about. But in this case, you need to transfer to share-based payment reserve account. In case of equity, you need to transfer to share-based payment reserve account. If it is cash, share-based payment liability account. So here we are talking about equity, so you need to transfer to share-based payment reserve account only. That's it. Every year expense will be transferred to reserve account. See here. Employee benefit expense to share-based payment reserve account. Second year, employee benefit expense to share-based payment reserve account. Third year expense, same. Fourth year, ultimately we are giving equity, right? So nothing but share capital. So this account will get closed. Share-based payment reserve account debit to equity share capital 4 lakh 10,000. This is a dummy account, sir. This is a dummy account. That's it. Clear, everyone? Clear? Okay. Next. This is the method on equity when you are issuing equity. If you come to second case, what is that? This is the cash settlement. Second case. Okay now. Cash settle share based payment. In this case, actually, cash, we need to pay cash, right? We need to pay cash. So it's a financial liability or not? So cash is a financial liability as per Ind AS 32. As per Ind AS 32, cash is a financial liability because we have an obligation to pay cash. It's a financial liability. Correct or not? So that's why we will use the, what's that, sir? Liability account here. That's why we will use a liability account here. So that's why we have used a share-based payment liability account. Every expense will be transferred to share-based payment liability account. And one more point, if it is a cash, financial liability. So generally, in case of a financial liability, okay, every year fair value should be remeasured. Correct or not? Fair value should be remeasured. This is the second point. Every year fair value should be remeasured. Initially recognized at grant date only. But every year ending we need to Every year ending, we need to recognize it. We need to remeasure the fair value. We need to remeasure the fair value. Simple. Are you getting my point? We need to remeasure the fair value. If you know all these points, then you can answer this question very easily. See, I will go with the question directly, then you will understand. No issue. XYZ issued 10,000 share appreciation rights that vest immediately to its employees. That vest. Okay. So come to question number 2. This is the question based on share appreciation rights. Okay. Question number 2. Sorry. Share appreciation rights. And one more point you need to remember here. What is that? This question has no vesting period actually. So see, XYZ issued 10,000 share appreciation rights that vest immediately to its employees. Which means, what's the meaning of it? Vest immediately to employees means there is no vesting period. So directly they are giving to employees on 1st April 2010. They vest immediately to its employees. The SCR will be settled in cash. Okay. Using an option pricing model at the date it is estimated the fair value of the SCR is 95. So, and in this case, you need to recognize on the date of grant date only. What's the grant date here? 1/4/2010. On this date only, you need to recognize this expense. SCR can be exercised at any time up to 31st March 2013. Here there is no conditions actually. What's the meaning of the vesting period? So employees need to comply with the conditions, right? Here there is no conditions. Directly they are giving. If you want, you can exercise immediately also within the 3 years. This 3 years is known as exercise period. Correct or not? For purchasing option, they have company given the option to the employees, right? So just for exercising, there is no need to comply with any conditions. In this, there is no vesting period, right? So that's why we are using the word vest immediately. Please underline this word, which means there is no vesting period actually. Okay, now. So in this case, see, we need to recognize on grant date SCR. Recognize on grant date SCR. So grant date, what's the value of SCR? 95 rupees. You need to recognize. You need to recognize on grant date. So here also the number of employees vesting percentage is given. The first year 95%, second year 92, third year 89. Same procedure. But what is the change here? We need to remeasure the fair value, right? We need to remeasure the fair value every year ending. Correct or not? That's why the fair value of SCR is given for every year ending value. On grant date, what's the amount? 95. So 95 into how many share options? Appreciation rates 10,000 into. Okay, now. So total number of employees is not given. So total how much? 95 into 10,000. How much, sir? 9,50,000. This is the estimated total expense. This is on 1/4/2020. This is on 1/4/2020. You need to recognize this expense. 9,50,000. Okay, now. Are you getting my point? Next, first year ending. Come to first year ending. Okay, come to first year ending. Sorry. Okay, come to first year ending. The number of employees exercising, how much, sir? At the end of the first year, expected to exercise 95%. How much? 95%. So, and that to the fair value has to be remeasured, right? So the first year ending, the fair value is 112. So number of options 10,000. Share appreciation rates 10,000. 10,000 into 112. Correct or not? 10,000 into 112. How many years? How many years actually? See, actually they can exercise in 3 years. Exercise in 3 years. Okay, everything is okay. But the point is, first year ending, how much the percentage they are vesting? 95%, right? First year ending, that is the ending I'm talking about. Yes, it is expected 95% will employees will exercise the option. When they will exercise, generally year ending only we will consider, correct or not? Yes, so beginning of the 100%, so total 9,50,000. So for first year ending, 10,000 into 112 into 95 percentage, how much? 10,64,000. Which means what is this 10,64,000? Up to the first year ending, what is the total expense they have to recognize? 10,64. Out of that 9,50,000 already recognized on day one only. So the balance will be recognized at the end of the year. So 10,64,000 minus 9,50,000. This is the first year ending expense. Come to second year, 10,000 into fair value 109 into 92 percentage. This is the second year ending, not third year, second year ending. This is the total value. But we already recognized 10,64,000, but second year ending 10,02,800 only, which means already extra recognized in previous year. Now we need to deduct that expense, correct or not? Yes, we recognize extra expense. The difference between these two should be reduced expense. You need to reduce the expense. Third year, third year ending, 10,000 into 114 into how much percentage? 89%. 10,14,600. Up to second year ending, what is the amount you have recognized? 10,02,800. Now 10,14,600, which means we need to recognize extra expense 11,800. Correct or not? 10,14,600 minus 10,02,800. So the difference is 11,800. You need to recognize at the end of the third year. I think everyone have a clarity about this share appreciation rates. Okay, in this question there is no vesting period actually. If there is vesting period, what we need to do? If there is a vesting period, what do we do? Please tell me. If there is a vesting period, same do like an equity method. So, correct or not? Are you getting my point? You need to consider the vesting period. So 1 by 3, 2 by 3, 3 by 3, we already discussed in equity method, right? Do same like that. Okay guys, I think everyone clear about this working note. So the entries will be same, but the just only what change is liability account. Employee benefit expense to share based payment liability. Same. Last year low, in last case, you need to pay cash, share based payment liability to cash. In that case, share based payment reserved to equity. That's it. But see, the difference is here there is no vesting period. Correct or not? So that's why okay guys, good evening. Next third method. What is that? Share based payment method. What is that, sir? First one, equity method, equity settlement, cash settlement. Now share based payment with the cash alternative. What is that, sir? Share based payment with the cash alternative. Ready? Okay now. What's the third one? Share based payment with the cash alternative. What it means? Simple, sir. Simple. We have two options here. Okay. So cash alternative means we have a equity option or a cash option. It's your wish. It's up to counterparty. Okay now. See, initial recognition, simple. Just for understanding purpose, it includes both cash and equity component. But ultimately it will be settled in either cash or an equity. Any one only will be possible, right? Correct or not? After completion of a period, okay, only one is possible, either cash or an equity, we don't know initially. So just it's an alternative. Okay now. So that's why it includes two options. One is a two components. One is cash component, second one is equity component. Cash component is nothing but liability component. Correct or not? Yes, you have to obligation to pay the cash. Correct or not? So that is nothing but liability. So yes or no? We have discussed that point. So cash is a liability. So it includes two components. In this share-based payment with the cash alternative, okay, it includes both equity and cash component, both equity and debt component, both equity and liability component. So all are same, sir. I am repeating just body remembering purpose. Are you getting my point? So it includes both debt and equity components, like a compound instrument, correct or not? Like a compound instrument. So, like compound instrument, it includes both debt and equity components, correct or not? Yes. Debt means cash. Cash is a liability only, right? Obligation to pay, sir. Obligation to deliver cash. It's a financial liability. See, under compound instrument, under Ind AS 109, we already discussed that. What we have discussed? It includes two components. Okay, initially you will find out the liability component, and then you should reduce the liability component from issued price. You will get equity component. Correct or not? Same like we have a small formula. It's a simple logic. You will understand when I discussed about the example. You will understand the logic. Just please read this. Fair value of equity alternative minus fair value of cash alternative. Then we will get fair value of equity component. What is it? Can you please repeat? Simple. Assume it's an issued price. Assume it's a liability component. You will get equity component. Same. Compound instrument concept. In this 109 we are discussed, right? What is the issued price minus liability component? So this cash alternative is nothing but liability component. Okay, now for understanding purpose, remembering purpose, I am saying that point. Okay, so there is no link between that and this one. Clear? How to calculate equity components, sir? Fair value of equity alternative. Fair value of equity alternative. Fair value of a cash alternative. On which date, sir? Grant date. You should take a grant date only, sir. Then only we will find out the equity component on day one. We want day one only. So first day you have to calculate the fair value of equity component. Actually, we want it includes both debt and equity components. Debt and equity components. Actually, generally for equity settlement, what we will do, every year expense will be transferred to where, sir? Share-based payment reserve account. Under cash, every year you have to remeasure the fair value. Correct or not? Yes. So, but this point includes both options. This point includes both options. Okay. So first of all, you should find out equity component. How to calculate equity component? Fair value of equity alternative minus fair value of cash alternative. You will get a fair value of equity component. Very simple, sir. Very, very simple. Okay, now in the given question, share alternative, nothing but equity alternative means share alternative. So this price will be given something. And fair value of a cash alternative means you should take a grant date share value, fair value. On which date, sir? Grant, because we already know about that. In case of a cash component, nothing but cash settlement, we will take a grant date value only. So same like that, you should take a grant value, grant date fair value. Then the difference is known as equity component. See, I will explain with a small example. So generally, if the question comes from this topic, same like this, the question will be like this, simple. Suppose example, entity will give 1000 shares, or this is nothing but equity alternative. For cash purpose, they will give cash equivalent to 800 shares only. If you want shares, okay, if you want shares, they will give 1000 shares. Otherwise, you will get cash equivalent to 800 shares only, because they are giving a cash rate, so that's why they are reducing the amount. Okay, says or no? That's why it includes debt and equity component also, like a compound instrument. Are you getting my point? Some difference will come, sir. Some difference will come. Because both should be equal actually. Both should be equal. Either 1000 shares or either 1000 shares or amount equivalent to that shares only, but they are giving only 800 shares only. The question will be framed like this. Okay, either give 1000 shares or cash equivalent to 800 shares only. Okay, so at that time you should take what value, sir? 1000 shares into which value? Share alternative value. Equity alternative value will be given. Suppose example 120. So 1,20,000 minus. Next, how many shares? 800 shares. 800 into what you have to take here? Grant date fair value. Suppose example 110. So something 88,000. This difference is known as equity component. Are you getting my point? This difference is known as equity component. So generally question will be framed like this. Are you getting my point? Once again I am saying, please focus. This 120 is share alternative price. This 110 is grant date fair value. Okay, now for cash we will take always grant date fair value only, and then we will remeasure. So we will remeasure it later when accounting of a expense. We will calculate expense, employee benefit expense we have to calculate, right? So at that time we will do that. So the total component how much? 32,000 or 22,000? So 32,000, correct? This is equity component. This equity component will be, okay, amortized. Nothing but over a period of vesting period. Vesting period. So for example, if the vesting period is 2 years, 16,000, 16,000. Correct or not? Yes. And then you should calculate the debt component. Debt component means cash, sir. Debt component means cash. Both should be accounted once at a once time. Once in a time. Nothing but sorry. At a time. Sorry. Both cash option as well as cash option means liability. Next equity option. Both should be accounted at a time only. At a time only. We don't know. We don't know what we have to, what they will decide. It's up to counterparty. Sometimes company also, sometimes counterparty also. Okay now. So it's a share based repayment with equity alternative. So that's why both should be accounted at a time only. Nothing but equity option as well as the cash option. Cash option means liability option only. Please don't get confused. What is cash option? What is liability option? Both are same. Debt option. Everything is same. Okay now. Clear? Yes. Can you please repeat what is this price? Share alternative price. Here 110 is granted date fair value you should take. Because we already discussed that cash settlement point. We should consider on grant date fair value only. Correct or not? Yes. Clear? Next. Come to entries generally. Finally. So every year you have to write this entry. What is it? Employee benefit expense to share based repayment reserve account, share based repayment liability account. Why we are writing these two? Because this reserve is equity option, this liability is cash option. You have to recognize at a time. I already told about that, right? Yes. Is that clear? So till settlement you have to write this entry. On the date of settlement, it's up to counterparty or maybe company also. So assume it's a counterparty option. If it is settlement in cash only, then what is the entry? Share based repayment liability account debit to cash. Then what about this reserve account? It should remain in equity. It should remain in equity only. Reserve means equity only. You have to settle whatever the amount of cash. Equity remains stable. But if the settlement is in equity, then share based repayment liability to equity share capital to securities premium. Here share based repayment reserve account to equity share capital to securities premium. For both amounts you have to issue shares. Equity share capital, if there is any security premium you have to consider, which is more than the face value, right? Correct or not? Face value is 10. You are issuing at 20 rupees, nothing but. So extra 20 rupees, 10 rupees is known as, what is that? Securities premium. You already know about it. Okay now. Okay. So everything is clear. Okay. I hope the concept is very clear. So I will discuss once again. So share-based payment with a cash alternative, which means here we have two options. One is the equity option, second one is cash option. Okay, so initially, in this case, initially you have to recognize both the alternatives. You have to consider both the alternatives. So that's why it included both the cash option as well as the equity option. Cash option means liability option. So nothing but equity and liability component, both are included. So that's why we can call it a compound instrument generally. Okay, so it includes both debt and equity instruments. Debt means cash here, liability. Correct or not? I already discussed about it. Okay, for calculation of equity option. So what's the formula here? It's a logic, small logic only. It's not like a formula to remember to by heart this. Okay, simple sir. The amount should be, this is the share price. This is the cash amount. Both are not equal actually. In our example, shares is 1000 but cash equivalent to 800 shares only. The difference is known as the equity component. Simply. Correct or not? Yes, that's it. Okay, this is the amount, difference amount, equity component. So cash alternative. So you should consider on only grant date. So equity alternative value will be given in the given question. So it will be given in the question. Okay, no issue. Next, entries. Employee benefit expense to share-based payment reserve account to share-based payment liability account. If the settlement in cash, share-based payment liability to cash. Correct or not? Same like second cash alternative. Nothing but cash settlement. If the settlement in equity, two entries we have to write. Or either you can write direct entry also. Share-based payment liability account, share-based payment reserve account to equity share capital to security payment. You can write like that also. Compound entry. Okay now. Okay. Now, if you solve one problem, then you will get a complete clarity about this topic. Then only you will get clarity sir sometimes. But in this, we already got a clarity. Yes or no? Clear? Okay. First of all, you have to recognize the expense for every year, right? Then how to calculate expense? That is the point you should know. Actually, we have two types of components. One is equity, second one is cash. So under equity, expense will be there. Under cash option also, cash alternative, also some expense will be there. So both will be added. This is the total expenses. This amount will be transferred to reserve account. This amount will be transferred to liability account. That's why entry will be, what's the entry? Employee benefit expense account debit, this amount. To share-based payment reserve account, this amount. Share-based payment liability account, this amount. Correct or not? If you have a clarity about first two methods, then easy. This topic is very easy. Clear? Okay. So come to question number 5. On 1st January 2011, ABC Limited gives options to its key MP, key managerial person employees. He is also considered under employee category only, to take either cash equivalent to 1000 shares or 1500 shares. So they are talking about if you want to cash, we have two options here. One is cash and the another one is shares. Shares is 1500 shares. Cash is equivalent to 1000 shares only. So the minimum service requirement is 2 years. So this is the condition, vesting condition. Minimum service requirement will be 2 years and the shares must be lock-in, kept for 3 years. We already discussed about this point. This is known as lock-in period. Lock-in period means that the shares to be held by the entity. So a party or another party for a period of 3 years. That should be the must. Party means employee. Employee should hold the share for a period of 3 years. That's it. Fair value is given below. Share alternative fair value with restrictions. How much? 1 not. Granted fair value 1 month. First year ending, second year ending. The employees access the cash option at the end of the 2002 past journal entries. I think this question is very, very simple question. Whatever the example we have discussed, as usual in this question, correct or not? Yes. Please try yourself. If possible, please try yourself. No, actually we want to calculate expense for each year. Correct or not? Yes. First, before going to that, you should find out the fair value of equity option. Equity option. Correct or not? How to get that? How to get that fair value of a what's that, sir? Share alternative, equity alternative minus fair value of a cash alternative. We will get equity option. Correct or not? Yes. See here. Fair value of shares. Number of shares, how many here? 1500 shares. Cash equivalent to 1000 shares. For equity shares, we will take a equity alternative value only. Share alternative value how much? 1 not. For cash purpose, cash alternative you should take only granted date fair value. How much? 113. What's the difference? Please calculate. That is only the equity option. So come to solution. 1500 into 2. Fair value of equity alternative minus fair value of cash alternative. How much? The difference is fair value of equity component. How much? 40,000. This is the equity component fair value. How much, sir? 40,000. This has to be recognized over a period of how many years? 2 years only vesting period. So divide for 2 years. So first year 20,000. Second year also 20,000. Correct or not? Okay. We'll allocate later. Just wait. Next, now you have to calculate liability component. Okay, nothing but cash component. So expense for cash component. How to get, sir? Simple. Total how many number of shares? Simple. Please do whatever the solution we have done for cash settlement. Same as that question. Same as that procedure you have to follow for this cash component. Same. So how many shares? 1000 shares. What's the fair value here? First year 120. Into how many vesting period? 2 years. So into 1 by 2. For first year 1 by 2. I have calculated directly. If you want, you can calculate separately also. Same. Whatever the pro forma we have, you can follow. Like fair value, total expenses, estimated expense, vesting period. Okay, expense up to date, expense during the year. So like that you can calculate. Okay, so 1000 into 120, 1,20,000. The vesting period is 2 years. So that's the 1 into 1 by 2. Here 2 by 2. Here 2 by 2. Then we will get what is that, sir? Okay. So students are getting confused. Don't confuse. I will solve the question. First of all, calculation of employee benefit expense. Particulars. Year 1, year 2. Okay. First of all, you should calculate the equity as well as first of all, you should calculate equity component, right? So for that, we will prepare one working note. Before that, you calculate a liability component. Sorry. First number of shares. Thousand. Fair value 120. 132. Total estimate expense 1,20,000, 1,32,000. Vesting period, how many years? 2 years. Expense up to date or till date, how much? 60,000. Here 1,32,000. How we will get this? 1,32,000 into 2 by 2. Same calculation what we have followed for previous questions. Expense during the year. Current year expense how much? First year 60, second year how much? 72,000. 1,32,000 minus 60,000, because the 60 already recognized in first year, so no need to recognize again, right? So difference amount will be the second year expense. It's a liability component. Now expense during year, equity component, how much? 40,000, right? So 40,000 into 1 by 2, 40,000 into 1 by 2, simply 20,000, 20,000. 40,000 into 1 by 2, 40,000 into 2 by 2 minus 20,000. We already recognize this 20, right? So balance 20 will be recognized in second year. That's it. This is the way of calculation, and for that working note you have to prepare calculation of equity component, particulars amount, particular amount. See, fair value of share alternative, fair value of cash alternative. What are the amounts? Now, share means 1,000 shares into how much? Share alternative value how much? 100. Sorry, 1,500, right? 1,500 into 100. Cash how much? 1,000 into 1 month. How much? What is the amount? 40,000 we already calculated. Please calculate the amounts. You will get a fair value of equity component. That's it. I think everyone understand this basic question, sir. It's a basic question. Correct? Say sir, no. So calculate the total expense. 60 plus 20, 80,000. Here 72 plus 20, 92,000. This is the total expense during the year. During the year means current year expense. Okay, now see the entries. First year employee benefit expense. First year expense how much? 80,000. Out of this 80, 20 is related to equity component, 60 is liability component. So then entry will be employee benefit expense account debit 80 to share based payment reserve account, nothing but equity, how much? 20, and liability 60. Same. For second year also same entry. 92, 20, 72. And ultimately they are choosing a cash option. So you have to pay the cash. How much cash? 72 plus 60. Total 1,32,000. Share based repayment liability to cash or bank 1,32,000. There is no need to give a account for give an entry for a reserve account. Reserve accounts remains in equity only. Okay, now I think the calculation part is very simple and very understandable. I think so. If you have any doubts, anybody you can ask. I think we already discussed 3 examples for this calculation. So please remember this. Sir, why this 1,32,000? Why this 60? Why this 72? Simple, sir. This is first year expense. So first year expense as usual. This is 2 years expense. Out of this 2 years expense, you should reduce the first year expense from it. Then only you will get second year expense. Correct or not? And then entries తెలిసిందే కదమ్మా అయిపోయింది. Okay, now if it is equity settled, then what is the entry here? If it is equity settled, then what is the entry? Share based payment reserve account debit, share based payment liability account debit to equity share capital to securities premium. This entry we already discussed. Share based payment reserve account should be debited. We already credited the treasury account. We already credited the liability account. We should debit both of that. Then issue the equity share capital. If there is any more than the face value, then it will be traded as securities premium. You already know about this basic entry. Correct or not? Yes. Clear? I think everyone is clear about this topic. Very clear. Question number 6. What is that? Same question number change. So homework. Okay now. Clear? So question number 6 is homework. You have to practice that. If you understand the question number 5 easily, then question number 6 is dead easy. Please don't see and write. I am not given the solution also because that's a basic question. This question is more than enough. One question practicing of one question more than one times is better than practicing number of questions. Seriously. Yes. There. Okay. Clear? Calculation of employees. Just wait, I will give a small example and then we'll go to the problem. అర్థమవుతుందా తెలుగు స్టూడెంట్స్? Understandable or not? Very simple topic, sir. Very simple topic. Still, if you have got any doubts, you can call. Feel free to call. Okay, na? So my personal number, I already know about it. So first ping to that office number, and then they will contact you. Okay, na? Clear? Okay. See, suppose example, number of employees in the organization is 1000. Number of employees in the organization is 1000. You already know this point. Whatever the employees stayed in the organization, we have to recognize expense for those employees only, not for lefting out of the organization employees. Correct or not? Because few employees are out of the organization, they are leaving the organization. Is it required to recognize expense for leaving employees? No, sir, because we no need to give any shares to them because they are leaving the organization. Why should I give them? Why should I give them the shares? No, not possible. So we want whatever the employees staying in the organization, that is only we want. Correct or not? Yes, exactly. So now we have 1000 employees initially. In first year ending, I am expecting 30 employees may leave the organization. Sorry, 30 employees left out of the organization. First year ending, 30 employees already left out of the organization, and I am expecting 20 more employees may be left in the next year. 20 more employees may be left in organization, left out of the organization. Okay, can I recognize that 20 employees or not? Can I recognize or not? No, sir, no, because it is everything depends upon estimation, right? Estimated expenses. So we are expecting that this 20 employees also will leave the organization. So ultimately we have only 950 employees only. For 950 employees only, we should recognize the expense. Correct or not? Okay, now please don't recognize expense for 970 employees because we are expecting 20 employees may leave out of the organization in next year. Everything depends upon expectation only. So when I am expecting that 20 employees are leaving the organization, then why should I recognize expense for those 20 employees also? Not possible. Don't do like that. That's a mistake. Okay, now clear? Okay. So come to second year. So already 30 employees left out of the organization in first year. In second year, 15 employees left. Actually, I am expected that 20 employees will left the organization, but only 15 left out of the organization. Okay, no need to recognize expense. At the end of the second year, I am expecting that 20 more employees will leave the organization in third year. So for that 20, can I recognize expense or not? No, no need. So reduce the 20 also. How much? 935. For this employees only, you should recognize the expense for second year. And the third year, 30 already left in first year, 15 already left in second year. and last year 22 employees left. Assume that, or 18 employees, something. Okay, 20 employees left. Nice. So how much? Okay, 15. Okay, 15 employees. How much? 6940. Okay. So under in third year you have to recognize expense for 940 only, because actually 60 employees only left out of the organization. Correct or not? This is the calculation for number of employees. Very important for exam. Examiner last time asked this question only. Copy paste from our book. Just numbers will change. That's it. Is it clear? Are you getting my point? Yes. If you understand this example clearly, then we can go to question number 11. Yes. And one more point. Okay, we'll go directly and we'll discuss in question itself. See, grant with a performance condition. Performance condition means it may be market or non-market, in which the length of the vesting period varies. Okay, at the beginning of the year 1, X Limited grant 200 shares, each of 400 employees. Conditional upon employees remaining in the employment with the company, okay, during the vesting period. The shares will vest at the end of the year 1 if the entity earnings increases by more than 15%. At the end of the year 2, if the entity's earnings increase by more than an average of 12% per year over the 2 years period. And at the end of the year 3, if the entity's earnings increase by more than average of 10% per year over the 3 years period, the share will have a fair value 40 per share at the start of the year 1. No dividends will be considered. Okay. By the end of the first year, entities earnings have increased by 13% and 32 employees left. Entities expect further 30 employees to leave during the year 2. By the end of the year 2, the entities earnings have increased by 11% and 27 employees left during the year. Then they expect 25 employees more leaving during the year 3. By the end of the year 3, 20. I don't want to study the question. Read the question. Because we need to read carefully. That type of reading will not work in our exam. Okay. First of all, we have to make a small chart. Then only we can solve that question. At the end of the year on exempt grants, how many shares are 200 shares? How many employees? Number of shares 200. Employees 400. Condition. Year 1, year 2, year 3. First year, the earnings C year and third line. The shares will vest at the end of year 1 if the entity's earnings increase by more than 15%. Okay, first year earnings should be more than 15, not 15 or less than 15. Next, year 2 entity's earnings increase by average of 12% over the 2 years period. 12% average of first and second. Next, at the end of year 3, entity earnings increase by more than average of 10% per 3 years. Are you getting my point? You have to understand this question carefully. The question is not saying about only earnings for each year. They are saying about average of for first year there is no average, so this is only the 15%. For second year they are saying that first and second year, if you total first, if you take average of first and second year, then the value should be more than 12. If you average the first and second and third, then the average should be more than 10%. This is the question. But see the reality. First year 13, second year 11, third year 9. 13%, 11%, 9%. Correct? See, you should not consider these values because we want average. This is the actual returns. Okay, actual earnings is 13%, 11%, 9%. We should consider average only, not this values. For first year, 13 is only the average because only one value. For second year, you should take 13 plus 11 by 2. That is the special point here. Please note down. 13 plus 11 by 2 means 24 by 2, 12%. This is the average. This is actual. Next, third year 13 plus 11, 24 plus 9, 33 divided by 3, 11%. See, in the first year, our expectation is more than 15, but it is 13 only, not reached. So don't waste the options or shares. In second year, more than 12%, but it is only 12% only. So, but it is a 12% only. So no waste the shares. Don't waste the shares. But in third year, it should be more than 10%, but it is 11%. Yes, you can vest in third year. You can vest in third year. This is the condition you need to understand. Otherwise, we will not solve the problem. We cannot. Are you getting my point? This is the way of understanding the question, sir. Way of understanding is very, very important. Employees calculation is very easy. We already discussed one example, so easily we can solve that. Clear? See, this is actually one special question. This is the point is, some students may got doubt, sir, how can I expect the earnings will be? The earnings, actually, how can I expect the vesting period in year 1? So we already discussed about that point. Okay. In year 1, I cannot expect the earnings, correct or not? Because I may or may not achieve the target. In first year ending, actually I have not reached that earnings rate. How much here? 13% only. Actually the condition is 15%, more than 15, but I got 13 only. Okay, so what you are thinking at that time? Oh, I have not reached in first year. Okay, I may reach in third year. If anyone will think like that, suppose example, if you fail in a first attempt, anyone will think, okay, I will not pass in second attempt, I will pass in third attempt. Anyone thinking like this? Yes or no? No, sir, no one will think like that. If you fail in this attempt, if you fail in last attempt, you will pass in next attempt. That's our thinking process will be there, correct or not? Yes. Accounting also same, sir. In first year, we may not expect the exact our condition will be satisfied in particular year, but our expectation will be okay. If we are not achieved in first year ending, okay, we may achieve in next year. That is our thinking process. That's why in first year the vesting period should be how much? It will be 2 years or 3 years? 2 years only. That is the special point we need to understand here. Generally, we will take vesting period 3 years, 3 years, 3 years in all the years. Correct or not? Yes, because we know that vesting period. But but in this case, we cannot estimate. If we not reach the goal in first attempt or first year, we may reach in next year. That's it. Correct or not? Yes. So that's why for the first year, the vesting period will be 2 years only. Why vesting period required? To recognize the expense. Without vesting period, how can we recognize, sir? So that's why. Suppose example. Okay, first year done. And second year also they have not done the target. We have not reached the target. Then what we should do? What should we do now? Anybody? At the end of the second year, what is the vesting period? Will take 2 or 3 or 4 or 5 or 1. Anybody? When we are not reached our target in second year, what is our expectation? Yeah, we will reach in third year. Correct or not? Yes. So that's why for second year, the vesting period will be 3 years. Are you getting my point? Finally, we achieved in our third attempt. Okay. In third year, we achieved the target. Actually, it should be 9%. Okay, 10 more than 10%, it is 11%. Okay, condition satisfied. You can vest the shares or options. So, what is the vesting period in third year? 3 only. No need to extend to 4 because we reached in third year. So, vesting period will be 3 only in third year also. If we not achieved in third year also, you can take a 4. Vesting period will be 4. It will be increased like that if you not achieved, because it is varies depends upon the when the performance is satisfied. Sir, we already discussed about it. Correct or not? Very interesting question. I like this question. When I actually this question in my CA when I was studying CA okay, this question is there. I like this question. Initially, I am unable to understand this question seriously, but now very clarity. Everyone will get a good clarity about this question. Yes or no? Yes. So easily we can solve this question. So come to first of all employees. In first year, 32 employees left. Actually, total employees is 400. Please calculate by your own. Please don't see the solution because we already calculated one example, right? So 400, 400, 400. First year, how many left? 32. The entity expects further 32 leave. So we are expecting 30 more employees will leave here. Second year, 32 minus, again 27 left during the year. Again we are expecting 25 employees will leave during the year. Sorry guys, sorry for disturbance. Okay. So please calculate the number of employees. No need to discuss because I discussed example also. Okay. I will show. Initially 400 employees. Okay, it's very good. In first year 32 employees will left the organization. Okay, minus 32. Next, I'm expecting 30 more employees will leave the organization. So minus 30. So the balance 400 minus these two, 338. Next, 32 employees left in already in first year, and second year 27 employees left out of the organization. So 32 plus 27, total 59. Okay, I am expecting 25 employees will leave the organization at the end of second year. Okay, minus 20. Third year, so already 32 left, already 27 left. So in third year, 22 employees left. So total 319 employees. Now you have to recognize the expense for each year. Employee benefit expense. See here, simple. I already discussed here. 338 employees into number of employees into number of years, 200 into. Okay. What happened? Okay, 200 into. Next, what is the fair value of a share? What is the fair value? Yes, the share value. The shares have a fair value 40 per share at the start of year 1. You should take 40 only into 1 by 2. Why should I take 1 by 2? Because the vesting period is 2 years only. So please write this also. Write one more column. Vesting period 2, 3, 3. Okay, 2, 3, 3. So that's why 2, 2, 3. Okay, now. So that's why 1 by 2. 1 by 2. Are you understanding this point? Generally, we will take 1 by 3, but we have to take 1 by 2 only. This is only the special point from this question. For second year, we have not reached the goal, right? So the vesting period is 3 years only. Then that is for 2 years expense. So that's why 2 by 3 is common. Correct or not? For third year, 3 by 3. So based on that, you can calculate the each year expense. This is expense during the year. Correct or not? We already catch the conceptual. We already got the conceptual clarity. Please solve that. So 13,50,000 first year. This is 2 years. We want second year. So reduce from this value to this value. This is for 3 years. Reduce from this value. These two values reduce from this value. You will get third year. This is question number 11. Clear? In this question, the special point is average is very important. We have to take averages. If you have any doubt, please note down this all. For understandable purpose, for understanding purpose, you can take this. Clear? Okay. Thank you. We'll discuss problems in next video. You got to clarity about fair value of option, fair value of a share. If the question is directly saying about fair value of option, you can take that. Fair value of a share, don't take fair value of share. You have to take intrinsic value of a share. But both the values is given clearly. Fair value of option is given, fair value of a share also given. What you need to take? Tell me, sir. Yes, whatever you want. Suppose example, if the exercise price also available, you can calculate the values based on shares also. Nothing but market price minus excess price, you will get intrinsic value. Okay. So based on that, you can calculate. Otherwise, you can take options also. Both the alternatives can be possible. Okay. See, this is a good question. On 1/4/2017, OM Limited grant 50 options to each of its 2,000 employees at 70 rupees. What, sir? They granted 70 rupees. Okay, now when the market price is 110. So, see, sometimes students may got confused about this point. So they want to issue 50 options. What options, sir? Nothing but share options only. Okay, na? Share options only at 70 rupees. This is not a fair value of option. First of all, you have to clear about it. And the market price also given. Then what is the 70 rupees? The 70 rupees is known as exercise price. That's the point you need to understand. Are you getting my point? This is not a fair value of a option. Okay, now 50 options. They're giving to each of the employees at 70 rupees. 70 rupees, which means it's a share value, exercise price. Market price is given. Okay. So the exercise price is the same in all the cases, right? In every year. Nothing but they will give at the end of the nothing but the condition satisfied. How many years? Maybe 3 years. After 3 years only they will give at that price. Okay. So for every year you need to calculate the intrinsic value, right? So we have exercise price. What do you want now? What do you want now? Fair value. Nothing but market price. Correct or not? Yes. Okay, now you want a market. Sorry. When the market price is 110, exercise price how much, sir? 70 rupees. When the market price is 110, the exercise price is 70 rupees. This is the point they have given on 1/4/2017. This is on which date, sir? Grant date. They are talking about grant date. The vesting date is 31st March 2020 and the exercise date is 31st March 2021. Which means 1/4/17 to 31st March 2020. How many years? 3 years. This is the vesting period. After that, they have given 1 more year to exercise the options. So, because we need to give some time to purchase the shares. Correct or not? Yes, company has to give some time. That is the 1 year is known as exercise period. We already discussed in first video. Correct or not? Yes. See, the company found that at the end of the year, when the company found that 100 employees had left an estimated The expected annual for feature. This is very, very important. Please underline the point. Annual for feature. Sir, first year ending 100 employees already left out of the organization, and estimating that. So estimate also we have to reduce from total employees. Correct or not? Yes. So in all the questions whatever we have discussed previously, they are saying directly 20 employees, 10 employees like that. But in this question they are talking in percentage. Not at the end of the year 2 or end of the year 3 they are talking about. They are talking about annual forfeiture. Nothing but every year 10% has to be reduced. Nothing but forfeiture, cancelled. They will left out of the organization. Okay. No, there is no need to book the expense for that employees. Because whatever the employees we are expecting in the organization remains in the organization, we need to book the expense. That is only the loss to the entity. If they exercise, then it will be the loss. We are expecting that. So in the year ending 1 only, I am expecting 10% for every year. Employees will get out. So they will not purchase the options. So it is not expense to us. So I have to reduce the employees. Correct or not? Yes. Yes. How much? 10%. See, you have to understand one more point. Suppose example, we have 1,000 employees. We have 1,000 employees. At the end of the year 1, 200 employees left. How much employees remaining? 900, 800. So we know that this point at the end of year 2 only. And year 1 only. Year 1 ending only I am expecting next year 10% and then next year also 10% will get left out. That means for next year ending out of 800 how many employees will be remain in the organization? 10% left out means only 90% of employees will be in the organization. Nothing but 720. Correct or not? This is for second year ending. So, and I am expecting about third year also in first year only. First year ending I am expecting, okay, second year 10% employees will go out. Next, third year 10%, again 10% employees will go out of the organization. So, I want, because the employees who will be remain at the end of the year 3 only will exercise the option. Not only at the end of the year 2 or end of the year 1. We have to consider the last year, right? So, this is the second year ending employees I am expecting, and third year employees another 10% will get out. So please calculate 720 into 90%, 648. So only 648 employees only will be remaining in the organization at the end of the third year. That is my expectation at the end of the first year. I think everyone understanding about this point. Clear? Initially 1000 employees. 200 left at the end of the first year. First year ending these employees 800. So I'm expecting at the end of the year 1, okay, next year 10% employees will go out and the next year 10% employees will go. So we can take directly 800 into 90% into 90%. This is the proper calculation and easy calculation. Clear? How much? 648. Because we are expecting 720 at the end of the year 2. Some people may got, sir, this 90%. That 10, nothing but the 10% we have to calculate on 800 or 1000 or 720. On which amount we have to calculate, I am not understanding. So this type of doubts may be arising for every student. Not every student, very few students. Okay. Generally our thinking will be like that only. So simple, sir. In first year ending, only 800 employees only left. Okay, I know this employees number at the end of the year 1 only. So at that point of time, I will expect for next years. So I'm expecting next year only 90% employees will be in the organization. Nothing but 10% will go out. So into 90%, 720. So whatever the employees remaining in the second year, out of that 10% only will go out of the organization, not on the first value, 800 or 1000 value. Correct or not? After second year, without completion of a second year, how can we calculate for third year? Correct or not? Yes. So that's why this is the calculation. I hope everyone understands. Next, EPS and PE ratio given 26 and 5 respectively. Sir, why this EPS and PE given? Is there any need for it? Simple, sir. Here, for calculating market price at the end of the, actually market price is changing here, simply. Market price is changing. Yes. Correct or not? Yes, sir. So at the end of the first year, I'm expecting, sorry, the EPS is, sorry, just wait. Okay. So PE ratio given and EPS given. So what is the EPS here? Earning per share is, sorry guys, small disturbance. So EPS is given how much? 26. And a PE ratio 5. With this value, what we can calculate? Anyone getting any idea? With these two values, why these two values given? Simple. So what's the P ratio formula? MPS by EPS. So we can calculate market price per share based on these two values. Correct or not? Yes. Every year market values get changing. Okay. So 26 is the EPS. P is a 5. So what is the formula? P equal to MPS by EPS. So MPS equal to EPS into PE. So 26 into 5. 130. So 130 is the market price per share. Yes. Next, at the end of the year 2, the company found that annual actual for fixed is 4%. Actually, at the end of the year 1, I expected 10% will leave the organization year 2, but actual expectation is only 4%. So now the employees will get changed. So out of 1,200 left out of organization in first year only, out of 800 only 4% left. That is nothing but how much percentage you have to take? 96% only will be in the organization. Correct or not? Yes. Next, re-estimate the expected annual for which rate of 5%. So every year from next years, the expectation is only 5%. Nothing but 5% will go out of the organization. That is nothing but only 95% only will be in the organization. That's it. Simple calculation. Okay now? Clear or not? Sorry, just wait. Okay? Correct or not? So, please calculate. Just wait. Out of 800, 4% means how much? 32. Okay. So, directly we can calculate 32. So, how much? 768. Correct or not? 768 is the balance employees at the end of the year 3. Out of this, you have to consider 5% means 95%. So, how much? 768 into 95. 730 employees something. Correct or not? This is the way of calculation. Okay, no? Okay. See, same 5%. Earnings per share and P ratio 27.4 and 4, 5 and 4. Next year 3, same for which rate was actually 10%. Okay. Next, P ratio given. Only 700 employees exercise the options at the end of the year 31st March 2021. This is the point you have to highlight. Face value is given. So year 1, year 2, year 3 for future values you have to find out. So solution is given, but we don't know how to calculate the values. So institute also given only the answers only, not solutions. Now you have to calculate the solution. Anybody please solve the number of employees for each year? Anybody please pause the video, please try it. Because very simple, based on the example what I have explained, you can easily solve that number of employees calculation. Seriously. Yes, anybody? Okay. Come to solution. And we can calculate market price for each value, each year. Sir, why we need to calculate market price actually for every year? Because so we have a exercise price. We have a exercise price. Every year market price is not the same. Every year is getting changed. So you have to consider the changed market prices only. Correct or not? Yes. Yes, based on the market price, you have to consider the expense or loss to the what are the loss company is getting. Is it clear? Okay. So first year, second year, third year, you need to calculate the market price. So exercise price we already know 70, 70, 70. We need to calculate intrinsic value. So that only you have to consider. So for that you have to book the expense. Correct or not? Yes. Come to solution. First of all, calculate intrinsic value. Particulars year 1, year 2, year 3. EPS P EPS P ratio. Please write neatly. 5, 4, 5. Sorry, reverse. 26, 5. 18, 5. Okay, this is the EPS and P ratio. Okay, now so now based on this we can calculate the NPS. 26 into 5, 27.5 into 4, 18.5 into 5, 18 into 5. So we got NPS, we already know excess price 70, 70, 70. We got intrinsic value 60, 40, 20. This will be used to calculate the expense. So you have to book the expense because it is a loss to the entity. We already calculated, so many problems we have calculated. See, this is the way of calculation directly. Calculation of employee benefit expense. That is, we need to calculate. First of all, year 1. So, see the question. Total how many employees? Actually, 2100 employees. 2100. Out of that, how many employees left? 100 left. So, balance 2000. Out of 2090, 10% annual forfeiture. Nothing but every year 10% will go out of organization. Correct? So, into 90%. Into 90% because 2 years, right? Second year ending, third year ending. So how much? This is the way of calculation. This is number of employees. For each employees we are giving how many options? 50 options. So take the 50 options. What's the value? What's the value you need to take? Intrinsic value. What's the intrinsic value? 60. So 60 is the intrinsic value. This is for 3 years. So we want 1 year. So into 1 by 3. Same calculation. Whatever we have some procedure. So but I calculated like this. If you want you can calculate like that also. But it is very simple. Okay, because annual forfeiture is there, right? So easy to calculate like this. How much? 16 lakh 20. This is the first year expense. First year expense. 1 year expense. That's why I have taken 1 by 3. For second year, come to second year, out of 2100 employees, 100 employees already left. Okay. So at the end of the second year, the entity expected that 4% will leave the organization. So 4% means how much? 2000 balance. 2100 minus 100 means 2000. 2000 into 4% how much? 80. 2000 into 4% 80. So minus 80 actually left. Based on remaining employees, 5% will be go out of the organization in next third year. So that's why I have taken 95%. Correct or not? Yes. This is first year employee I have reduced. This is second year. This is third year I am expecting. Next 50 options. Next 40. What is the 40 here? Intrinsic value. So 40 into 2 by 3. You already know about it. So for 2 years, this is the 2 years expense. I want second year expense. How I will get that answer. Sorry guys. Okay. How will I get that? So out of 2 years expense, you need to reduce the first year expense. So this is the 2 years expense minus first year expense. You will get this value. This is the second year expense. Next, come to third year. Out of 2100, 100 already left in first year, 80 already left in second year, and last year 10% will left. That is nothing but only 90%. You have to take 90 only. Into what's the intrinsic value? 20. Options how much? 50. 20 into 50 into 3 by 3, which means this is 3 years expense. This is 3 years expense Out of 3 years expense, you need to reduce first year expense and second year expense. You will get a third year expense. So minus 16 lakh 20 minus 8 lakh 12,000. You got this value, negative value, not positive value. You will get a negative value. Because please calculate. I have not calculated actually. See, 2100 minus 100 minus 80 into 90%, 1728 employees. How many employees? 1728 employees at the end of the third year. Here, 2100 minus 180 into 95%, 1824 employees. Here 1620 employees. First year running, second year running, third year running. Okay. So 1728 into 20 into 50 into 3 by 3. Okay. Minus 16 lakh 20,000 minus 8 lakh 12,000. How much? 7 lakh 4,000 is the negative value. Yes, I got a negative value, which means you need to reverse the expense. Because in second year, we have created extra expense. But I realized that that expense is more than actual expense. So I need to reverse that expense. So that's why negative. I need to write the reverse entry. So this is the year 1, year 2, year 3 expense. That's the question they are asking about. 1, 2. But the last is calculate value of options forfeited. So at the end of the year 3, okay, totally at the end of the March 31st, 2021, nothing but it is the last date for exercise date, correct? It is the last date for exercise date, this one. So 1700 employees only exercised the options. Actually, I thought 1728 employees at the end of the third year, I am expected 1728. Because at the end of the year 3, okay, all the employees left out, only 1720 is remaining. Okay, 1728 based on this, I have to create the expense. I thought like that. But at the end of the exercise period, only 1700 only exercised. That is nothing but this 28 is lapsed. Nothing but cancelled. Nothing but forfeited. So the question is asking about calculate the value of options forfeited. How many forfeited here? 28. 28 employees forfeited. 28 employees into. So at the end of the year 3, what is the intrinsic value? Are you getting my point? Okay, now. So total employees how much? Last year 28 forfeited. So 28 into. Okay, nice. How many options for each employee? 50 options. Okay. Okay. If we book the, so whatever the expense you have booked in third year for this 28 employees, 20 rupees. Correct or not? At the end of the year 3, we have booked for this 28 employees also. So I am calculating that 28 employees, what is the amount we have booked. So simple, 28 employees in each employee 50 into 20. How much? Please calculate. How much? So year 4, sorry, we have to write here only. You can write year 4, value of share forfeited equal to how much? How many employees? 28 employees into 50 options into 20 rupees, 28,000. How we will get this 28, 17, 28? Actually, at the end of the year 3, total employees I am expected, but only 1700 only exercise. That's it. Remaining 28 forfeited. Is that clear? Okay. This is question number 17. Examination point of view, very, very important. Okay, now. So, our last question, question number 18. So, we are done with this ESOP based questions and fair value method questions. Okay. So, 17/20/2018 AMLA, GILA and Tulsi Limited grants 100 options to each of 2000 employees at 60 when the market price is 200. The vesting date is 31st March 2021, exercise date is 31st March 2022. At the end of the year, when the company found that 100 employees left, fair value of our shares issued under ESOP is 93. Very important question. At the end of the year 2, the company found that 80 employees had left. Fair value of a share issued under ESOP was 104. At the end of the year, the company found that 192 employees had left. Fair value of share under ESOP was 80. Only 1700 employees exercised their options. The fair value of equity share is 10 rupees. Year 1 expense, year 2 expense, year 3 expense, value forfeited. This is for homework. Sir, what sir? Why homework sir? Please tell me sir, Andara. Same question sir, same question. Please think the logic. Just okay guys, we'll discuss in next video. Hello guys, good morning to all. Welcome to CFR classes. So today our next topic Ind AS 115. What is that? Ind AS 115. Very important standard. Okay, compulsory question from this standard. So what is the topic name? Sir, interview purpose also, many of the interviewers will ask this standard only. So there you have to give some briefly explanation about this standard. If you are well with it with this topic, you can easily crack the interview question also. Okay, now so very useful, very important. Clear. So revenue from a contract with the customers. Income. First of all, what's the meaning of revenue? Revenue means simply, suppose example, if you sell the goods to the customer, you will get some consideration, right? Okay. See, income arises in ordinary course of business. Income arises in ordinary course of business. Then you will get a consideration for satisfying performance obligation. Consideration. So you need to remember these keywords: performance obligation. Consideration for satisfying performance obligation. Okay, if the entity satisfies their performance obligation, okay, clear. For satisfying the performance, they will get some consideration from the customer. What is the performance obligation here? Simple, sir. I am the seller. You are the customer. My performance obligation to deliver the goods to the customer. Nothing but I have to deliver goods to you. That's my performance obligation. Your performance obligation is to pay the consideration, correct? Yes. Everyone have a performance obligation. So once satisfied my performance obligation, I will get some consideration, right? That is nothing but income arising in the ordinary course of business is nothing but revenue. Correct or not? Yes. Revenue from contract. What is contract? What is contract? A contract is an agreement which is enforceable by law. I think you already learned during your childhood, CMA foundation level. What is agreement? What is contract? What is offer? What is acceptance? What is counter offer? What is the invitation to offer? You already learned in CMA foundation level, right? So contract means same agreement, an agreement which is enforceable by law. It has to be enforceable. So both the parties has to give their consent. Both the parties has to give their consent. Correct? Yes. So revenue from contract with the customers. Clear? Suppose example, I entered into a sale contract with the customer. Okay. So my performance obligation is to deliver the goods. I already delivered. I got the consideration. Simple. Simple or not? Yes. See example, sale of goods. Performance obligation satisfied when the goods transferred to the customer. Yes. And the revenue has to be recognized at which price? Please note this. Transaction price. You should remember this one also. Transaction price. At a transaction price only you should recognize the revenue. Is it clear? What is transaction price? We have to see. Okay. We'll see later. Clear. Useful. Just wait. Information about nature, timing, and uncertainty of revenue. What is the nature of revenue? What is the timing of revenue recognition? What is the recognition time? What is there an uncertainty arises? Clear? So we have some general principles. Revenue recognized. Recognize revenue when the transfer goes to the customer and expected to receive the consideration. If we don't have any expectation to receive the consideration, then don't recognize. That is nothing but only uncertainty. We have some expectation about the consideration from the customer. That is nothing but certainty. Recognize revenue only when transfer goods to the customer or deliver goods to the customer and expect it to be received consideration. Not only receive consideration, sometimes the consideration may be received immediately or may not. So that's why the wording used expected to receive the consideration. Clear? Everyone? Is it clear? That is a general principle. General principle. Clear? Recognize the revenue when transfer goods to the customer and expect to deliver the consideration from the customer. That's it. That's the basic principle. Scope. An entity shall apply this standard to all the contract with customers except these standard will not applicable for all these. What are those? Lease contract 116. Ind AS 116 will applicable. Insurance contract Ind AS 104 will be applicable. Financial instruments 109. Next consolidation. Next joint arrangements. Next separate finance statements. Investment in associates or joint ventures. These are the standard names. If you want, you can note down. Otherwise, we have already in our book. Okay, no need to write. Clear. Index I have given. Okay, all these topics we have. 109 financial instruments. Okay, 110 consolidated finance statements. 111. It's also covered in 110. 27 also covered in 110. 28 also covered in 110. Non-monetary exchange borrowing entities between entities in same line of business. Non-monetary exchange. Suppose my company is oil company. Okay, I am selling oil to the customers. I don't have sufficient oil at that point of time, particular point of time. I have taken oil from other company and sell to the customer. And then after that, once I produced the oil, I gave back to that company oil. So this is nothing but non-monetary exchange. We are not giving any money here, just adjustment I have made. Correct or not? Between same line of business. Example to oil companies. So this is also we can say it's a contract only, but it is not covered under this standard. Non-monetary exchange between entities in the same line of business. Are you getting my point? Customer came to my company, my business, my factory or whatever maybe. I don't have sufficient oil. I have taken some oil from the particular entity. Okay, for fulfilling this contract with the customer. And later I gave back to him. I gave back to that company oil. Okay, once I have produced that. Clear? So this is also not covered under the standard days 115. Clear, everyone? Lease contract, insurance contract, finance instruments, non-monetary exchange between entities in the same line of business. Clear, everyone? Next, important definitions. Contract, you already know about it. An agreement that creates enforceable rights and obligations. Obviously, it leads to create enforceable rights and obligations to the customers and supplier. Both the parties, nothing but. Both the parties will get rights and obligations. That is nothing but a contract. I entered into a contract for Okay, my obligation is to deliver the goods. My right is to receive the consideration from the customer. Correct or not? Yes. Contract asset. An asset, contract asset means an entity's right to consideration in exchange for goods or services that the entity has transferred to customer. An entity right to consideration. So what is the contract asset for the entity? So I have a right to receive the consideration. Right to receive the consideration in exchange of, for what purpose I am getting that consideration? I'm exchanging the goods or services, sir, that the entity has transferred to the customer. So my entity transferring goods to the customer. For that purpose, I have a right to receive the consideration. I'm talking about entity point of view, right? Not customer point of view. Contract liability. What is the liability for me? Nothing but entity only I'm talking about. So an entity obligation is to transfer the goods to the customer for which entity has received consideration or due from customer. You will get a consideration from the customer. For that purpose, you need to deliver the goods, right? That delivery of goods is nothing but your obligation. Contract liability. Liability is nothing but obligation. Correct or not? Yes. Right to receive consideration is asset. Transfer or delivery of goods is nothing but liability. Contract liability. Contract asset, contract liability. Very clear. Standalone selling price. Selling price is directly given separately given. The price at which entity would sell promised goods or services separately to customer. So I promised to the customer I will sell the goods, promised goods or services separately at separate price. At separate price. That is nothing but standalone selling price. Separate selling price. Okay, I am sending different types of goods. Each type of goods has separate price. This is nothing but standalone selling prices for each product. Is it clear? Is it clear? That's it. See, these are the summary I have written here. Object or scope, definitions, recognitions, contract, cost, presentation and disclosures. Transition note. Summary, just summary. We need to learn everything. We are done with it. Next, recognition. I hope everyone got a clarity, sir. I want clarity. Simple way of learning, sir. Simple way of learning. Easily you can understand, sir. Even Telugu students. Okay. Clear? See, you want to recognize the revenue. You want to recognize the revenue in your books of accounts. An entity required to recognize the revenue in their books of accounts. For that purpose, they have to apply this 5-step model. Important for interview point of view also. 5-step model. Have to apply 5-step model. What are the 5 steps? Please give signal ready. Everyone, please, you have to keep it in your mind. Please identify the contract with customer, identify performance obligation in the contract, determine the transaction price, allocation of transaction price to performance obligation in the contract, recognize revenue when entity satisfying performance obligation. Everyone, please. Everyone, please guys, identify the contract with customers, identify performance obligation in the contract, determine the transaction price. Next, allocation of transaction price to PO in the contract. PO means performance obligation. Next, recognize revenue when entity satisfies a performance obligation. Correct or not? Yes. We'll see stepwise. Okay. What's step number 1? Identify the contract with customers. Step number 1. Identify the contract. If you want to identify the contract, 5 conditions need to be satisfied. Below 5 conditions need to be satisfied. Okay, now what are those 5 conditions? In a contract, generally we have 2 parties, right? Party 1, party 2, customer and seller. Example, for example, seller and customer. Our entity is nothing but seller. Customer is second party. So parties to the contract have approved the contract and commitment to perform performance obligation. Here, what is my performance obligation? Is to deliver the goods. What is the customer performance obligation? Is to give the consideration, right? So who are the parties to the contract? Have approved the contract. Contract must be approved. And commitment to perform the performance obligation. Commitment to perform the performance obligation. Are you getting my point? Clear? Yes. Parties must have a commitment to perform their performance obligations. You have commitment, sir. Okay, you should give commitment to that other party. Simple. Next, entity can identify each party's rights and obligation regarding goods or services to be transferred. Regarding goods or services to be transferred. You are the entity. You have to identify each party's rights, sir, regarding goods or services to be transferred. What is my right? My right is to receive the consideration. What is the other party's right? Receive the goods. Correct or not? What are those goods? What are those goods? You need to be specific. You need to be identified separately, clearly. So you need to identify each party's rights clearly regarding goods or services to be transferred. And also entity can identify the payment terms is very important, sir. What is the amount of revenue? For your transfer, you're delivering the goods or services, you have to receive the, you will get the consideration from the customer. So entity must identify that also properly. There should not be any uncertainty, sir. If the amount of rupees 1 lakh, it must be 1 lakh. Don't be like, so 1 lakh to 1 lakh 50,000 maybe. So don't, that limit should be there. That limit should not be there. I'm talking about, you have particular amount, sir. Particular amount must be there. That is certainty in that amount. If we don't know the exact amount, we don't have any certainty. It is nothing but uncertainty. That correct or not? Yes. So the entity can identify payment terms for goods or services to be transferred. You have to identify the payment terms and conditions, everything. You have to talk with that customer and come to decision. Come to one, conclusion regarding the price. Contract has a commercial substance. What is commercial substance? I already discussed in Ind AS 16, right? See, exchange of goods or services. See, in case of a commercial substance means a simple, sir. Whatever the cash flows we are getting must be nothing but does not equal to the cash flows. Whatever simple, sir, outflows and inflows shall not be same. If both are same, there should not be any commercial substance there. Commercial substance means must have, and the entity must have some benefit to that. Entity must have some benefit. Otherwise, we cannot say it's a commercial substance. If you are exchanging similar goods or services, Ind AS 115 not applicable. Only dissimilar things only will be involved here. Dissimilar. Suppose example, I am giving 10 lakh value of asset. I am taking 15 lakhs value. Dissimilar, similar, dissimilar. So Ind AS 115. If it is both are similar, if there is no benefit, then Ind AS 115 not applicable. We cannot say it's a commercial substance also. Commercial substance means we need to consider dissimilar things only. Transaction price equal to fair value of the consideration received. Okay, we'll discuss about it later. I think everyone got clarity about this commercial substance. Okay, now you should consider dissimilar things only. Dissimilar, not similar. Okay, now it is probable that entity will collect substantially all of the consideration. Nothing but certainty. It is probable that, probable means more than 50% chances. So entity will collect the substantially all of the consideration. Suppose example consideration value is 1 lakh. I have a certainty is there, collectability certainty, collectible certainty. Okay, I can collect from them of rupees 1 lakh. This 1 lakh is nothing but we have a certainty here. Certainty here. We are not receiving 1,99,000 only. So that is nothing but substantial amount. Substantial means more than 90%. Generally, we can say that substantial means more than 90%. Okay, now so majority amount you are receiving simply. Then also we can consider it is probable that the entity will collect substantially all of the consideration or part of the consideration. That is nothing but certainty. When these five conditions are satisfied, we can say the contract is there. We can identify, that is nothing but identifying the contract. When you identify the contract, it has to, if you want to satisfy the step number 1, it has to satisfy 5 conditions. One is parties to the contract have approved the contract and commitment to perform the performance obligation. Entity can identify each party's rights and obligations to be transferred, goods or services to be transferred regarding. Entity can identify the payment terms also, contract or commercial substance also. It is probable that entity will collect substantially all of the consideration. If these 5 points are satisfied, we can say contract is there. Identifying the contract. Step number 1. Very important. Clear? See, we have exception point for point number 1. What is that? See, step number 1. Non-fulfillment of a step number 1. Even if there is no contract initially. See, but the entity still transfer goods or services to the customer and receive non-refundable consideration in exchange for those goods or services. In that case, entity cannot recognize the revenue for non-refundable consideration received until either the step number 1 criteria is subsequently met or one or more has occurred below. The point is saying that simple point, sir. Step number 1, contract is not identified. Okay, but still goods transferred to the customer. This is the one case. Okay, entity still transferred goods to the customer and receive non-refundable consideration in exchange for those goods or services. Simple. Suppose example, I have started coaching. CFR subject is suppose example 5,500 from next batch. So suppose example, I have started a face-to-face classes. Okay, suppose example 100 students attended. Sorry, 99 students attended, 1 student not attended. But payment made for 100 students. That student has some issue. Okay, the student has some issue actually. Sir, I'm unable to attend for this batch. I want to refund the money. So initially I said that no refund. If you want, you can attend for next batch. I said like that. Or you can take the recording classes, whatever. Okay, but you want face to face only. Okay, guy, you can attend for by next batch. Or if you suppose example, if we absent for 1 month, present for 1 month, for balance 1 month, you can attend in next batch. So these are the scenarios. Possible, right? Possible or not? Yes. In that case, entity cannot recognize the revenue for the non-refundable received consideration received until either the step number 1 criteria are subsequently met. What is the non-refundable consideration? Suppose example 5,500 is the fees. He did not attend completely at all. So 5,500 I will not refund. We can say it's a non-refundable consideration or not? Yes. Initially, generally don't recognize. But these 2 points. The entity has no remaining obligation to that transfer goods or services to the customer, and all or substantially all of the consideration promised by the customer have been received by the entity and is non-refundable. So initially I said to that person or student, bye, hello Babu, we are not giving any refund to you. Okay, I don't have any initially I said that point. So I don't have any remaining obligation to transfer goods or services. No need to provide service, right? This is service. No need to provide service to the customer. Okay now. But the money received from the customer. Correct or not? See. And all of the consideration or part also may be considered. If it is 5,500, he paid 3,000 only. That also considered. Promised by the customer. Consideration promised by the customer have been received by the entity. You received that already. But it is not refundable. In this case, you can recognize the non-refundable consideration also. And the contract has been terminated. Contract has been terminated. See, contract has been terminated and the consideration received from the customer is non-refundable. So initially I said that if you want a class, you can attend for this batch only. No need to, don't join for by next batch. We are not giving that opportunity for you. This is nothing but he did not attend for that classes. Nothing but the contract has been terminated. And the consideration received from the customer is non-refundable. Yes, I will not refund. I need to recognize in my books of accounts. In both the cases. In both these cases, you can recognize the revenue in our books of accounts. Otherwise, don't recognize. That is the point. Everyone getting clarity about this? Clear? Everyone? I have discussed about objective, scope, next basics, performance obligation, next general principle, important definitions, next summary. Okay, summary, leave it. Recognition. Correct. 5 steps. On that I discussed that step number 1. Clear? Okay. We'll discuss in next video step number 1, problems, and one. Okay, guys. Next, contract modification. What is that? Contract modification. Modification means change. So once you already entered into the contract and then we have done some modification in that contract, that is nothing but simply we can say that contract modification. So contract modification exists only if these 3 conditions are met. What are those 3 conditions? See, there is a change in the scope or price or both. Scope means, suppose example, I ordered 100 books initially I ordered 100 books. Okay, that's my contract for rupees 100 rupees each book. Okay, clear? See, after that, suppose example he delivered 50 books initially, and that after I said that so I want a extra 100 books. I mean totally 150 books I want. That is the change in the scope. Whether it may be increase or decrease, whatever may be. It's a modification only. Modification. Or suppose initially the book price is 100 rupees. Now I am taking books at 80 rupees only. Balance 50 books. Or balance 100 books at 120 rupees. That is the change in the scope or price or both. Both also possible. We can say it's a modification only. That is approved by both entity and the customer. Must be approved by the both entity and the customer. That's the important. Okay, are you getting my point? The change is approved by both customer and the entity, and the change is enforceable. Okay, it should be as per contract. Okay, now clear? If these 3, you must write these 3 conditions in case of a contract modification. There is a change in a scope or a price or a both. That is approved by the customer and the entity. Change is enforceable. Legally possible. Okay, enforceable means simply legally possible. We can say that. Clear? So now we want how to account that modification. How to account? We have almost 4 to 5 questions. Okay, I will give few examples and immediately I will solve the questions also. Don't worry. See, in that first one, scope of the contract increases because distinct promised goods are added to the contract. So scope of the contract increases, which means, suppose example, initially 100 goods ordered, 100 books ordered, and then it was changed to 150, example. Distinct promised goods, different promised goods added to the contract. And the consideration increases by standalone selling price of the added goods. Whatever the adding, whatever the goods are we are adding, are you getting my point? What are the goods we are adding? It has separate selling price. Are you getting my point? Yes. Consideration increases by standalone selling price. Clear? What is accounting? Accounting for modification as a separate contract. Whatever you are modifying right now, whatever the additional goods you are adding right now, so treat it as a separate contract. Treat it as a separate contract. Are you getting my point? Clear? That's the first one. That's the first one. Everyone clear about it? Simple. Suppose example. Initially I ordered 100 books at the rate of 100 rupees. 50 already delivered. 50 already delivered. Okay. 50 already delivered. So the customer says that I want extra 50 books, 50 different books at the rate of 90 only, or at the rate of 110 only. This modification is there, right? This should be accounted separately. That's it. 50 into 110, 55,000. That's the answer. Simple. Account separately. Don't include in overall value. That's the point they want to say. See. So, okay. Come to next second point. Consideration increases by standalone selling price of the added goods or services. What's the second point? Consideration increases by standalone selling price of the goods or services. Okay, we are done with it, right? Correct or not? First, scope of the contract increases because distinct promised goods added to the contract, and consideration increases by standalone selling price for the added goods. So account it as a separate contract. Account for modification as a separate contract. Clear? Are you getting my point? So go to simple example. You will understand. You will get understand. That's the first one actually. Second one is remaining goods or services from the goods or services transferred on or before the date of contract modification. Termination of old contract, creation of a new contract. This is a second case. What is that? Remaining goods or services distinct from the goods or services transferred on or before the date of contract modification. Are you getting my point? Okay, just wait. See this example first. First, scope of the contract increases because distinct promised goods added to the contract, consideration increases by standalone selling price, right? Okay. Chet Limited agrees to sell 200 units of product A to customer for 3,20,000, 1,600 per unit. Clear? Product A transfer over to customers from 1/1/2019 to 30th June 2019. Product A transfer over to customers from 1/1/2019 to 30th June 2019 for a period of how many months? 6 months, right? 6 or not? Yes. On 31st March 2020, after transfer of control of 100 units of A, contract modified to deliver additional 50 units at a market price of rupees 1400 per unit to be delivered in the following 3 months. Show accounting in the books of Jet Limited. Are you getting my point? Okay, clear? So see, simple question, sir. So Jet Limited entry to agrees to sell 200 units of product. That is the original contract for rupees 3,20,000. Correcta? Yes. So అయితే sir, simple అండి. Product A transfer over to customers from 1/1/19 to 30th June 2019 for a period of how many months? 6 months. Okay, over a period of time, they have to Jet Limited has to transfer the goods to the customer. Okay, on 31st March 2020 for a period of 3 months. After 3 months, after transfer of control of 100 units of A, how many units already sent? 100 units are sent to customer. Correct. Out of 200, 100 already transferred. Transfer of control. So control transfer is already delivered to the customers. Contract modified to deliver additional 50 units at market price of 400 units to be delivered in following 3 months. Additional 50 out of 200, 100 already delivered. So additional 50 they want. We have to deliver. This is the modified contract at a 400 rupees only. If you read the first point, it will be clearly matched. Scope of the contract increases, yes, because distinct promised goods add to the contract, yes, and the consideration increases by standalone selling price of the added goods. Here added goods is 50. Standalone selling price is 1400. Correct? Yes. Simple sir, bacha question. See, original contract after 31st March 2020. Original contract transaction price equal to 1,60,000. 100 units transfer, 100 into 1600, 1,60,000. So revenue should be recognized. Transfer to P&L. That is for 1920. Sorry, 1819, no 1920. 1819, sorry, 1819. Oh, just wait. The dates is different. Just wait, guys. I will check the date. Okay, guys, the day. Please change the date. So 20 only. Yes, clear. So we delivered up to 31st March 2020 100 units. Okay, additional for 50 is the modified contract, right? Contract modified to deliver additional 50 units at market price 400 per unit. 400 or 1400? 1400 per unit. Clear? Right. In the following 3 months. Yes. See, original contract we are done with it. Revenue recognized should be transferred to P&L of rupees 1,60,000. 1600 into 100. 1,60,000. Correct? Yes. 100 is already delivered. Transfer of our performance obligation also satisfied. Satisfaction of performance obligation. Yes, we are done with it. 100 goods delivered. 100 units delivered. 1920. Balance 100 units is there, right? So our contract is for 200 units. 100 already transferred. In that particular year, 100 units is pending. So balance 100 units revenue will be recognized when PO satisfied. When PO satisfied. Performance obligation means here you have to deliver the goods to the customer. That's a performance obligation satisfied. So and at that point of time you need to record that 1,60,000, right? Yes. For modification, we have delivered 50 additional units at the rate of 1400, 70,000 to be recognized as a revenue when, sir? When the satisfaction of PO. That's the main importance, sir. Control should be transferred. Control should be transferred to the customer. Is that clear? Satisfaction of a performance obligation. So additional 50 units need to be transferred to the customer. At that point of time, you need to recognize the revenue. How much, sir? 1400 into 50, 70,000. At that point of only the control will be transferred. Is it clear? Yes. Everyone got clarity about this? Yes. Right. Next, come to point number 2. Remaining goods or services distinct from the goods or services transferred on or before the date of contract modification. Contract modification. So termination of old contract, creation of a new contract. Termination of see example. Suppose example, I got an order for 200 chocolate boxes. 200 chocolate boxes from the customer. I delivered 100 already. 100 already. Okay. Balance how much? 100. The customer is saying that what are the remaining goods or services here? This 100 is the remaining goods, right? Remaining goods. Clear? Correct or not? Yes. Remaining goods or services are distinct from the goods or services transferred on or before the date of contract modification. You already delivered 100 chocolate boxes, right? That is, suppose example, it is a Cadbury. Example, it is a Cadbury chocolate boxes. The customer is asking that whatever the goods, whatever the chocolate boxes you have delivered on or before the modification date, that is not the remaining goods. So question is saying, the point is saying that remaining goods or services are distinct from the goods transferred already. So you have to send the new goods. So customer is asking that, sir, I don't want that Cadbury. I don't have a lot of demand for that. I want 5-star chocolate boxes for the remaining goods. Okay, so this may be the 5-star. Now, what is the accounting here? Termination of a old contract. Termination of old contract, creation of a new contract. Nothing but account separately. This is the 100 Cadbury chocolate, suppose example 180 rupees, 1,80,000. Sorry, 18,000. Now it is 150 rupees only. 100 into 150, 15,000. Are you getting my point? Are you getting my point? So total 200 only in this example. In this example, total 200 or more than also. Sir, I don't want 100 5-star chocolates. I want 150 chocolate boxes. So you can give 150. So the point is saying that in the standard, treat them separate contract. It's the old contract, termination of old contract, creation of a new contract. Because old contract get terminated because now we are the customer is asking not that Cadbury chocolates. They're asking about what is that? What is that, sir? 5-star chocolates. Clear? Clear? Are you getting my point? Clarity? Are you getting clarity? Yes, that's the second point. Full clarity, sir. That's the best example. Next, remaining goods or services not distinct. Remaining goods or services not distinct and therefore forms part of single performance obligation that is partially satisfied at the date of contract modification. Account for the contract modification as if we are a part of the existing contract, that is adjust to revenue. Adjust to revenue made on cumulative catch-up basis. Sir, I am not understanding this one. I want a best example. Yes, I have a best example for this. And then we'll come to this theory, you will get understand. Ready? Yes, come. Example number. Sorry. Yes. Example 3. Clear? Okay. Clear? Okay guys, this is the example for the third case. What is that? Cumulative catch-up basis, right? Cumulative catch-up basis. So once again, please read this. Remaining goods or services are not distinct, not different. I think you got clarity about the second one, right? See. Therefore, forms part of a single performance obligation that is partially satisfied at the date of contract modification. account for the contract modification as if it were a part of the existing contract, and that is adjusted to revenue is made on cumulative catch-up basis. Simple, sir. Very simple. Okay, come to example. Then you will get understand. See, original contract price of the project is 50,000. So this is the original contract price, 50,000, right? Clear. Based on the estimation 200 production hours at a rate of 250 per hour. So based on the estimation, so total how many hours required? Total 200 production hours. Per each hour 250 rupees. Okay, per each hour 250 rupees. Total how much? 50,000 we are charging from the customer, right? So they're providing a service 250 per hour. After revenue recognition for 100 hours, the contract is modified to increase required hours by 50. After completion of 100 hours, we decided that balanced 100 hours is not sufficient. We want a 50 more. We want a 50 more modified to increase the contract is get modified to increase the required hours by 50. Total how much? Total how much? 250. Total 250. And we are done with 100 hours already. You can recognize that 100 hours. Balance 150 you need to recognize. Correct? Yes. At hourly rate of rate by 200. This is the first case. Second case, at hourly rate of 200 for remaining hours. Third case, at hourly rate of 200 for total hours required. Initially 250 per hour. Initially 250 per hour. Okay, original contract price. First case is saying that hourly rate is 200, completely 200. Next, hourly rate is 200 for remaining hours only. Hourly rate of 200 for total hours required. 200. Are you getting my point? Clear? Just wait. First case one, take case one. Hourly rate for 200 for. What is that here? That extra hours is there, right? Extra hours. How much? Extra hours only 50 only, sir. Correct or not? That for that 50 only 200 rupees. Hourly rate by 200. Hourly rate by 200. Are you getting my point? Sir, total 200 hours, sir. 100 hours already completed. After revenue recognized for 100 hours, the contract is modified to increase by 50. So for that extra 50 hours, 200 rupees per hour. Second case is okay. So come to question number 1. Case number 1. At a hourly rate of 200 per 50 hours. Very important in case of a modification. Clear. First, particulars hours rate amount. This is the original contract 200 hours. Original contract how many hours? 200. 250 is the rate per hour. 50,000 is the total original contract price. Correct? Original contract price 50,000. Is it clear? Now the modification of hours is 50 hours per hour 200 rupees. Total 10,000. Total 10,000. Clear? Clear or not? Now the cumulative catch-up price. The calculation is simple, sir. What is the total amount here? 60,000, right? Total amount 60,000. Total hours how much? 250. Total hours how much? 250. Then we can calculate this rate per hour or not. Say sir, no sir. Cumulative means total. Total how many? What is the amount? 60,000. How many hours? 250. What is the rate per unit? Rate per hour. Then it will become 240. 60,000 divided by 250. You will get a 240. Are you getting my point? This is the adjustment. This is the adjustment to the revenue. See, remaining goods are not distinct. Just hours increases. Okay. Then therefore forms part of a single performance obligation. That is completely single performance obligation only. You have to complete within 250 hours. Sorry, 200 hours, right? 200 hours initially, but it was just increased, right? That's it. That is not different. That is not different. That is remaining goods are service. Here the service is not distinct. Therefore forms part of a single performance only. It is the only single performance obligation that is partially satisfied at the date of contract modification. Please tell me. Clear? Account for the contract modification as a if for a part of the existing contract, that extra 50 hours also treat it as a existing contract. It's a part of existing. So that's why adjustment to revenue is made on cumulative catch-up basis. Now come to solution. The revenue already recognized how much? We can't change it, right? But we should recognize the 240 per hour only. This is the cumulative catch-up price, right? So, but we already recognize the 250, 25,000. This is already recognized. But the modified recognition how much? At a 240 only. So 100 into 240, 24,000 only. You need to recognize 24,000, but you already recognize 25,000. That 1,000 should be adjustment to the revenue. So adjustment for past revenue recognition 1,000 rupees minus. This is for 100 only. So total how much? 250. 100 already done. So balance how much? 150. 150 at which price? 240 only, sir. Total should be 240 only. So that's why 150 240, that's 6,000. It is in future. Revenue recognition future. This question is given in your study material also. Okay, now the case number 1 is for balance 50 hours only this 200 rupees. I think everyone got clarity. First initial original contract, next modification. Total you will get a cumulative catch-up price, average price. Like you should recognize that price only, but you recognize that 250, 100 into 250, 25,000. This is already recognized. You need to change it. So actually modified recognition at 240 only, 24,000, right? So you need to adjust that revenue. This is revenue recognition future, simple. Now the second point is for remaining hours. Total 250, 100 already done. Balance how much? 150. So for that 150 hours, 200 is the price. So come to solution. First take revenue recognized actually how much? Revenue already recognized 200 into 250, 25,000. 25,000. Remaining hours modified for remaining hours total how much? 150 at how much? 200. 3. How much? 55,000. 250. Balance how much? Price 220. 55,000 by 250. How much, sir? 55,000 by 250. Then you will get this price. In previous question we have taken like this 200 plus 50. Why original contract we have taken here? That is 200. Modification is only for 50 only. Modification is only for 50. Now 150. So the balance 100 is how? What is that? Already recognized, right? So 100 into 250, 25,000 already recognized. Modified is 150 at 200. 30,000 total 55 by 250, 220. You need to recognize the 220 only. So modified recognition how much? You recognize at 250. Correct? But actual recognition at 220 only. So 100 into 220, 22,000. So the balance 3,000 will be reversed. This 150 also at 220 only. 150 into 220, 33,000. Simple. It is future. Revenue recognition future. I think everyone got a full clarity about this question. Right now. Clear? I think third question you can solve by yourself. Total 250 hours at 250 hours at 200 only. Try, please pause the video, please try yourself. 100 already recognized at 250, but the total 250 at 200 only right now. So just you need to reverse. Yes, simple sir. Direct modification for total hours 250 hours at 200 only 50,000, but you already recognized at 250. 100 into 250 25,000. Modified 100 into 200 only you need to take, so 20,000. Balance 5,000 reversed. Future recognition 150 into 200 30,000. Anything difficulty in this question? Anything? Nothing difficult, sir. Nothing difficult. This total 250 at 200 only. Okay, but initial 100 hours recognized at 250. So you need to reverse that. You should recognize this 100 hours also at 200 only. So balance 5,000 will be reversed. Very simple question, sir. Very simple question or not? These are the three cases. The three cases very important for your exam. Examination point of this modification is very important. Sir, modification exists only when three conditions exist. There's a change in scope or a price. Correct or not? Yes or no? That's approved by the customer and the client. Entity and the client. The change is enforceable. You need to write the 3 points also in case of this modification. Clear? Now we are done with the modification. Next, come to step number 2. I think we are done with step number 1, right? We are done with step number 1. Identification of a contract. Contractor need to satisfy the 5 conditions. Okay. And then what you have seen that non-fulfillment of a step number 1 and combination of a contracts. Correct? And then this modification, right? Modification of the contract, right? Yes. Next, come to step number 2. Identification of a performance obligation. So you need to identify the performance obligation. Sometimes in a contract they're having a more than one performance obligations also. First of all, what is the meaning of performance obligation? Simple. Whatever you have given the promise in the contract to the customer. Okay. That is nothing but performance obligation. Suppose example you said that you have to supply the goods or you have to provide the services, whatever may be. Okay. So I think in that case, sometimes more than one performance obligation also will be there. You need to identify. So the question will be asked like that. How many performance obligations in this question, in this contract? So they will ask like that. You need to answer that. See, promise in a contract with the customer to transfer the customer either the goods or services that is distinct or series of goods or services substantially same and they're having a same pattern of transfer to the customer. Simple. Whatever the goods or services you are providing that is distinct, if it is distinct, we can treat it as a one performance obligation. What is distinct actually? Distinct means customer can benefit either alone or with readily available resources. Separately identifiable from other promises in the contract. In a contract, suppose example, we are providing a broadband services. Okay, so come to we have an example also, don't worry. Okay, see, okay, example, see, construction service company. We are the construction service company. We are, okay, in a contract, we are providing different types of services. One is main is water purification, overall project management, engineering and design services, test flow volumes. Are you getting my point? Are you getting my point? So generally, everything we are providing in a single contract. In a single contract, the contract includes all these four. Performance obligations. Sir, construction service means you need to, okay, water purification plant you need to install. First point is water purification plant you need to be installed. That's the main point. And you need to overall project management, engineering, designing services you're doing, and the test flow volumes also you need to do. All these are part of this contract only. Correct or not? Yes, all are the part of one contract only. So we can treat it as a single performance obligation. Are you getting my point? So come to definition. Goods or services that is distinct. Now in this case, see, all are not distinct. Customer can benefit either alone or with readily available resources. Simple, sir. Without test flow, what are the cases? What are the example there? Okay, without test flow volumes or engineering or designing services, he cannot use this water purification plant. Correct or not? Yes or no? So customer cannot benefit alone. Correct or not? Yes. That's the one example, sir. I'm saying we have a lot of examples. In this case, we cannot separately identifiable from the other promises in the contract. Okay, suppose the example water purification plant installing by one party. Okay, you are taking test flow. Okay, the test flow for any other party is possible. So generally, whoever the installing, okay, that party only will test that, right? So generally, we cannot separately identifiable from other promises in the contract. Correct or not? So that's why these four are a single contract only, single performance obligation. Sometimes we are providing audit services or accounting services for a period of 1 year. Series of goods or services substantially same, and that have same pattern of the transfer to the customer. Same services we are providing for a period of 1 year. So we can treat it as a one performance obligation. So for example, I am providing accounting services as well as the GST services, income tax services, something. So all services I am giving for a period of 1 year. We discussed at one point of time only, and we decided one price only. Yearly I want 5 lakhs. So this is the series of goods or services substantially same. Most of the services we are giving same for every month also, right? Accounting or a GST or whatever maybe. Correct or not? Yes. Identification of a payable. See one more example. A Limited providing a broadband services. I think everyone knows about it. And voice call services and modem services. Modem. I think everyone knows about that modem, right? Okay. Simple. Sir, customer can benefit alone also. Sir, I am providing broadband services. If the customer can take voice call services from any other, modem services also can be taken from any other person. So it is not dependent on this one, right? Not dependent. Correct or not? Yes, then we can say here there are 3 performance obligations. Even you are taking from the single party, but we can say these are the 3 performance obligations. Completely 3 are different. Are you getting my point? Please understand that theory. Otherwise, we cannot understand this. If the goods or services that is distinct, okay, here yes, they are distinct only because customer can benefit either alone only he can benefit. Alone means singly. Separately we can take from any other party also. All the services cannot be provided by single person. We can take three services from three different persons or three different parties also possible. At that time, we can say it is a different performance obligations. Nothing but three performance obligations in this case. Are you getting my point? Clear or not? Okay, guys, we are done with two steps, right? Two steps. We have three steps pending. Before going to that, okay. So please note down these two examples also regarding step two. Site preparation, assembling of a plant, test running. We already discussed one example like this. So it's a single performance obligation. But in case of C, one need to install a central AC and water plant. Is there any connection between these two? No connection. So we can say it's a separate performance obligations. So two performance obligation here, one. Okay. Next, customer options for additional goods or services. What are the options for customer in addition to the goods or services? So they have discounts, rebates, discount vouchers. I think everyone knows about it, right? We have seen in a discount vouchers will be there. Correct or not? Yes or no? Yeah. So these are the customer options. We have a lot of options. Okay. So one of that we are going to discuss is a discount voucher. What is it? Discount voucher. So very important in previous exam, very last attempt. In the very last attempt, question came from this. Same question. Copy paste this question. Okay, now. So this question is beyond that question. Okay, now. So that question is simply just wait. Yes. Yeah, this question number 12 is there. This is the exact question from your study material. Copy paste this question. Okay. I'm going to discuss the similar question as an example. Once we are done with the example, we'll go to that question. You can easily solve it, right? Is it clear? Simple, sir. Customer option for additional goods or services. In addition to the goods, we are giving some discount vouchers. Giving a discount vouchers. I think everyone say if you go to Trends or what or Peter England or US Polo. So I think I have not seen the US Polo vouchers, but I have seen Trends vouchers I have seen. Okay. So by using, they will give, if you purchase up to 2000, if you purchase more than 2000, will give 500 discount. If you purchase more than 5000, they will give 1500 discount. You can use three vouchers. Each voucher value is 500 rupees. So like that will be there. I already seen that type of vouchers. I think everyone knows about that trends vouchers. Correct? Yes. See, come to example. On 31st March 2020, A Limited sale of goods for rupees 4000. Sale of goods for rupees 4000 to the customers. A Limited sale of goods of rupees 4000 to the customers, granting 50% discount to be availed in future purchase up to 3000 within 30 days. Okay, present sale of goods is 4000. If you purchase up to 3000 within 30 days, you will get 50% discount in future. They are talking about a future. Yes, sir. If you purchase today, they will give vouchers on that day. It will use in next time. So that too you have to use in within 30 days. Then only you will get discount. That's the question. Practical example. So please feel it is a practical example. Okay, you are the customer here. Okay. Actually, you have to think for this question, for this standard, you need to think in entity point of view only. Entity point of view, okay, now? Clear. Next, ordinary discount 10% on sales for all. For every customer, they will give 10% discount is common. For every person, 10% discount is common. 60% probability that customers will redeem discount voucher and estimated amount of purchase is 2000. So entity is expecting that 60% of a customers, 60% probability of a customers will redeem that discount voucher. So because all the customers will not redeem the vouchers, correct or not? Yes. Yes, I have not used it even one time also. Seriously. My brother used it one time. Yeah, yeah, I've seen that. An estimated amount of purchase is 2000. So this is expecting by the entity. Entity is expecting that because estimated, okay, 60% of probability that customers will redeem discount vouchers and estimated amount of purchase is 2000 only. Okay. Ordinary discount will not be availed to avail 50% discount voucher. Whoever is getting 50% discount voucher will not get ordinary discount. Will not get ordinary discount. 50% discount is different, 10% is different, sir. 10% is different. 10% is given for all. If you're taking 50% discount voucher, it included the 10%. Separately 10% discount they will not give. They will not give if you're taking a 50% discount voucher. If you are going to avail a 50% discount voucher, they will not give ordinary discount of a 10%. That 10% is a inbuilt, not separate. That is only for ordinary customers. Other than 50% discount voucher using customers only, they are giving 10% normal discount. In April 2021, discount vouchers are redeemed for purchase of additional goods for rupees 2,800. Find revenue, recognize revenue 2019-20 and 2021. This question is in extension of that question. In last attempt, they have given that question given for up to this one only. I think yes. Yes, this question. But I am explaining the example is beyond that. Okay, you will get understand. Just wait. First of all, I am asking about here. But sale of goods is one thing. Sale of goods is one performance obligation. Second performance obligation is discount voucher is second performance obligation. Correct or not? Yes. Discount voucher is second performance obligation. Clear? Yes. Here, two performance obligations we have. One is sale of goods. Second one is sale of discount vouchers. They are going to sell. If you purchase up to 3,000, they are giving 50% discount for future sale. Sorry. How much? Sorry. Just wait. They are giving a discount 50% to be available in future purchase up to 3,000. Future purchase up to 3,000, they will give 50% discount within 30 days. That too within 30 days. Okay, very nice. See here. Performance obligation 1, performance obligation 2. Performance obligation is nothing but product. Performance obligation 2 is discount voucher. Correct? Yes. Sir, if you purchase the product, suppose example, for customer point of view, 4,000 is the sale of goods. We are giving a discount of rupees 10% in all sales, general sales. So 4,000 minus 10%, how much? 3,600 is the purchase, sale of goods, right? Product sales, how much? 3,600. But come to second case, discount voucher. See, 60% customers will redeem discount voucher and estimated amount of purchase is 2,000 only. So we are estimating the purchase amount general up to 3,000. They are going to avail 50% discount voucher. But here only 2,000 only we are expecting. So expected amount of purchase is 2,000 only. But we are giving discount. Discount how much? How much discount? 50% or 40% or 60%? Sir, generally 50% discount, but it does not, don't include that general discount. General discount is 10%, right? So that is available to everyone. So what is the benefit we are getting extra? 40% only, right? So 50 minus 10, 40%. 2,000 into 40%, how much? 800, right? 800. Okay, that is good. But not all the customers are going to redeem the discount voucher, sir. How much percentage? Only 60% probability that customers will redeem. So out of that 800, 60% probability is only there. Into how much? 480. 680, 800 into 60%, how much? 480 only. That is only the price of a discount voucher. I think everyone got clarity about this. If the question is saying that the purchase is up to 3,000, right? If it is 3,000, you need to take 3,000. If it is 2,500, the question is given, given the question is 2,500, you need to take 2,500 only. So that how much, sir, is the estimated purchase? How much? 2,000 only. 2,000 into 50 minus 10%. Why I am reducing the 10%? Because this is given to everyone. What is the extra we are giving? Discount voucher. Value is 40% only. So 2,000 into 40%, 800 only. That is the discount value. But expected probability of customers redeem the discount voucher is 60% only. So you need to take 60%. So how much? 40, 480. Sorry, 480. Clear? I think everyone have a clarity about this. So total price is 4,080. Okay, now price of the product is 3,600. Discount voucher value is 480. Total 4080. But here, in case of a sales, the sales value is only 3,600. Correct? So the transaction price is 3,600 only, sir. We will not take extra charge for discount voucher, right? But just we valued that. So nothing but this. Now what you need to do, simple. This 3,600 should be allocated between product and the voucher. Correct or not? Yes. Now you can allocate. Transaction price is 3,600. Selling price minus 10%. It is allocated between product. Performance obligation 1 and 2 proportionately for first one. For goods equal to 3,600 into 3,600 is the product price. Total is 4080. 3,600 by 4080. For discount voucher, 480 by 4080. 480 by 4080. You will get these values. Sir, total sale of price is 3,600, but we are charging a discount voucher. We need to allocate. Sir, entities point of I am talking about. So entities total charging 3,600, but they are giving a 424 value of a discount voucher they are giving. Yes. So the balance only the amount allocated for goods. So now you need to, as per Ind AS 115, sir. Now you need to recognize the revenue of rupees 3,176. This is the revenue, actual revenue. But this 424 is not you are giving right now. This is discount you have to give in future. So that's why we can treat it as a contractual liability, contract liability. So discount voucher carried liability 424. Because this 424 is not incurred by you right now. Still, even you have received 3,600, but 3,176 only is the revenue. Balance amount you already taken. Okay, but you need to provide the service in future. It's a liability, it's an obligation. You have an obligation to provide the service in future. So we can call it as a liability only. Yes, we have an obligation, means liability. So discount voucher carried liability 424. That's it. Clear? The question is asking about up to this point only in previous exam. But this is an extension. Next, come to next point. In April 2020, discount voucher vouchers are redeemed for purchase of additional goods of rupees. So after that they have used, in April they have used the discount voucher for 2,800. Okay, now. So see, liability will be recognized. Already you have recognized the liability of 424, right? Why, sir? Why you have not given any discount on that time? Now you are going to be giving the discount right now. So nothing but that liability will get cancelled, right? Yes, in previous year, okay. So 424 we recognize as a liability, which means we have to provide the service in future. But now you are providing the discount right now. You are providing the discount right now. Nothing but that liability will get cancelled. Correct or not? So liability will get cancelled. Reverse revenue recognized for that 424. when the discount voucher expired. We are giving 30 days only, right? So they correct or not? Yes, discount voucher time got, discount voucher expired. So you can recognize that 424. See, the transaction price for additional goods is 2,800, right? 2,800, but we are going to give 50% discount. We will give. Entity point of view, customer purchased with 2,800. I have to give 50% discount. So what is the amount I have charged from the customer? 1,400. So this is the revenue you need to recognize right now. Correct or not? But along with this, apart with this, we have discount voucher value also. You need to recognize that revenue as revenue, because in previous year, in March 31st, you received 3,600, but you recognized 3,176 only. That 424 recognized as a liability, not as a revenue. Now you need to reverse the liability and recognize the revenue. Present revenue is 1,400. Along with that, you need to recognize. You need to recognize that 424 also. Total 1,824. That's the total revenue recognized. The contract liability 424 added to the revenue. Yes. Yes, that's it. I think everyone have a perfect clarity about this question. Nothing doubt. I think so. I'm feeling like that. But if you have any doubts, still I will discuss one more time. Don't worry. See, come to question. I am the A limited. Very simple way of learning. This is very simple way of learning. I am A limited. I sold goods to the customer of rupees 4,000. So generally I will give 10% discount to all the customers. But I'm giving all the customers 50% discount voucher. I'm giving a 50% discount voucher if they purchase up to 3,000 within 30 days. Within 30 days, if they purchase the goods with up to 30,000 value, okay, I will give that 50% discount. But I'm expecting that 60% customers only will redeem the discount voucher. Okay, I'm estimating at that point of time the purchase value is 2,000 only. So by using that, so the estimate may be changed also. Yes, estimate may be changed. Are you getting my point? Estimate may be changed. Clear? Yes. Okay. So simple. First, so now here I have two performance obligations. One is sale of goods, second one is sale of discount voucher. But this discount voucher value is included in that value of sale price. Customer may don't know about it, but we have to know. We have to recognize in our books of accounts like this only. Are you getting my point? Everyone? Clear? Okay. Simple, sir. Very simple. So total price is 3,600. Okay, I want to calculate the discount right now. So I'm giving a 50% discount, but I'm giving 10% discount to all the customers. Nothing but the extra discount is how much? 40% only. I will not recognize the 10% discount. Correct or not? The 10% is for everyone. This is specific discount who are taking the discount vouchers. So I'm expecting the price is 2,000. Estimated purchase amount of purchase is 2,000 only. I'm giving a discount is 50%, generally 1,000 rupees. That's the discount value. But don't take 50%. We need to take 40% only, because the 10% is given to all the customers. Correct or not? That is given to everyone. Everyone. No need to recognize that 10% discount. So 40% means 800. Only 60% probability of customers will purchase, will redeem the discount voucher. So 480 is the, how much? 480 is the discount value. Discount voucher value. Correct? But I'm taking only 3,600 rupees only. But I need to allocate the transaction price proportionately. 3,600 is the actual selling price. 4,000 minus 10%, 3,600 is the actual selling price. But 480 is the discount voucher. Within that proportion, I need to allocate the transaction price. Correct? So 3,600 into 3,600 by 4080, 3,600 into 480 by 4080. You will get these answers. Revenue recognized for 2019-20 is 3,176. Yes, this is the revenue. This 424 need to be recognized as a liability. Now, amount you received already. but that is not revenue. Don't recognize 3,600 as revenue, only 3,160 as a revenue. This is discount voucher value, sir. So you need to provide the discount in future. If they purchase within 30 days, you need to, and then at that point of time you can treat it as a revenue, but present it is not a revenue, it's a liability. Even if if you received the amount earlier, okay, we can treat it as an advance, nothing, but you need to provide the service in future. Correct or not? The discount will be given in future, sir. That's a, you have an obligation, nothing but it's a liability. Yes. Next, in the second case, you already given customer within that day, so customer came, purchase up of rupees 2,800. You need to give 50% discount. Yes, obviously you need to give 50%. So you are getting only 1,400 amount. That is the revenue. But at this point of time, you have given this discount value, right? Discount is given at this point of time. So you already recognize as a liability in previous year. Now you need to reverse that. Reverse the liability and recognize as a revenue. This is revenue not at that point of time. At the point of before, like voucher is expired. Okay, at that point of time we can recognize the revenue. On that time we can recognize the revenue. Okay, when the discount voucher expired, when it will expire, the customer purchases, the customer uses the discount voucher gets expired. So you can add it as a revenue. 424 total. 1824 is the revenue recognized for 2021. I think everyone got a full clarity about this question. Clear? Yes. Come to question number 12. I will not discuss the solution. Please do by your own. Simple. 1,000 is the sale of product. Giving how much? 40% discount for any future purchase up to 33,000 in the next 30 days. So intends to offer 10% on all sales during the next 30 days. For seasonal promotion, 10% discount cannot be used in addition to the 40%. So already discussed about that. This 10% is inbuilt in this 40%. The entity believes the 80% likelihood customer will redeem the voucher, as in the customer will purchase 500 additional products. So now you need to calculate the discount first of all. We have two performance obligations. One is sale of goods. Second one is sale of discount vouchers. Correct? Sale of goods means simply how much? 1,000 minus 10%. How much? 900. Yes or no? Okay. See question. Just wait. An entity enter into a contract for sale of a product for rupees 1,000 rupees. As a part of the contract, the entity gives 40% discount voucher for any future purchase up to 1,000 in the next 30 days. The entity intends to offer 10% discount on all sales during the next 30 days. This is, please underline this point. Students will do mistake at this point. They're giving 10% discount on sale, all sales during the next 30 days only they are giving, not today. Not today. Today they are not giving any discount. They are giving a 10% on after 30 days. I mean, next 30 days only, not today. You were purchasing product with 1,000 rupees, they are not giving any discount. But in our previous example, this is the difference between these points. Ordinary discount 10% all sales for all. Simply I said like that, which means the discount allowed now also. That's why I have taken the selling price as 3,600. If the question is saying like this, ordinary discount will be available next 30 days only, 10%. And then you need to take here 4,000 directly. That's the point. Please note this point, sir. Your wish, you can write your wish, whatever may be, but it should be understandable to you. When you are before going to exams, you need to see that this point. Please underline this and note down there. This is only next 30 days. In our example, this point is not there. In our example, that point is not there. Clear? See next, the 10% discount cannot be used in addition to the 40% discount. Yes, same point. Then he believes 80% likelihood as a customer will redeem the voucher and average customer will purchase 500 additional products. How many performance obligations does it have in the standalone selling price and allocated transaction price? Now you can do this problem. Please try this. take sale of to performance obligation. Please go to that solution. Please solve. I mean, once again practice it and then come to this question. Okay, sale of goods. How much here? No discount available. So 1000. Discount. How to calculate discount? So 500 is the additional purchase. So 500 into how much percentage? 40%, 10% means 30% only you need to take into 60%. How much? 90. So that is only the discount. But you have received that how much? 1000 only. So you need to allocate. Correct or not? Correct? 500 into 30% to 80%. Sir, not 90, sir. 120, right? Sorry. 120. 500 into 30% into 80%. Not 60, 80% here. Okay, 120. So simple. Allocate 1120, right? But you received only 1000. Correct? What's the calculation? Everybody, please. So the calculation will be like this. But you received 1000 only, right? 1000 into 1000 by 1120. 1000 into 120 by 1120. 893. One not 7. That's it. This is the allocation. Recognize the revenue, credit as a liability. Any questions in this? No more questions. I think everyone got full clarity about this. I am not solving this question, but this is only the answer. I directly written. I mean, write the solution. Clear? Yes, that's it. If you know, I mean, just wait. If you solve this question properly, you will get a full clarity. But this point is very important, sir. Please don't ignore this point. If you take in discount here also, the answer will be wrong. Because the question is clearly saying that the 10% is given for next 30 days only. Please underline this word. Again, I am saying. You can get the answer. Simple answer, sir. See, sir, customer options for additional goods or services. Retail and consumer product entities frequently give certain customers the option to purchase additional goods or services. The option may be in the form of incentives, coupons with limited distribution, competitor price matching programs aimed at only some customers, gift cards issued by the retailer as a promotion, and customer award credits, loyalty and reward programs. See, these are the different types of customer options for additional goods or services they are giving. So come to question number 10. Come to step number 3. Determine transaction price. Determine a transaction price. Simple, sir. What is transaction price? Please read that. Amount of consideration in exchange for promises. In exchange for promised goods or services. Sir, I promised to sell the goods to the customer. I will get some consideration from him, right? That is the transaction price. Amount of a consideration in exchange for promised goods or services, excluding amount collected on behalf of third parties. Sometimes we will charge GST, taxes, etc. Right? So we will not take the GST, taxes, etc. We will give to government. So nothing but on behalf of a third party. Government is the third party for us. So on behalf of third party, I am collecting that. So exclude that transaction price. That's the point I want to convey you. I think see, in that consideration we have a different non-cash consideration, variable consideration, significant finance component. So we have different things, right? So I'm talking about first one, variable consideration. Are you getting my point? Amount of a consideration. Variable consideration means amount of a consideration can vary, can change because of different reasons. One is discount, rebates, refund, incentives. Suppose example, the transaction price is 1000 rupees, but I am giving discount 10%. The price will get reduced. Rebate, price reduced. Refund, price reduced. Incentives, price reduced. So price will get varies, changes. Amount of a concession can vary through discounts, rebates, refunds, incentives, etc. Okay, for this variable consideration, we have two types of methods for calculating transaction price. Okay, we have two types of methods. One is the expected value method. Second one is most likely amount. First one is expected value method. Sir, what is expected value method? Simple, sir. Sum of probability weighted amounts in a range of possible consideration amounts. Sum of a probability. Simple, sir. They will give the prices. They will give the probabilities. They will give the weights. You need to take the proportionate value, weighted average, like. Simple, sir. I think everyone knows about goodwill weighted average calculation, right? You know about it? Everyone? I know about it. Everyone, please raise your hands. Okay, I know everyone knows about that weighted average method. So you will take the profits, you will take the weights, products of profits into weights, and the total products divided by total weights. You will get the answer. That's the weighted average, right? Correct or not? Same. In the same way, we will calculate this expected value, sum of a probability weighted amounts in a range of possible consideration amounts. Okay, na? So they will give probability also, 50% probability, 60% probability. You need to consider that. Most likely amount means single most likely amount in a range of possible consideration amounts. If we have two amounts, so we will take only one amount. Base, what is the base for that? Suppose example, if we have 90% probability for that one particular amount, you can take that. Are you getting my point? Clear or not? Okay, you will not understand. Once we are done with an example, and then you will get understand. Okay, again I will discuss what is transaction price, amount of a consideration in exchange for promised goods or services, excluding that amount calculated on behalf of third parties like taxes, GST, etc. Variable consideration we are talking about, right? Amount of a consideration can vary because of discounts, rebates, refund, incentives, etc. We have two types of methods: expected value method, most likely amount. Expected value means sum of probability weighted amounts in a range of possible consideration amounts. Here, most likely amount. Apply one method consistently. Okay. Price. Sir, actually in variable consideration we have two methods, right? One is the expected value method, second one is most likely amount. Sir, simple, sir. Most likely amount means we have only two possible outcomes in that most likely amount. Either yes or no, either pass or fail. Either, suppose example, in case of a bonus, we are getting bonus or not. If the bonus is 1 lakh, something condition is there. Okay, under most likely amount, the bonus is either 1 lakh or 0. There's only two possible outcomes will be there in that most likely amount method, right? So generally, which method we will use, it will completely depend upon the entity's decision. Entity will estimate the best prediction. Prediction will be made by the entities itself. It's entity's own. Depend upon the situations and predictions, which is most better method to the entity. Okay, which is better, they will calculate the transaction price. Clear? Okay. So come to example one, basic example. M Limited sells 1,000 televisions through retailers or for 50 lakhs, 5,000 per TV. M Limited provides the price production to R by agreeing to reimburse R for the difference between this price and lowest price that is offers for that TV during the following 6 months. Anyone understand this? M Limited provides the price production they are giving. So they are going to reimburse for the difference between this price and the lowest price that is they are offering between the following 6 months. See, Price reduction next 6 months. If the price is reduced by 0, for 0 reduction, nothing but there is no reduction. 70% probability. Price reduction next 6 months by 500, for that probability is 20%. 1000 rupees, 10% probability. Determine the transaction price. Which method we need to be select? Estimated value, expected value method, or most likely amount. Simple, sir. Here we have they have given a probabilities, right? Probabilities given. Okay, that is good. In next 6 months, the entity expecting there is no reduction, for that 70% probability. In next 6 months, 20% probability for reduction of 500 rupees. In next 6 months, 10% of a probability for 1000 rupees reduction, price reduction. Are you getting my point? Clear? Now you need to calculate the transaction price. Simple, based on the expected value method. Simple, sir. See, initially the price value of a TV, how much? 5000. For 5000, 70% probability is there, nothing but 0 reduction. For 20% probability, 500 decrease, nothing but how much that TV price will be? 4500. TV price will be 4500 for that 20% probability. TV price reduced by price reduction by 1000 rupees. How much? 4000. TV value will become 4000 for that 10% probability. Correct or not? Correct. So by using this, we can calculate the expected value method. Yes. And then you can tell the exact transaction price per TV based on this probability. Expected value method. 5000 to 700 plus 4000 to 20% average, simply 4000 to 10%. See how much? Just wait. How much? 4800 per TV. Please calculate. 5000 to 70%, how much? 3500. 4500 20%, 900. 4000 10%, 400. Total 3500 plus 900. 4400 plus 400. 4800 per TV. That's the estimated transaction price. That's it. Any difficulty? Nothing difficult. This is the price reduction value. I think everyone understand this question, right? So the examiner will ask questions like this only, based on transaction price. Very important, sir. Whatever the questions I am going to discuss, very important. I will discuss 2 examples and 2 questions from the material. Both are important. 4 questions is more than enough. Come to example 2. C will enter into contract with the customer and to build an asset depend on when asset is completed. C will receive either 1,10,000 or 1,30,000. How much C will receive? Either 1,10,000 or 1,30,000. Only 2 possible outcomes. Either 1,10,000 or 1,30,000. 2 possible outcomes. Which method will be useful? Which method will be useful? Most likely amount. So this is the project completion on time. For project completion on time, okay, 90% probability is there. For project delayed, only 10% chances. 10% chances to delay the project. 90% chances to complete the project. Which value we will take? 1,30,000 or 1,10,000. So 90% probability is there for project completion. So we can take most likely amount will be the 1,30,000. Positive outcome. See, because there are only 2 outcomes under the contract, C determines that using most likely amount provides the best prediction of the amount of consideration. Estimated transaction price equal to 1,30,000, which is single most likely amount. Simple, we can answer simple this. Don't calculate 1,30,000 into 9%, 1,10,000 into 10%. Don't do like that. So we have only 2 possibilities. The question itself saying that we can take, suppose example, it is 10%, it is 9%, you can take 1,10,000. Correct or not? Clear? Yes. To build a manufacturing facility, then to determine the contract contains one performance obligation for satisfied over time. Construction is scheduled to complete at the end of the 36 months for an agreed upon 25 crores. The entity has the opportunity to earn performance bonus for early completion as follows: 15% bonus of the contract price if completed 30th month, 25% likelihood. So you will get 15% bonus of the contract price if they complete by 30th month. If you complete by 30th month. If you complete by 32nd month, you will get 10% bonus. If you complete by 34th month, you will get 5% bonus. That is 15% probability, 40% probability, 25% probability. What is that contract price? 25%. 25 crores. 25 into 15%. 3.75 bonus. 25 into 10%. 2.5. 25 into 5%. 1.25. This is the bonus amount. For that, we have a probability is 25%, 40%, 15%. So 3.75 into 25%, 2.5 into 40%, 1.25 into 15%. So go to solution, you can check. 15% bonus, 10%, 5%, 0%. How much? 25 into 15%. 25 is the contract price, right? So 25 into 15%. 25 into 10%. 25 into 5%. 25 into 0%. Because the probability is one is 25, 40, 15 total. 25 plus 40, 65 plus 15, 80 only. Balance 20, there is no bonus. 20% probability for no bonus. That is the understanding. And then you calculate the average, right? Weighted average, like 3.75 to 25%, 2.5 into 40%. Correct? 1.25 into take a calci. 1.25 into 15% of 0.1875 total 2.125. That's the transaction price under expected value method. Simple calculation. Say sir, no? Yes. In addition to that, the potential performance bonus for early completion entitled a quality bonus. So please use this as a keyword or remember this point. Remember this point. Quality bonus, like this they are giving. You simply use most likely method. Simple, directly. See, if the safety inspector assigns a facility a gold star rating, simple, same answer. You need to take either 2 crores bonus or 0. 2 crores or a bonus or a 0. But A is still to conclude the 60% like that they will receive the quality bonus. So they have a 60% probability for getting the bonus. So most probability is there. So what is the most likely amount? 2 crores is the most likely amount. Because getting bonus have a 60% probability, so you can take the 2 crores as a, what is that? 2 crores as the most likely amount. That's it. Simple. Are getting my point? Previous question also same that, like this. If, please remember this point I am saying. Just if the entity takes gets any rating, okay, they will get bonus. So in that point of time, please use most likely method. That's it. That's what I want to say. I think everyone got a clarity about this point also, right? So they are getting a 2 crores gold rating, then they will get 2 crores as a quality bonus. Under most likely method, we have only 2 possible outcomes. Okay, one is 2 crores getting quality bonus, otherwise 0. Here 60 probability is there, 60% probability is there. Then you can take this 2 crores. That's it. Correct? Say sir. No. See the solution. We have only 2 possible outcomes, 2 crores are nil, and this method would best predict the amount of consideration associated with quality bonus. A is limited to believe that most likely amount of quality bonus is 2 crores because 60% probability is there. Correct? Say yes or no? Very simple answers or not? Yes. So charging is too low. Okay. So come to one more point. I will close the session for this topic. Next, refund liabilities. Sale with right return. Refund liability means you have a liability to refund the money. Suppose example, if you receive the advance amount, you need to refund actually. So for that purpose, till that time, you need to recognize as a liability. If the entity receives consideration and expect to refund, we are expected to refund that. Suppose example, I received consideration 1 lakh. I have an expectation to refund 20,000 from that 1 lakh. So that 20,000 is known as refund liability. So we can treat it as a refund liability. Refund liability. Because we have a liability to deliver, refund that. So that's why we need to create a liability for that. Suppose example, if you recognize the revenue completely for 1 lakh, but still you have a, you are expecting that amount should be refunded of rupees 20,000. If the entity receives consideration and expect to refund some or all of consideration to the customer, some or all of the consideration, either 20,000 or fully 1 lakh also, that is the refund liability. This point will be helpful here. Simple. Sale with right return. Sale with right return. I sold the goods to the customer. He have a right to return the goods. Okay. This is the contract symbol. Revenue recognized for transfer products. Don't recognize for expected return products. So I sent 100 products to the customer. I am expecting, actually I know that 20 products is damaged. So I am expecting that 20% definitely it will return by the customer. That customer is very crucial. Okay, very cruel, sorry. Okay, I know definitely he will return that goods. So don't recognize for expected return products. I'm expecting 20 products. Don't recognize for that. I should recognize only for 80 only. And you should refund that amount, right? You should refund that amount. So you need to create refund liability for that amount. And they will simple at a selling price only. See, at selling price, refund liability at selling price. Simple, sir. 100 goods at the rate of 500 rupees. 100 products. I am expecting 20 will get returned. So I should recognize only 80 only. So 80. So I have to return 20 into 500 because he's giving 500 rupees. I need to return that 500 rupees only. So that's why I have write here that selling price. Okay, 100 into 500 is the amount received. So 200 into 500 need to the refund that liability. So refund liability. So I will get 20 products, right? That's a closing stock for me. Correct or not? So I need to, it's an asset or not? Stock is an asset to me, right? Stock is an asset to me. So I need to recognize as an asset. Because I have a right to recover that products from the customer. Correct or not? So that 20 recognize that its cost. Suppose example cost is at 400 rupees. Because when you sold the goods, stock value will get reduced. Once the stock comes into your go down, the stock value will get increased. Asset increased. At which value? Don't take sale value. You need to take cost value only. That's why at cost only. Correct or not? Inventory should be valued at cost or NRV whichever is lower. Inventory should be valued at cost or NRV whichever is lower. Net realizable value or cost whichever is lower. Here there is no net realizable value, only cost. You need to recognize it cost only. Understand or not? Not understand? Okay, come to example. See. A limited enter into 1,000 contracts with the customers. Each contract have 1,000 products at the rate of 50 each. That is 50,000. 1,000 into 50, 50,000. If any unused product, you should return within 30 days. I have given a option to the customer. If you are unused any product, please return within 30 days. You will get refund. The cost of each product is 30 rupees. Okay. Entity expected that 970 will not be refunded. Returned will not be returned, which means only 30 may be returned from the customer. Out of 1,000 products, only 970 will not return, 30 may be returned. So for how much I need to recognize the revenue? For 970 only I need to recognize the revenue. How much at which price? 50 rupees. So 970 into 50, 48,500 is the revenue. Okay, I am expecting 30 will be returned, right? So 30 into 50, how much? 1,500. That is the refund liability. Refund liability is there for me. So I need to recognize it. And the 30 will come to my go down. So it's an asset to my entity. So I need to recognize it at cost. Correct or not? Okay, I need to recognize it cost only. So 30 goods into 30 rupees is the cost per product, so total 900 rupees. So in case of sale with right return, sale, we have 3 points. One is revenue recognized, second one is refund liability, third one is asset. Okay, whatever the amounts we are not getting returned, for that only you need to recognize the revenue. Whatever the amount, whatever the goods returned, for that you need to recognize the refund liability. That return goods will be added to my stock. Our stock means asset will get increased at which price. Don't take selling price. If you take selling price, completely wrong. You need to take only cost only. 13 to 30, 900. That is the answer. If you understand this question, automatically you will understand this theory. Please give me single reading. Revenue recognized for transferred products. I transfer 970 only. Don't recognize the expected return products. I'm expecting 30 return. I'm not recognizing that. Only 970. Refund liability for returned products at selling price 30. Asset for the right to recover the product from the customer. I have a right to recover product from the customer. So that is an asset to me. At which price? Cost price. 30 into 30. That's it. Clear or not? Everyone? I think everyone have a full clarity about this topic. Clear? I am done with step number 1, step number 2, step number 3, and this bloody refund liability, sale with right return, customer options for additional goods or services. I am done with it. And I have one more topic is pending in this, that is warranty. That is warranty. Under warranty, I have a concept and as well as the one example also. If you are done with it, you are experts in this. You will become experts. Okay. Ready? Okay. So now come to warranties. Come to warranty. Simple, sir. I think everyone knows about this warranty. Suppose example, if you purchase a mobile or a TV or an AC, whatever maybe, they will give 1 year warranty. Correct or not? So say sir, no, yes, that is nothing but assurance warranty. If any repair comes within that 1 year period, they will repair that mobile or whatever maybe device. Correct or not? Yes, that is nothing but assurance warranty, assurance type of warranty. Sometimes, for example, actually I purchased a TV, MI TV, so they have given 1 year warranty inbuilt. The price is something 50,000 something is there. Okay, so actually I asked him that, so I want 2 more years for warranty, 2 more years of a warranty. So he asked that, he said that, okay, pay 2,000 extra for that. He said that I paid the $2,000. For what purpose I have paid that? For that is nothing but service type of warranty. That is not included in the price. Correct or not? Say yes or no? Yes sir. Yes. Okay now. So for that purpose we need to pay extra amount. Suppose example, see, okay. So generally we have 2 types of warranties. One is service type of a warranty. Second one is assurance type of a warranty. Assurance type of a warranty. Come to assurance type of a warranty. Customer has no option to purchase warranty option separately. It is an inbuilt warranty. It is an inbuilt warranty. For that, Ind AS 37 will be applicable. Suppose example, you purchased a mobile, they have given 1 year warranty. That is inbuilt warranty. Is that clear? Ind AS 37 will be applicable. Come to service type of a warranty. Customer has an option to purchase a warranty separately. For service type of a warranty, customer need to purchase separately. For that only Ind AS 115 applicable. Account for promised warranty as a separate performance obligation and allocate the portion of transaction price to that PO. So we need to perform performance obligation, right? Correct or not? Yes, this warranty is also a separate performance obligation when you are purchasing a separately. Account for promised warranty as a separate performance obligation and allocate portion of transaction price. Transaction price will be there, right? That should be allocated to this warranty also. Are you getting my point? Service type of warranty Ind AS 115 will be applicable. Assurance type of warranty Ind AS 37 will be applicable. Ind AS 37 means provisions, contingent liabilities and contingent assets. That's a different standard, separate standard, okay? And accounting standards it is AS 29, I think. Okay, AS 29, yes. Okay, now clear. So that is not in our syllabus, only this one. But we need to discuss. Clear about this, everyone? We need to allocate. I don't know how to allocate. So let's see one example. You will get a clarity. Example on warranty. Transaction price for the sale of computer and extended warranty is 36,000. How much? 36,000. That is the computer cost plus extended warranty also. Assurance warranty provided for first 90 days. Standalone selling price 32,000. Extended warranty 4,000. Extended warranty how much, sir? 4,000. Only that computer price will be 32,000. This is 4,000. Total 36,000. Correct. Clarity. Okay. So entity estimates that it will be incur 2,000 rupees to repair defects within first 90 days. So the question is saying that entity estimates it will incur 2,000 rupees only to repair the defects within first 90 days. Suppose example, if any repairs, suppose example, computer something issue came to your computer, you need to repair it. You need to repair it. For that purpose, you need to incur 2,000 rupees. For that purpose, you need to incur 2,000 rupees. That too within first 90 days. So it is expecting that, estimates that it will incur 2,000 rupees only. For what purpose? To repair the defects within first 90 days. To repair the defects within first 90 days. Are you getting the clarity about the question? Everyone? Clear? So transaction price for sale of a computer and warranty, extended warranty is 36,000. Assurance warranty provided for the first 90 days. Standalone selling price of the computer is 32,000. Extended warranty is 4,000. So it is estimating that it will occur 2,000. It will incur, sorry, not occur. It will incur 2,000 rupees to repair the defects. To repair the defects within first 90 days. Clear? Says sir, no? Yes. Here extended warranty is nothing but service type of a warranty. Service type of a warranty. Up to 90 days they will give a service. That is a inbuilt warranty or a assurance type of a warranty. Clear? Yes sir, no? So total transaction price is 36,000, right? First, we need to account for assurance type of a warranty. You have to think in a entity point of view only. So you sell that computer, nothing but it's a good to your company, your entity, it's a good. So that's why we need to write what's the entry? Bank account debit to sales. What's the standalone price of the computer? 32,000. So bank to revenue or sales 32,000. That's the standalone price. Correct or not? Say sir, no. We need to account both, sir. One is a assurance type of warranty, second one is service type of a warranty. For service type of warranty, we will account separately. Correct or not? So I'm talking about assurance type. First of all, sale of a computer, bank to sales, 32,000. Not computer. Please don't write computer because computer is a good to the entity. Because your business is computer business. Computer is a good. So bank account debit to sales 32,000. But the company is expecting that assurance warranty, how much? 2,000 rupees may incur within first 90 days. For that purpose, we need to create a liability initially. We need to create a provision for that. Correct or not? So NT expect to incur 2000 rupees to repair the defects. So that's why warranty expenses how much? 32,000 to provision for accrued warranty or to accrued warranty. So it's a liability, like a liability 2000. We need to incur. So we need to create a provision for that warranty expense. Once you have incurred that, what is the entry? Once you incurred, liability will get reduced. Correct or not? I'm talking about simple, sir. Such warranty expenses will be transferred to P&L. Such warranty expenses should be transferred to P&L. Simple, sir. You need to divide two types of a warranty. One is assurance type, second one is service type. In case of assurance type, don't consider that service type of a warranty. We have 36,000 transaction price. Out of that, 32,000 only the computer price. So bank to sales 32,000, and we also need to incur that within 90 days that warranty expenses, right? So warranty expenses to accrued warranty 2,000 rupees. Clear? If we come to service type of a warranty, what is that, sir? You are taking up money 4,000, right? So bank account debit to contractual liability. So this will incur in future. Correct or not? Initially you are taking money from the customer, but you need to give service in future. So that's why we have to record like a contractual liability. Are you getting my point? So bank account debit to contractual liability. Clear, everyone? I think everyone got a clarity about this. Clear? Everyone, sir. I want a clarity, complete clarity about this concept. Sir, warranty is a simple, general, regular activity, sir. Warranty. If you purchase the TV, they will give 1 year warranty inbuilt. If any issue comes, if any defect came, so they will repair that. That's nothing but assurance type of warranty. But we want to after 1 year maybe the TV gets defected. I mean defects will come in the TV. So that's why we need to take a service type of a warranty also. For that we need to purchase that. We need to pay for that extra separately. So that is nothing but service type of a warranty. We need to account separately. Okay, now assurance type and service type. What is the journal entries? Bank account debit to sales 32,000. Here warranty expenses to accrued warranty 2,000. Here bank to contractual liability 4,000. Correct? This is extended warranty entry. Clear? Okay, nice. Next, come to question number 16. Question number 16, sir. Very simple. Please read the question, you can answer directly. NT sells 100 ultra life batteries for 2,000 each and provides the customer with a 5-year guarantee that the battery will withstand the elements and continue to perform the specifications. The entity will normally provide a 1-year guarantee to customer. Purchasing ultra life batteries determines that years 2 through 5 2 years, so the years 2 to 5 represent a separate performance obligation. Then it determines 1,70,000 of the 2 lakhs transaction price should be allocated to the batteries and 30,000 the service warranty based on the estimation of standalone selling price and relative selling price allocation. The 1-year warranty cost is 100 per battery. Past journal entries. Okay. So everyone can answer this solution. Simple, sir. Purchase sells 100 ultra life batteries, 200 each, which means total 2 lakhs. Out of that, so 1,70,000. The entity determines 1,70,000 as a transaction price should be allocated to the batteries, 30,000 to the service warranty. So out of 2 lakhs, 1,70,000 is the nothing but battery price, and 30,000 is the service warranty price. Correct or not? Yes. So how to allocate? Simple, you already know about this. Out of 2 lakhs, 1.7 lakh 30,000. This is service type of warranty. What's the entry for that? Bank account debit to contract liability 30,000. For 1 lakh 70, bank account debit to 1 lakh 70 to revenue how much? Bank account debit to revenue 1 lakh 70. Next, second entry. What is the second entry? Warranty expenses. Assurance type of warranty expenses. How much here cost you are incurring? 100 per battery. So warranty expense to accrued warranty. How much? Total how many? 100. So 100 into 100, 10,000. Same interest, sir. Same ditto interest. Sorry. So please note down this solution because I'm not given in my material because notes also I have not given this solution. Please write this solution. Entries, just entries. Fast. Please pause the video. Please write all the 3 entries for that question number 16. Everyone clear? Okay na? Yes? Done na? Cash or bank to revenue sales account 1 lakh 70. Okay. Second entry accrued warranty expenses to accrued warranty. Yes. And how much? 10,000. 100 into 100. Next, service type of warranty entry. Cash or bank to. What is that, sir? Contract liability. 30,000. Simple question. Correct or not? Yes. Simple, sir. Very simple. This is the warranty type question. Next, significant finance component. So here finance component may be significant or insignificant. In case of insignificant, you can ignore, but significant you need to account separately. You should account separately. Clear or not? As the interest income. See, if significant component exists within the contract, whether explicitly or implicitly, that could be separately recognized as an interest income. That could be separately recognized as an interest income. See, we have few examples for that. Okay, guys. So we are done with the warranties also, right? Correct? So we are done with this question. Just wait. Yeah. So we are done with this. And second one, based on discount. This is the previous question actually. Question number 2 is last attempt question. Exactly same question. So you need to done with the question number 3 also, as well as we are done with the 4 also and 5. So we don't have a lot of time. We have spent time on Ind AS 1 for it. So we need to discuss a lot of topics. So that's why. Okay, this is the allocation step number 4 actually. This is based on allocation. Are you getting my point? So allocation of a transaction price. Okay, now you need to allocate the transaction price to the performance obligation. Okay, and entity shall allocate the transaction price to each performance obligation identified in the contract. Okay, now so we don't have a lot of time. Clear? Hey guys. See, very simple example I will discuss here. Allocation of transaction price to performance obligation. A Limited sold products for rupees 10,000 to the customers. Okay, those products are ABC. A, B, C are the three products they're selling to customer. Satisfy performance obligation at different points of time. Okay, we satisfy the performance obligation. What is the performance obligation? We need to deliver the goods to the customer. What is the customer's obligation? He has to pay the consideration, right? So standalone selling price directly observable. So they have given the standalone selling prices directly observable for product A, but not for B and C. So for product A, standalone selling price directly given, for B and C not given. So we need to estimate them by using the methods. So for that we have different methods actually. See here. So these are the methods. What is it? Adjusted market assessment approach. Next, expected cost plus margin. Last one is residual approach. So what is the adjusted market approach here? Adjustment approach simple. You need to evaluate the market, estimate the customer willing to pay for the goods. So you need to evaluate the market. Based on that, you can estimate the customer willing to pay for the goods. What's the price, or whether they are willing to pay for the goods or services or not. So based on this first method, we need to identify that. Second one is expected cost plus margin. We can expect some cost and we need to add some margin to that cost. This is the second method. So these two methods they're following in the following example, right? See here, what is this? For first one, method 1. For product B, they're following method 1. Product C, method 2. Adjusted market assessment approach, expected cost plus margin approach. They are following. So products are A, B, C. These are the three products. 5,000, 2,500, 7,500. 5,000 is directly observable. But for 2,500, followed method 1. For product C, method 2. Total 15,000. The question is saying that satisfy the performance obligation at different points of time. Right? Where's the different points of a time? If you see the standalone selling price of each of the product, total how much actually? 15,000. But I promised the consideration of rupees 10,000 only. Yes, the difference 10,000 is known as the difference 5,000 is known as the discount. You need to apportion such discount proportionately. You need to apportion the discount proportionately. Allocate the discount proportionately to all performance obligations except evidence exists for discount. If there is any if there is any evidence available for discount, particularly, okay, then only, the point is saying that you need to apportion, nothing but proportionately. Discount should be apportioned proportionately to all the performance obligations. When you will apportion that, the question is saying that there is no evidence for particular product. There is no evidence for discount for a particular product. Then you can allocate proportionately. That discount allocate proportionately. That is the point. Come here. So the first point is saying that there is no specification regarding the discount. Where we discount for product A or product B or product C, there is no clue. There is no hint for that. So you need to apportion proportionately. See here. Hence, there is no observable evidence about the PO which the entire discount belongs. That this discount belongs to product A or B or C, there is no evidence. So then allocate proportionately to A, B, C. Then transaction price allocated as follows. Product A, B, C. 3,300, 1,700, 5,000. How I will get this? Simple, the discount is 5,000. Total price is 15,000. Allocated to 10,000. So 10,000 by 15,000. Next, what is this 5,000 actually? What is this 2,500? What is 7,500? These are the standalone selling prices based on this I proportionately allocated. So 10,000 is actually the promised consideration. Total consideration is 15,000. So proportionately I am dividing the discount. Correct or not? We need to allocate the discount as well as transaction price. Sorry, I'm talking about here not discount, transaction price. So transaction price allocation, actually allocation of transaction price, not discount. I'm talking, you need to allocate the discount also, but I'm talking about transaction price. So transaction price is 10,000. You need to allocate 5,000 by 15,000, 2,500 by 15,000, 7,500 by 15,000. This on this basis, standalone selling price basis. If the question is asking about a discount, allocation of discount, then we will take here 5,000. Correct or not? Yes. We will take 5,000 here. If they are asking about discount, then you will take 5,000 and then based on that allocate. That's it. This is the example number 1. I don't want to waste my time actually. So we are spending a lot of time on this. Clear? Clear? Next. Yeah, this is one more example actually. This is more than enough, sir. This is more than enough. Actually, I want to discuss one more point, residual approach also. Residual approach means, see here, in addition to case A, so please ignore all the things. Just I want to conclude the point. Residual approach means contract includes the product alpha, total consideration is 1,30,000. The standalone selling price of alpha between the range 15,000 to 45,000 determines standalone selling price of XYZ and alpha using residual approach. What is this question actually? If you want, before knowing that, you need to start the example 2 also. Okay, I will pause this video. Please make a snapshot because we don't have a lot of time to discuss all this, right? Please make a screenshots. Please pause the video and then make a screenshots. That's it. Because we spend a lot of time on this Ind AS 115. Okay, that's the point. That's why. Okay, now that is more than enough, sir. That's more than enough for our discussion. But don't leave this question number 6. This is only the answer for that. Example 2 is only the answer for that. Sorry. Yes, that is only the answer. Yeah. Clear? So we are done with this Ind AS 115. That's more than enough, sir. More than enough. Okay, now clear? But please do all the solutions actually, question and answers, if time permits. Otherwise, you can go with all these questions. That's it. Okay, now are you getting my point? We discussed everything in regular class and fast track classes, but we don't have a time in this marathon, right? Clear? Okay. So next, I don't want to discuss all the things. Step number 5, satisfying the performance obligation and all. I don't want to discuss. Okay. Let's go to next. See here. Done, 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 done. So 108 is very simple topic. Correct or not? 108 is simple or not? Yes, Ind AS 108. Just I will give a simple brief explanation within 5 minutes. Within 5 minutes, I will complete this Ind AS. Operating segments. Operating segments. Actually, you learn in accounting standard 17 actually segment reporting. That's we can call it as operating segments right now. As per Ind AS 108. Simply directly we are talking about reportable segments. We need to report the segments. Segment information we need to be reported. That's it. So for that we have a based on 10% limit, based on what is that 75% limit, management discretion, management judgment. Okay now. So in this 10% limit we have assets criteria, second one result criteria, and third one revenue criteria. So these are the 3 points. One is revenue, second one is assets, third one is result. Okay, this 75% will cover in revenue only. This is the management discretion. These are the 3 points. Okay, if you want, you can see my old marathon also for AS 17 is there. You will get a full clarity about this. Because we don't have a lot of time, I will discuss very briefly. Simple. 10% limit is very important. First, I will talk about revenue. Revenue means we have a external revenue and internal revenue also. External revenue and internal revenue. Both are called as revenue, total revenue. Okay, suppose example we have a 4 segments A, B, C, D. Okay, the revenue is 10 lakhs, 20 lakhs, 30 lakhs, 40 lakhs. So total 100 lakhs, right? So the point is saying that 10% limit means if the revenue of the segment is more than or equal to 10% of a total revenue, then we need to be report that segment should be reported. So 10 divided by 100 how much? 10%. 20 divided by 100 how much? 20%, 30%, 40%. So all the segments need to be reported. All the segment information needs to be reported. So A, B, C, D are the reportable segments. That's the answer. This is total revenue. If the question is asking about external and internal revenue separately, A, B, C, D, internal revenue, external revenue. Okay, now within the segments, internal revenue means 1 lakh, 2 lakh, 3 lakh, nothing. 4 lakh, 6 lakh, 12 lakh, 10 lakhs. So, in this case, what we need to do? Simple, sir, simple. We need to add the both internal revenue 2 plus how much? 6. Here 10, 22, 32. 32, 6, 38 lakhs is the total revenue. Here we need to total both 5 lakhs, 8 lakhs, 15 lakhs, 10 lakhs. Okay, now you should calculate. Simple. 10% means 38%. Sorry, 38 lakhs into 10% how much? 3.8. Nothing but if any segment's total revenue is 3.8 or more, then we need to be reported. Simple. So everything is more than or equal to 3.8. Yes, A, B, C, D are the reportable segments. And one more point is there, that is regarding 75%. Suppose example, I don't want to discuss this point. Go to old marathon, you can watch AS 17. Okay, 75%. Suppose example, as per 10% limit, I reported A and B are the, suppose example, total 5 segments I have. A and B are the reportable segments as per 10% limit. 10% limit. Okay, clear. We have internal revenue, we have external revenue also. The point is saying that 75% limit point. Whatever the segments you have reported based on the 10% limit, please calculate the reported segments external revenue percentage. What is that? External revenue percentage. Suppose example, external revenue 10 lakhs, 20 lakhs, total 30 lakhs divided by the total external revenue is 200 lakhs. Assume that 200 lakhs. Assume that, or 180 lakhs. Assume that 180 lakhs is the total external revenue. I am talking about only external revenue, not total revenue. So total whatever the segments you have reported, please total the external revenue of those 2 segments. Yes, total 30 divided by total external revenue. What is the percentage? Please calculate. If that percentage is more than or equal to 75%, okay, no issue. Then no issue. If it is less than 75%, you need to be report additional segments, whether it is a meet the criteria of 10% limit or not. You need to report additional segments. Additional segments you need to be reported. That's it. That's the point they want to say. I don't want to prolong this discussion. I will go to assets. Simple. A, B, C, D. Total assets 10 lakhs, 20 lakhs, 30 lakhs, 40 lakhs. Simple. Total 100 lakhs. Correct? So simple. 10% limit. If the segment assets is more than or equal to 10% of the total assets, then we need to be reported. So 10% means how much? 10 only. 100 into 10, 10%. How much? 100 into 10%, 10 only. So everything is more than or equal to 10. More than or equal to 10%. So ABCD are the reportable segments. Segment assets excludes this point. What is the point? Deferred tax asset. So deferred taxes should be excluded from the value of asset. Total assets 10 lakhs, right? Suppose example in this 10 lakhs, 1 lakh included, 1 lakh of deferred tax included. Please remove that. So 9 lakhs is only the asset value. In this 2 lakhs included, total 18 lakhs only the 18 lakhs only consider for the calculation of this reportable segments criteria. You need to don't consider this deferred taxes. That's the point I want to say. Please exclude the deferred tax amounts and then calculate the percentages and all. This is the assets. And come to results. Results means, suppose example A, B, C, D, E. We have 5 operating segments, right? So 5 lakhs profit, 2 lakhs profit, 3 lakhs loss, 4 lakhs loss, 2 lakhs profit. Okay now. So in this case, what we need to do? Simple, add the profits. How much? 5 plus 2 plus 7, 2, 9. 4 or 4 plus 3, 7. Whichever is higher. How much? 9. 9 or not? Yes. Take 10% of that 9, we will get 0.9. So in all the cases, everything is more than or equal to 0.9. Please ignore the sign. In case of operating result, we will take only absolute value. Negative sign means loss. Please don't consider that. We want number only. But for calculating that, first of all, please take all the profits. And then please take all the losses, whichever is higher. You should take whichever is higher. How much? 9. Out of that, apply the 10%. So 10%, 0.9. So check the 0.9 is there or not. If the segment revenue, segment result is 0.9 or more, then you need to be reported. You need to be reported. So A, B, C, D are the reportable segments. Please ignore the negative sign. That's it. The simple logic. I don't want to discuss more about this. Ind AS 108. Okay now. Next. So next come to valuation of a goodwill. So goodwill, we have different methods, right? Simple goodwill is an intangible assets, okay, which cannot be seen and touched. So goodwill means is the value of a reputation of the firm in respect of a profit expect to be earned in future over and above the normal rate of a profits. Everything we already know about it. We need to be recorded in the books of accounts. So we need to, for that we have some value. Goodwill has some value. For the calculation of that we have different methods. What is the average profit method, super profit, calculation method, and annuity method. So for very important methods are first and second methods. Both are very important. So average profit means average profit equal to formula for goodwill. Goodwill equal to average profit in number of years of purchase. Average profit means everyone. Simple sir. We have different two types of average. One is simple average, second one is weighted average. Simple average means sum of profits by number of years. Weighted average profit means sum of profits into weights divided by sum of weights. Correct or not? So I think everyone know about this thing. Okay. Next, is there any abnormal loss or abnormal gain? Abnormal loss or abnormal gain? Please don't consider. So for example, year 1 the profit is 10 lakhs. It includes abnormal loss of rupees 50,000. What we need to do? Sir, because of that abnormal loss, generally profit will show less amount, right? So actually abnormal loss will not come in all the years, right? So it will come in a rare cases only. So that's why such abnormal loss is not a normal loss. So that's why we need to add back that abnormal loss to that profit in that year, particular year. So year 1 the profit is 10 lakhs only. In that abnormal loss includes. So after considering abnormal loss 50,000. So because of that abnormal loss, the profit shows 50,000 less amount, right? So we need to be add back. Suppose example, if it is abnormal gain, because of that abnormal gain, the profit shows more. So we need to be reduced from that. Are you getting my point? Clear? Is there any non-recurring receipts? You are receiving any non-recurring receipts? Non-recurring items are there? Please adjust it to profit. Non-recurring items means not recurring in nature. not recurring in nature. For example, sale of asset, profit on sale of asset. So this we will not get a profit on sale of asset regularly. It is a non-recurring in nature. Please don't consider that type of items. Clear? So we know everything about the calculation. Next, come to super profit. Super profit means what is the formula for goodwill under super profit method? Super profit into number of years of purchase. Super profit into number of years of purchase. Correct? Yes. So what is the formula for super profit? Super profit equal to average profit minus normal profit. Average profit minus normal profit. Average profit we can also call it as the average future maintainable profit. Future maintainable profit. Okay now? Clear? Next, what is the normal profit here? Normal profit, how to calculate means simply capital employed into NRR. NRR means normal rate of return. It will be given in the question, no issue. So how to calculate the capital employed? Simply we can take total assets minus current liabilities. Sometimes they will take outside liabilities also, all the liabilities. You can take that. Okay, but exclude except goodwill and fictitious assets. Don't include total assets. What is that? Goodwill and fictitious assets don't include. So we have different examples for fictitious assets. What is that? P&L debit balance, preliminary expenses, discount in of debentures. These all are comes under fictitious assets. Don't consider that in total assets while calculating capital employed. Okay now? Clear? So this anti method is not that much important. You can ignore. Otherwise, you already know about the formula, right? And calculation method also not that much important. Clear? Clear? Yes. We'll discuss about valuation of shares. Before going to the NBFC, before going to exam, please see this rates. In case of loans and advances, we need to NBFC need to make some provision, right? If it is a loss assets 100%, we need to be create a provision. We need to be recognized the provision. If it's a doubtful unsecured 100% provision, you need to be recognized in the books of accounts. If it is secured, doubtful up to 1 year 20%, 1 to 3 years 30%, more than 3 years 50%, substandard assets 10%. You need to be create the provision. You need to be recognize the provision. But in case of a standard assets, 0.4%, 0.25%, two cases are there. 0.25 in case of a non-systematically important, 0.4% in case of a systematically important. Systematically important means asset size should be more than or equal to 500 crores. Non-systematically important means less than 500 crores. Asset size should be less than 500 crores. So systematically important means high amount, so that's why 0.4 percentage. It is low amount, so 0.25 percentage. Provision we need to be created. Okay, so next one more point, in case of a higher purchase, additional provision we need to be created. What is that? Up to 12 months in case of a higher purchase. Okay, lease. Higher sir, certain higher charges. So up to 12 months due. No provision need to be created. 12 to 24 months, 24 to 36 months, 36 to 48 months, more than 48 months. 10% of net book value, 30% of net book value, 70% of net book value, 100% of net book value. Sorry, 40% I think so. 40 or 30? Please check once again. Okay. Yes, 40% only. 40% of what value? Net book value. I am not discussing all the points. Just the key points I'm discussing. Just that's it. For MCQ purpose, it may come. Net book value you need to take. Net book value means cost minus depreciation. You will get the net book value of a asset. That's it. Clear? So this is all about NBFC. Clear? Yeah, guys, come to accounting for financial instruments. Before going to that, okay. So in this, you need to study the financial asset definition. Next, financial liability definition and equity definition, as well as putable instrument. 4 definitions are very important. Please note down. Please make a mark on it. Yes, very important examination point of view. So they may ask the questions. So financial asset means it's a cash or equity instruments of other entity, or a contractual right to receive cash or another financial asset from another entity. So first of all, what do you mean by financial instruments actually? It's any contract that gives rise to financial asset to one entity and financial liability to or other equity to another entity. Simple, sir. Suppose example A Limited and B Limited. Okay. Suppose example, I invested in a company B Limited. I invested in a company B Limited. Okay now. So invested in shares, suppose example. So nothing but I paid cash to him. I got a shares. Yes or no? So investment is an asset to me, nothing but financial asset to one entity. Next, he have a liability. B Limited have a liability to pay the amount. So they are issuing shares, right? So ultimately they have to pay amount. They are nothing but equity. That is nothing but equity to B Limited. So for one entity it may be asset, other entity it may be equity or liability. Suppose example, if it is shares, we can call it as an equity. If it is debentures, we can call it as a liability, financial liability. So nothing but for one entity it's a financial asset. Then automatically other entity, for other entity either financial liability or an equity. It may okay now. Are you getting my point? So this is the discussion. Financial asset, financial liability, equity. Equity means MCQ important this point. Residual interest in the assets of a entity. Residual means a pending balance. After deducting all the liabilities, we will give to this equity shareholders, right? So that's why we can call it as residual interest. Scrap. Okay now. So just go with all the definitions. Very important for examination point of view. Okay. Directly we'll go to the Ind AS 109. Very important for measurement of a financial instrument. And one more point for MCQ purpose. 107 deals with, 109 deals with, 32 deals with. You need to check that. MCQ purpose. Presentation, disclosure and measurement. Okay now, clear? So MCQ purpose important. So that question may ask. Clear? Everyone? So we will discuss one or two questions from Ind AS 109 and we'll get close this session. Ind AS 109. Okay now, don't worry about it. Discuss about Ind AS 109. Recognition and measurement of a financial instruments. Now you have to measure the financial instrument. Till now we presented, we disclosed also. Actually disclosure will be last criteria. First presentation, first measurement, presentation and disclosure, right? Okay now, clear? Okay. First of all, objective. What is the objective of this standard? The objective of the standard is simply to establish principles for financial reporting of a financial asset and liability that will present relevant and useful information to the users of financial statements. This point is repeated in every standard, sir. Because ultimately we have to provide information to the users, right? That's it. Correct or not? So simply the objective of the standard is to establish principles for financial reporting of what is that, sir? Financial asset and liability that will present relevant and useful information to the users of financial statements. For what purpose? Users has to assess the what is the amount and timing and uncertainty also, because they want everything, sir. Everything, users need everything, so that's why we have to provide. So the entity will get cash flows or not in future. In future, entity may or may not get the cash flows. So they have to assess, sir. They have to assess. For that purpose, you have to report about the financial asset and financial liabilities. Okay, if you don't have any investments, you have only liabilities mostly. So then users will have any interest on your company? No, they will not interest on you. Correct or not? Yes. See, please repeat the objective. The objective of the standard to establish principles for financial reporting of financial assets and liabilities that will present relevant and useful information to the users of financial statements. Okay now. For what purpose? For the assessment of amounts, timing and uncertainty of entities' future cash flows. The future cash flows, they may get or not. They will get a future good cash flows or not in future. Is there any uncertainty arises in the entity? So is there any indications? So everything users will assess based on the presentation given by the entity. Okay, now this is the object. See, financial instrument, generally three categories, right? Financial asset, financial liability, equity. Now we are going to discuss about what is that, sir? Financial asset. First of all, we are done with the financial asset. Okay. Financial asset or a financial liability also. Financial asset or a financial liability. So see, in case of a financial asset, we have three methods actually. Based on three methods, we can categorize. At what price, at what place we can measure that financial asset. So we have first one is amortized cost, FVTOCI, FVTPL. Measured at amortized cost or measured at FVTOCI, measured at FVTPL. That's what you have to say based on the conditions. Examination point of view, very very important. This amortized cost, very important. See, if you want to measure the financial asset or liability at a amortized cost, then see, first of all we are going to discuss about financial asset and then we'll go to financial liability, because same methods, right, except this method. So first of all I am going to discuss about financial asset. Clear? Financial asset. Simple, sir. If it is financial asset to one entity, automatically financial liability or an equity to other entity, right? Yes. Conditions. The business model should be the collection of contractual cash flows. CCF test. CCF means collection of contractual cash flows. Collection of contractual cash flows. So CCF test should be passed. Should satisfy the business model. The business model should satisfy CCF test, which means contractual cash flows, collection of contractual cash flows. And also SPPA condition also should satisfy. SPPA means solely payment of a principal and interest. What is it, sir? Solely payment of principal and interest. If these two conditions are satisfied, okay, now if these two conditions satisfied, then what is that, sir? Okay. See, what is the condition here? Okay. See, what is the condition here? What is the business model? Collection of a contract. Please repeat. Collection of a contractual cash flows. Nothing but CCF test plus SPPA test. Suppose example, if we take an example, debtors. Debtors is a financial asset, right? Financial asset. Okay. If the business model is, our business model is collection of contractual cash flows. Okay. And satisfy the SPPA conditions. Suppose example, if you gave a loan to any person, you will collect the principal plus interest only, right? Okay. If it is only the condition, okay, if it is only the condition, nothing but your business model, then you can recognize that amortized cost. In case of a security deposit, also same. If you deposited nothing but security deposited, as a security you are deposited. Okay, so security, based on that also you will get a principal plus interest. Are you getting my point? Suppose example, if you deposit in a bank also, you will get interest or not? Yes. So our business model is contractual, collection of contractual cash flows, and must satisfy the cash flow satisfy SPPA condition. Here, no intention to sell till hold maturity. Suppose example, you invested in debentures for a period of 5 years. You should not sell it before 5 years, sir. You have to hold it for 5 years. We don't have any intention to sell it. So our business model is not to sell that. Our intention is to hold till maturity. Okay, now clear? So next, debt instruments. Mainly debt instruments is the best example. Yes, best example, because our business model is the collection of contractual cash flows and solely principal and payment of interest only. Solely payment of principal and interest. So based on the principal amount, you will get the interest amount, right? Correct or not? Says or no? Yes. Debt instruments. So if it is a financial asset to your entity, it is financial liability to other entity also. Correct or not? Yes. So our business model is, can you please repeat? Contractual, sir, very important. Collection of contractual cash flows and it must satisfy the SPPA condition. Example, debt instruments. Next, FET-OCA means if the business model is collection of contractual cash flows, okay, and cash flow satisfies SPPA condition also, okay. And one more point adding here, you can sell it before maturity. If you want to sell it before maturity, then you can. Our business model is like that only. So then you can measure it FET-OCA. Otherwise, amortized cost. If not covered under first 1 and 2 methods, then you will cover under third one. Okay, now. So majorly derivative financial assets held for trading investments. Okay, so derivative items will comes under last one, FVTPL. Okay, now. So investment intended to sold in short term. So your intention is sell in short term only. Next, investment in equity of any company when no contractual cash flows of interest and payments. There is no contractual cash flows regarding interest and payment. Principle. Okay, now. Are you getting my point? No, sir, I am not understanding. Just wait. At a time, we will not get a complete clarity, sir. Just wait. Okay. See, okay, now. Are you getting my point? So, in case of amortized cost, our business model is CCF test plus SPPA, but you should not sell before maturity. If you sell before maturity is your business model, then it comes under FET OCI, fair value through other comprehensive income. Fair value through other comprehensive income. Clear? If not covered under 1 and 2, then comes under 3. What is that, sir? Derivative financial assets held for trading investment. Derivative financial asset. So you know about already discussed about derivatives. Okay, now. So we have a derivative financial asset and derivative financial liability. It's a based on underlying asset. It arises because of underlying asset. I think everyone knows about the derivative. You should know about it, sir, in SFM. Okay, now. Okay, so no issues. See, for theory point of view, exam point of view, you remember these two conditions. In case of amortized cost, business model is collection of CCF, contractual cash flows, and SPPA test should be satisfied. Solely payment of principal and interest. Examples, debt instruments. Example, government bonds. Suppose example, government bonds also we can take an example. Suppose our business model is not to sell that bonds till maturity. Okay, so and also we will get the principal plus interest also. Then it is a financial asset to financial asset to the entity, we can recognize that carried at amortized cost. Carried at amortized cost. If our business model is to sell before maturity, then we'll go to the FET OCA. Okay, now if in both the cases if it's not covered, then go to third one. What is that, sir? FET fair value through P&L. Fair value through P&L. Okay, now clear? Okay. Simple. This is the classification, sir. This is the classification. See, but in case of a financial asset, we have three methods: amortized cost, FET OCA, FET PL. Okay, now. But in case of financial liability, only two methods: amortized cost and FET PL. But for equity only initial recognition. At only initial recognition, we can measure at equity. If it is an equity share capital, we can measure at that value only. Okay, clear? This is the classification of a financial asset. Okay, now just change. Okay, now clear? So first amortized cost, FET OCA, FET PL. If 1 and 2 not covered, if it is not covered under 1 and 2, then comes under 3. Simply we can what is that, sir? Derivative contracts, derivative financial asset example, one of the example, and held for trading purpose or trading, everything will comes under, will measure at FET PL only. Okay, now clear? That's it. So this is all about classification. Clear? I think everyone clear about this classification. Yes or no? Just right. Okay. Clear, sir? One more time I am going to repeat. One more time. Okay. Measurement of a financial instruments. Recognition and measurement of a financial instruments. Okay. So here classification we have three. And the thing what you already know about the categories: financial assets, financial liability, and equity. Okay, so we have actually three methods, nothing but we can recognize the financial asset or liability at three ways. Okay, what's that, sir? One is amortized cost, second one is FET OCA, third one is the FET PL. It classifies into three categories. Business model, what's that, sir? Business model. Okay, what is the business model? CCF test plus SPPA test, but no, don't sell before maturity. Okay, if you have our business model is SPPA, next CCF plus sell before maturity. You can sell before maturity. So for example, we discussed about government bonds. Okay, if you can if your business model is to sell that before maturity, then comes under FET OCA. Okay, now clear? This is classification. I am going only in examination point of view. Don't worry, please wait. Next, we are going to discuss about compound financial instruments. Okay, we are done with the classification. Now, compound financial instruments, very important for examination point of view. Damn sure question will come from this topic only. Actually, if we discuss the financial instrument topic, it will take almost 10 to 15 hours also. 10 hours. Okay, the two CA final level I'm telling about. Okay, we don't have that much theory, just they have given basic questions and basic theory only. That is more than enough for exams. Okay, you can crack the exams. Previous 2 terms questions also easily you can solve. Okay, now we'll discuss that questions. That questions only given in the book. Clear? Okay. See, compound financial instruments. Compound financial instruments means which have both debt and equity components. It is the combination of debt and equity components. we can call it as the compound financial instrument. Compound financial instruments. Examples for that: convertible debentures, convertible preference shares. Okay, na compulsory convertible equity shares. There is a compulsory convertible preference shares. So which means, suppose example, if we take a convertible debentures means presently it is a debentures only. It will convert into equity shares later. It will convert into equity shares later. So then we can call it as a compound financial instrument. In case of a convertible preference shares also same. So present it is a preference shares only, but in future it will convert into equity shares. So that's why this comes under compound financial instrument. It includes both debt and equity components. It includes both debt and equity components. Debt means liability component. Okay, now we are going to calculation. How to calculate liability, how to calculate equity. Okay, now completely examination point of view, don't worry. See, how to calculate the liability. Simple, sir. Present value of a cash outflows of a principal and interest. You are getting a 1 lakh rupees cash flows every year, and also interest on that also. So what should you do, sir, for calculating liability? You have to calculate the present value of a cash outflows of a principal and interest. Principal and interest. Are you getting my point? Present value of a cash flows of a principal and interest. This is a liability component. Sir, how to calculate? We'll discuss one example. A Limited issued 6% debentures of rupees 10 lakhs on 1/4/2017. On 1/4/2017, repayable on 31st March 2022. How many years? 5 years, 18, 19, 20, 21, 22. How many years? 5 years. So 10 lakhs are okay. Debenture value 10 lakhs, 6% debentures. The debenture holders have a right to receive equity shares at a face value of 4 lakhs at maturity as alternative to repayment in cash. The required rate is 10%. How transaction will recognize measurement and present rate 2017 and 18. Simple, sir. So these are the 6% debentures, convertible debentures on 1/4/2017, repayable on 31st March 2022. So the debenture holders have a right to receive equity shares of face value of 4 lakhs at maturity as alternative to repayment in cash. So they have an alternative. They have an alternative at maturity date. They have a right to receive equity shares. Okay, now by issuing of cash, repayment of cash, they are giving equity shares. They have a right to receive also. Required rate is 10. Now what should we do? So here it is a compound instrument or not, compound finance instrument or not. It includes both debentures, nothing but liability component and equity component. So that's why first of all you should calculate the present liability component, nothing but present value of cash flows of a principal and interest. See, every year, total value how much? 10 lakhs, right? 10 lakhs. So every year interest how much? So A Limited issuing means A Limited has to pay interest. So what is the interest amount? 10 lakhs into 6%. 60,000. How many years, sir? How many years? 5 years. So you have to calculate the present value. See, calculation of present value of cash flows of principal and interest. First year cash flow 60,000. Second year 60, third year 60, fourth year 60, fifth year also 60. But after fifth year, repayment has to be made, right? How much repayment? Total amount, principal amount, how much? 10 lakhs. This amount has to be paid at the end of fifth year. So that's why I have taken directly. So 10 lakh 60,000. Okay. So every year cash flows how much, sir? Cash flows means outflows here. Interest you have to pay in A Limited point of view. Okay now, so 60, 60, 60, 60, 60, 50 also 60. You can take separately this 10 lakhs, but I am taking directly because everything is same, right? Because the present value is 50 running only. So now this is the format actually. Here cash flow, present value factor, present value. Present value factor at what rates are 10% rate, you have to bring it into the present value. Okay now, so present value factor at the rate of 10%, 1 divided by 1.1 calculator, 1 divided by 1.1, how much? 0.909. Next, 1 time equal to you will get 0.09, 2 times equal to you will get 826, 0.826, 3 times equal to you will get 0.751, 4 times equal to you will get 0.683, 5 times equal to you will get a 0.621. I think you already know about this basic present value calculation. Is it clear? Yes. Then you can calculate the present value. This is the present value. You got this answer. Okay now. So this is the liability component. For liability component, you have to calculate the present value of cash flows of principal and interest. Okay now, simply I bring all the values into the present value. That's it. We got a liability component. Because it's a compound finance instrument, right? So total amount is how much actually? 10 lakhs. Huh? So total amount is 10 lakhs. Out of the 10 lakhs, that 10 lakhs is not only the liability component, it includes equity component also. Okay na? So because we are issuing a 4 lakhs value of equity shares, having a face value. Okay na? So it's a compound financial instrument. Compound financial instruments, convertible. Compound financial instrument. So that's why, okay, we have calculated the liability component initially. What is that? Present value of a cash outflows. Okay now, cash flow simply, whether it is outflow or inflow, same calculation. Whether it is inflow or outflow, same calculation. Inflow means it's a receipt like, outflow means it's a payment like. That's it. Same present value calculation. If you are in other party's point of view, other company point of view, also same calculation. Present value calculation. Okay now. Clear? Huh? Okay. So we are done with the liability component. Present value of cash flows of principal and interest. Now you have to calculate the equity component. So it is a part of a convertible equity shares. Correct or not? Yes. So how to calculate this equity component means simply total liability minus nothing but total value. How much total value? 10 lakhs. Total value how much, sir? 10 lakhs. Out of the 10 lakhs you have to reduce this liability component. You will get a equity component. So yes or no? Because you are issuing 10 lakhs only. 10 lakhs value of debentures only. So 10 lakhs is the general liability. General liability because it's a convertible debentures. So what is that, sir? Total 10 lakhs will not be the liability. It includes equity component also. Then how to calculate equity component, sir? Total liability minus liability component. Nothing but issue price, sir. Total liability means total issue price. Issue price how much? 10 lakhs. Issue price how much? 10 lakhs. Okay now? Clear now? Yes. Okay, clear? So this is the equity component calculation. I think everyone clear about this because it is very important. Examination point of view, they are asking repeatedly this question only based on compound financial instrument. Please be careful about this question. Okay now? Are you getting my point? Yes. So we are not done with the question immediately. Sir, we already discussed this. the liability component is 8,48,400 only. So interest will be charged on this component or this component actually? Yes, this component. But we are paying interest on this one. Correct or not? Yes or no? We are paying interest on 10 lakhs only, but actual interest is on this one. Yes or no? So for that purpose, you have to prepare amortization table. Amortization table. Okay now. Sir, how to prepare this amortization cost? Amortization table. Simple, sir. I want to calculate the actual interest for each year. Actual interest for each year. For that purpose, I have to prepare this amortization table. Okay. See, this is the format like year, opening balance, interest, payment, closing balance. What is that, sir? Okay, what is that? Opening balance, interest, payment, opening balance, year, opening balance, interest, payment, closing. So this format is very flexible to us to understand this. Okay, now this format is very flexible. Okay, see, first of all, year one. Year one, the opening balance is how much, sir? What is the opening liability value? Opening outstanding liability, how much? 8,48,400 only, correct? Yes. So here the interest rate is 10% only. Here the interest rate is 10% only. So generally you have to take market rate, sir. When we are calculating this amortization table, you have to take a market rate. But in the given question, there is no separate rate. So you can take what rate, sir? Directly 10% rate only. Are you getting made? Sometimes that interest rate will be different from this rate. Are you getting my point? Sometimes we have one more question on this, so we'll discuss about it. Present the rate is 10% only. Interest at the rate of 10%. 8,48,400 into 10%. 84,840. 84,840. This is the interest on it. But we are paying how much? We are paying 60,000 for every year, right? So payment is 60,000. Then what is the closing liability? This is the calculation I want. Are you getting my point? Opening value, opening liability is 8,48,400. That is the opening liability. And also interest is also my liability only. Yes, interest I have to pay to the entity, right? Other entity. So this interest portion will be added to the liability amount. So 8,48,400 plus, because liability is increasing, right? So 84,840. We will get some amount. Out of that liability, you are paying 60,000. You are paying a 60,000. So 60,000 should be minus. Correct or not? Are you getting my point? Sir, I want clarity about this question. Because if you don't have a clarity, you cannot attempt this question in exam. You will get confused also. Okay, na? So opening balance plus interest minus payment. That's why I have framed this, pro forma for flexibility, for understanding purpose, easily understanding, plus minus. You will get the closing outstanding amount. Okay, na? Closing outstanding amount, closing balance. Current year closing balance for next year, opening balance, correct? Same calculation. Interest on this amount, 8,73,240 into 10%, 87,324. So payment how much? 60,000. Payment 60,000. You are getting a closing balance. Understanding? So 9,564. Same for third year also. 9,564 into 10% minus 60,000. So simply opening balance plus interest minus payment. Because the interest will be added to the liability portion only. Interest will be added to the liability portion. So here general entries are also very, very important. General entries are also very, very important. Okay. So Payment 60,000 will get a closing balance. Same for all the years. Ultimately, you are paying 10 lakh 60,000 at the end of the last year, right? So if you see the cash flows, this is the cash flows, right? You are paying this amount first year, second year, third year, fourth year, fifth year. In fifth year, you are paying 10 lakh 60,000. So ultimately, the balance amount should be adjusted to this. So there is no closing balance because the liability is repaying completely. There is no balance. But sometimes, if you add these two amounts, exact amount will not come. Some 500 or 1000 rupees, some difference may come because of decimals difference, points difference, some difference may come. At that time, you have to adjust it to interest amount. You are not understanding, I think so. So 9,63,682 is the balance, right? Okay, if you calculate interest on this, how much? 96,368. That should be the interest, right? Actually, the interest should be 96,368, but the interest is 96,318 only. Why did it happen, sir? Because of points difference. So at that time, how to calculate this interest means simply out of this payment, you should reduce this amount. You will get the balance interest amount. Interest should be the balancing figure here. Are you understand my point? Understanding or not? Clear? So you have to do like this only because these two, if you add these two amounts, you should get this amount. Then only it will be zero. Otherwise, it will not get zero, right? Some difference points, 10, 5 rupees or 10 rupees, 200, 300 difference may come. So please don't do like that. Okay, please adjust to interest amount. Actually, if you calculate the interest, 96,368. But if you write this, if you add these two, you will not get 10 lakh 60. Because there is no repayment, there is no balance amount pending. So contract get closed also. Okay, so that's why there should not have any difference. So you should reduce this from this 10 lakh 60 to 9 lakh 63,682. You will get some interest amount, 96,380. That is the interest portion. This is the way of calculation of amortization table. Clear? Okay now. So this is the journal entry actually. So first of all, you are getting a cash bank account debit. Two, we have two portions. One is liability portion, one is equity portion. So convertible bonds, convertible debentures. This is another question actually. This is question number 2. I have not written the entries in question number 1. Okay, but you can write by your own. Same like this. So bank account debit. Okay, convertible debentures account, balance sheet, bracket low, liability component. How much? 8,48,400. 2 convertible debentures equity component. How much equity component? 1,51,600. Okay now. Bank account debit how much? 10 lakhs. Bank account debit to debentures, liability component brackets in brackets, to debentures, equity component in brackets. 8,48,400, 1,51,600. That's the first entry. For second entry, interest portion will be added to liability portion, right? So interest account debit to debentures liability portion. When payment made, liability should reduce because we are minusing from liability, subtracting. So that's why liability should be debited here. See here entry, you will understand. So liability account debit to cash or bank, 60,000 in our example. In our example, liability to cash for the first year. For a period of 5 years also same. In last year, we have to issue equity shares. We have to issue equity shares. We'll discuss about the entry for equity shares. Last entry. Simple sir. 2 equity share capital. That's it. Okay. So we'll discuss in second example actually. So I think everyone understand this basic. This is basic example. This is basic example for compound financial instrument. Please watch the video again if you are unable to understand, because very important. I am very clear about this. I think no one should have a doubt in this. Maybe little bit confusion. Please repeat this video. We are giving almost 7 views, right? 7 views. 7 times you can watch the video. Okay. So nothing to worry. Clear? So we'll discuss in next session. Okay, thank you.